Hello everyone, welcome to EduTap and welcome to today's comprehensive video in which you will be getting the important RBI notifications and finance current affairs that we have discussed in the April 2026. So you will not have to go through the different videos, you will not have to go through the whole playlist of the Finance 360 degree to search for the important sessions, to search for the important articles. In this one comprehensive compiled video, we are providing you the most important RBI notifications and the finance current affairs that we have discussed in the April 2026. Okay, so it will save your time, it will save your efforts, and this session is going to be important from the examination perspective. So let's get started. But before that, there is a big announcement from EduTap that we have brought for you this RBI Grade B guidebook, where you are getting the previous year questions for the different components for the different subjects at one place, as well as you are getting the important topics for the different components so that you can see your coverage that is in the right direction or not. Resources are also provided in this one guidebook so that if you are doing the self-study, you can see the right sources. And the 6-step strategy is provided so that you can move in the right direction in your preparation. And this 6-step strategy is going to help you. Okay, so this guidebook is absolutely free of cost. The link for this guidebook is provided in the description box below. So do get this guidebook. Okay, to download this guidebook. Now let's get started with today's session. So we have discussed about the Payment Vision 2028. So RBI has been periodically preparing the Payment Vision since 2001. Okay. Now the RBI has released the Payment Vision 2028 for the duration up to December 2028. How many specific initiatives have been mentioned under the Payment Vision 2028? So there are 15 specific initiatives that have been mentioned under the Payment Vision 2028 that have to be undertaken in the next 3 years. Okay. So this, the core theme of the Payment Vision 2028 is shaping India's payment frontier. Okay, so this is the core theme. And the Payment Vision 2028, it has the dual imperative, or it focuses on the dual areas. One is to consolidate and strengthen the existing systems and the existing infrastructure while pioneering the future payments. Okay, so the dual imperative or dual focus of the Payment Vision 2028 is to consolidate and strengthen the existing systems and the infrastructure while also focusing on the future of the payments. Okay, now Payment Vision 2028, these are the two sections that we have already completed in the previous session. So I have taken a detailed session on the Payment Vision 2028. I hope you have seen that previous session in which we have discussed the section 1 and section 2. Today we have to focus on the section 3, that is the specific initiatives of the Payment Vision 2028. Okay, so today we'll focus on the specific initiatives that is for the Payment Vision 2028. Any confusion? Chalo. Now, specific initiatives, well done Ashish. Now, we have already done the 2 sections. Coming to the 3rd section, this document is still what? This document is valid up to what? This document is valid up to December 2028. What is the theme of this document that you have to remember? Okay, what are the dual imperatives? Consolidating and strengthening the current systems while also pioneering the future payments. So these are some of the points that you have to remember from the Payment Vision 2028. Now coming to the specific initiatives, starting with this. So coming to the first one, the facility for the remitter, that is the sender. If you are sending the money, you can enable or disable the transactions in your card. So usually when you do the Amazon payment, you see that okay, your card is blocked or your card is not available for transaction. You have to permit through your mobile phone. So you can enable or disable the transactions through your card, through your debit card, through your credit card. So customers can already switch on or switch off, that means enable or disable the domestic and international card transactions. So the customers, they have the better control over the usage, that where the card is being used, for what kind of transactions the card is being used. So customers can already switch on or switch off their domestic and international card transactions, giving better control over usage. Now it has been proposed under the Payment Vision 2028, it has been proposed to extend this feature to all the digital modes, that is the UPI, wallets, net banking, so that you can enable or disable the transactions. Okay, let's say I know that for the coming week I do not need the UPI, or I do not need to use the wallets because I will be using the UPI, or I do not need to use the UPI because I have money in the wallets. So I can disable the UPI so that the frauds and such kind of activities, nefarious activities does not happen. Okay, so there is the proposal to extend this feature to all the digital payment modes. When you want to actually transact, then only you can enable the system. Okay, so this is the idea, that the facility for the sender of the money to enable or disable the transactions on any digital payment mode through issuer challenges. This will contribute towards controlling the frauds in digital payment transactions. So basically, if there is the facility to switch on or switch off the domestic and international card transactions, then the same facility will be provided to the other digital payment systems. Now, reports on cross-border payments, domestic trends, global development, strategic implications for India's payment ecosystem. So RBI shall publish basically report on cross-border payments. So it has been proposed that RBI shall publish regular reports on cross-border payments covering key metrics such as the volume of the cross-border payments, the cost, what is the cost of the cross-border payments, the transparency, the speed, the performance of the various channels. So if through different channels the payments are happening, the cross-border transactions are happening, so what is the performance of the various channels, which channel is performing the best. The RBI shall publish the regular report to also track the global development in the legal, regulatory and technological and the process advancements, so that we can also develop seeing the global developments. We have to benchmark India's progress against the global trends, and the reports shall also identify the gaps and the areas of improvement in the cross-border payments domain. See, when we have a report, then we can see that, okay, where we are working better and where we are not so better, or where we can improve. Okay, so that's why it has been said that proper reports have to be constituted for the cross-border payments by the Reserve Bank of India, so that through these reports we can identify the key, we can cover the key metrics, we can see the key metrics, we can track the global developments, and we can identify the gap and the area of improvement while assessing the impact of international development on India's payment system. Okay, so this is the idea, that we have to publish a report. The RBI has to publish a report on the cross-border payments, so that we can see the domestic trends, global developments, strategic implications for India's payment ecosystem. Okay, now coming to the next specific initiative, that is streamline the cross-border payment authorization under Payment and Settlement System Act 2007 and the Foreign Exchange Management Act 1999. So till now what happens, that the authorized dealers, the authorized persons, they are authorized by the Reserve Bank of India to do the transactions or to buy and sell the foreign currency. Okay, to buy and sell the foreign currency against rupees, or to buy the rupees against the foreign currency. Okay, so this is the basic idea, that the authorized dealers or the authorized persons, they are authorized by the Reserve Bank of India to do the transaction in the foreign currency, to buy and sell the foreign currency. So in order to facilitate cross-border transfer of funds, the entities, the authorized dealers, the authorized persons, they need to seek authorization under the Payment and Settlement System Act and the Foreign Exchange Management Act. That means they have to take the authorization under the Payment and Settlement System Act, and they have to take the license under the FEMA. So there was the duplication of efforts. If you want to become the authorized dealer, or if you want to act as an authorized person, you had to take the authorization under the PSS Act, Payment and Settlement System Act, and you had to take the license under the FEMA. So to improve the efficiency, there is a single window application process that shall be considered. Okay, so to improve the efficiency, a single window application process that shall be considered. This will allow the firms, this will allow the entities to enter the market faster and at lower cost, because the authorized dealers, they will not, or the entities that want to become the authorized dealers, they will not have to take the authorization in the PSS under the PSS Act and license under the FEMA Act. There will be a single window application process that shall be considered. This will allow firms to enter the market faster and at lower cost instead of navigating multiple approvals. So this will enhance the ease of doing business. Okay, so before, there were the two areas from where the authorization and license were required, but now there will be a single window application process. So this is a very important initiative. Okay, next is review of cross-border payment ecosystem. See, the domestic, when it comes to domestic transactions, we have so many of the tools, we have so many of the infrastructure. We have UPI, we have Bharat Bill Payment System, we have Aadhaar enabled payment system, we have RTGS, we have NEFT. But when it comes to the international transactions for the cross-border payments, we do not have so many of the infrastructure. We do not have such developed infrastructure. Okay, so basically there is the need to review the cross-border payment ecosystem with an objective to increase the efficiency of the cross-border payments. First of all, cross-border payments, they are very important for the India's trade and remittances. The exporters, the importers, they need to do the cross-border transactions. We need to get the money from outside, or we need to send money outside. So the cross-border transactions, the exporter and importers, for them it is very difficult right now, or it is complicated right now to get the money or to send the money. So it has been said that the cross-border payments are vital for India's trade and the remittances that we receive or the remittances that we send. Efficient payment ecosystems, they are critical for reducing the remittance cost, the cost of transacting the money between the countries. But these payments, they are very complex due to multiple intermediaries, due to multiple jurisdictions. We are exporting to Middle East, let's say we are exporting to USA, we are exporting to the UK, we are exporting to Germany, Italy, and the other European Union nations. So we are exporting to so many of the countries. Now these different countries have different regulations. So the cross-border payments become very complex due to the multiple intermediaries, multiple jurisdictions and regulations. So the global agenda shaped by the G20 also aims to make these cross-border payments faster, cheaper, transparent and accessible. RBI is actively improving the cross-border payments ecosystem. Okay. Now RBI, what is the proposal? That RBI shall undertake a comprehensive review of the existing ecosystem to identify the friction from the regulatory, operational and technological perspective to strengthen the India's cross-border payment landscape. Okay. So basically we have to identify that from where the friction is coming, from where the problem is coming, from which domain, from the regulatory perspective, from the operational domain or from the technological perspective, from which area the problem is coming, the friction is coming, and we have to improve so that the cross-border transactions can become smoother and the cost of the cross-border transactions can be reduced. Okay. Now coming to the next one, that is limiting liability of the customers shared responsibility framework. If there is any fraud, digital transaction fraud that happens, so this is the responsibility and the liability of the issuer bank, that is issuing the money, to look after this digital transaction fraud and to take the liability for this digital transaction fraud. So basically under the limiting liability, so the existing limiting liability framework for safeguarding the customers from payment fraud, it places the responsibility and the liability exclusively on the issuer bank that is issuing the money, So if there is a digital transaction that is happening, if the payments are happening, that means there is a issuer, there is a sender of the money, there is a issuer bank, and there is the beneficiary that is going to get the money. There is the receiver of the money that is receiving the money in the beneficiary bank. So there is the issuer bank that is issuing the money on behalf of the sender, and there is the beneficiary bank that is receiving the money on behalf of the receiver. So basically right now, under the existing limiting liability framework for safeguarding the customers, it is the responsibility of the issuer bank to take the responsibility and liability in case of the payment frauds. Now it has been said that a shared responsibility model is proposed. Okay, under the specific initiative, a shared responsibility model framework is proposed where both issuer bank and the beneficiary bank, they share liability for unauthorized digital transactions, encouraging that both the banks, both the side of the parties, both the issuer bank and the beneficiary bank, they should take the liability, because if both the banks are taking the liability, if both the banks are taking the responsibility, there will be better fraud prevention that can happen, because rather than one bank being responsible to look after the frauds or to close the frauds or to stop the frauds, now there are two banks that will take the responsibility to stop the frauds. So this will encourage better fraud prevention, coordination and stronger customer protection. Okay, so rather than only one bank being responsible, now both the banks should be responsible, should share the liability and responsibility for unauthorized digital transactions. Now coming to the next one, that is recognize the small payment system providers, so that there is a perpetual regulatory sandbox. So now what it has been said, that there will be a new category of small payment system providers that will be identified. Now these small payment system providers can be the small fintech companies that are doing some innovations in the digital payment domain, in the retail payment domain and such. Now because these are small fintech companies that are only creating the innovation for a small area that has very less risk. So these kind of small payment system providers will not need the authorization from the Reserve Bank of India. Okay. So to encourage innovation, a new class of small payment providers, system providers is proposed. So to encourage the innovation, to continuously keep on doing the innovation, to continuously have the innovations, a new class of small payment system providers is proposed, allowing them to operate without prior authorization from the Reserve Bank of India at early stages, because these are the small payment system providers. They are the very small payment system providers that are doing the innovation, but they have very less risk because they are the small entities. Okay, so they cannot create a big impact in the terms of the risk. Okay, they can do the innovations, they can create new innovations, but they have less risk because these are the small entities. So to encourage innovation, a new class of small payment system providers is proposed, allowing them to operate without prior authorization from the Reserve Bank of India at early stages, so that they have the freedom to develop their innovative products and services. So regulation would be applied later based on their scale of activities and the risk profile. The higher the risk that they are dealing in, the more the regulations will be basically. So this risk-based approach promotes ease of doing business while maintaining systemic stability. So in the initial phases, when the innovation is not very risky, when the scale is not very big, so then there will be no authorization that will be required, the regulations will not be there, or the strong regulations will not be there. But when the innovation is for the larger group of people and have more risk, then there will be more regulations, so that there is systemic stability that is maintained, the financial stability is maintained. This is the idea. Coming to the next point, any confusion anyone has till now? Any confusion anyone? No? Now, develop payments research and training capacity. Another specific initiative is to develop the payments research and training capacity. So the global payment landscape rapidly evolves. There are so many of the countries that are doing the different kind of innovations. So there are the new and emerging technologies. To keep pace with evolving payment technologies, it is proposed to enhance the research and training in areas like the policy making, risk management, fraud prevention, cross-border payments, cybersecurity. So these are some of the areas that you can see where we are lacking. Fraud prevention is a major issue right now, because the digital payment ecosystem is evolving, it is developing, but we have to focus on preventing the frauds through these digital payment ecosystem. Cross-border payment is a point where we have to focus. Cyber security is the point where we have to focus. So now it has been said that we have to enhance the research and training in areas like policy making, risk management, fraud prevention, cross-border payment, cyber security, while building global and domestic partnerships with various central banks, international standard setting bodies, the payment system operators of our country and other countries, especially from the global south, for knowledge sharing. Okay. Next is cyber key risk indicators framework for non-bank system payment system operators. So non-bank payment system operators, like you must have seen the Paytm wallet. There is also MobiKwik wallet. There is also the Trades platform, the trade receivables discounting system. That is a payment system basically through which the MSMEs can get the instant payments or the instant money. Okay. Then there is also the white label ATMs that are operated by the non-banks. Okay, so these are the ATMs that are not operated by the banks. They are white label ATMs. That means these ATMs are operated by non-banks. There is also the card networks basically. So there are different card networks. These are the non-bank payment system operators, because they are operating the payments. They are operating the payments. They are operating the payment system. Okay, the card networks like Visa, MasterCard, American Express, RuPay. So these are the card networks. They are the non-bank payment system operators. Okay, so this is the idea of the non-bank payment system operators. Now it has been said that it has been proposed basically that there should be the cyber key risk indicator framework for the non-bank payment system operators, because they are operating the payment system. They are involved in the transactions, in the digital payment transactions, in the transactions they are involved. Even the Bharat bill payment operating units that operate the Bharat bill payment system and that operate the transactions, or they help in the transactions to be completed. Okay. So there are so many of the non-bank payment system operators. So it has been said that the cyber key risk indicators framework for the non-bank payment system operators shall be developed and implemented. This framework, now what this framework will do, what are these key risk indicators? So this framework shall assess and monitor the robustness in cyber security of such entities on a continuous basis, because the card networks, the Bharat Bill Payment Operating Units, the Paytm wallet, the MobiKwik, as well as the white label ATMs, they all these entities, all these units, they basically are involved in the transactions. They basically are storing the data, or they basically are getting the data from the customers. So basically, this framework will help assessing and monitoring the robustness in the cybersecurity of such entities on a continuous basis. It shall enable RBI to systematically identify and monitor the key risk indicators across the industry, that in the card networks or Bharat Bill Payment Operating Units or in the wallets, in the digital wallet space, what are the key risk indicators, compare the cyber resilience of different entities. So there are different Bharat Bill Payment Operating Units, there are different card networks, there are different digital wallets. So in the space of the digital wallets, which entity is having the least cybersecurity, which entity is having the most cybersecurity? So the comparison point will be allowed, and compare the cyber resilience of the different entities in a domain. Track their security posture over time, as also provide early warning signals to identify and monitor the potential IT and cyber risk. So basically, it has been said that this framework will be for the non-bank payment system operators, because they are not banks, so they are not regulated directly in a very strict manner. But these payment system operators, they are involved in the transactions, so that's why they should have robust cybersecurity. And this framework has been developed to assess and monitor the robustness in the cybersecurity of such entities on a continuous basis. RBI to systemically identify and monitor the key risk indicators across the industry in a particular domain, compare the cyber resilience of the different entities, track their security posture and such. Okay. Now, coming to the next one, review of design and security features of checks and explore introduction of electronic checks. So right now, if you have to give a check, what is the form of check that you are giving? The paper check? Even if we have the check truncation system, that basically involves the digital transfer of the images and the MICR data between the banks. Till now, we only have the paper check, and the bank, they take the digital images of the paper check, they take the MICR data of the paper check, that digital images and that MICR data is transferred between the banks so that the check can be settled. But the check is in the paper format only. Whenever you sign the check, it is in the paper format only, right? So now there is the idea that it is proposed to explore the introduction of electronic checks. So in the electronic format, maybe in your mobile phone, in your laptop, you will see a check that you will sign digitally. So these kind of ideas have been proposed. So first of all, a review of design and security features. So building on the existing check truncation system 2010 standards, banks have independently implemented additional security features. Okay, so on the basis of the CTS 2010 standards, the banks have independently implemented additional security features leading to variations across the system, because the different banks are following the different security features for the check. A comprehensive review of the design and security features of the checks shall be undertaken by the Reserve Bank of India to enhance the uniformity, strengthen the fraud prevention. So basically, the different banks are following the different security features for their checks. Now it has been said that RBI should do a comprehensive review of the design and security features so that there can be uniformity that can be maintained in the security features of the check. So some banks have more security features, some banks have very less security features. So to maintain some uniformity in the security features, there is a comprehensive review that will be undertaken to strengthen the fraud prevention and ensure alignment with emerging processes. The review shall identify and adopt the best practices with the higher security features. Further introduction of electronic checks in India shall be explored. Okay, so this is the idea, that electronic checks idea is going to be explored. Now, facilitate enhanced access to payments data. So basically, With rapid growth in the digital payment ecosystem, it is proposed to create an AI-enabled user-friendly payment database, improving the transparency, monitoring, and supporting the data-driven innovation. This shall also serve as a single point of access for the cross-border payments data, which shall provide a unified dynamic view of India's cross-border payment ecosystem. So basically, in the whole point, it has been said that we need to have a database for our digital payments, and for the cross-border payments data also, this single access should be provided, or this single point of access should be provided. Okay, now coming to the next point, that is payment switching service. Okay, pass. So what is this? Basically, it has been said that, let's say, like, I get my salary in a bank account, let's say Bank of Baroda bank account. From this bank account, I'm getting the salary, as well as I am paying for my mutual fund, I'm paying for my insurance premium, I'm paying for the Netflix subscription or Jio Hotstar subscription or any other subscription, I'm paying for my MediBuddy subscription, okay, for the medical app and such. I'm also paying for other subscriptions. Okay, let's say I'm paying for the AI platform subscription and such. So from my one account where I'm getting the salary, I am paying so many of the different subscriptions amount. Okay, now what happens that I want to segregate my salary account and my expenditure account, because I know that I am spending a lot from my salary account, and sometimes I'm not able to decipher that how much amount has been spent from this account. So if let's say I have a salary of 10,000, so I am sending the money to the other account, Bank of India account, let's say the Canara Bank. In this account, I have sent 5,000 rupees, that only this amount I will spend, and the rest 5,000 rupees will be saved in my salary account. So this 5,000 rupees that I am sending in the Bank of India account, I want to spend only from this account. That means I will have to transfer all of individually. I will have to give the instructions to the different mutual funds that I will be sending the money through this Bank of India account or Canara Bank account. The insurance premium, here also I will have to change the account details. For Netflix, Jio Hotstar, I will have to change the account details. For MediBuddy, I have to change the account details. For the other subscriptions also, I will have to change the account details. That will be a very lengthy process. So I will, after one or two subscriptions, I will get tired and I will leave this whole process. So now, to make the process easier to transfer or to change the accounts, to make the process easier, there is the pass that has been launched, okay, or that is proposed to be launched basically. So customer face challenges in managing their payment instructions in case their account number changes. So if you want to change your account number from where the subscription amounts are going to be taken, so you face a lot of challenges, because you will have to individually you have to change the account details, you will have to change the account number and such. So if you want to shift from one bank to another, or if there is a merger of the bank that is happening, acquisition of the bank is happening, and you have to change the account number, you have to change the details, then individually you have to change all the details, which is a very lengthy and hectic process. To address this issue, the feasibility of implementing a payment switching service shall be explored, so that by one instruction, or in one instruction, I can easily change my account from Bank of Baroda, or I can easily change the transactions from the Bank of Baroda to Canara Bank. Okay. So basically, this is the idea. It is envisaged as a centralized service that would facilitate migration of payment instructions, both incoming and outgoing, from one account to another. So I can easily migrate the payment instructions from my Bank of Baroda account to Canara Bank account. So this is the idea. Okay. So this is the idea that usually you face the challenge if you change the account. You have to like direct debits, all the payment instructions that you have given, you have to individually change the payment details. You will have to individually change the payment details. So with the payment switching service, what will happen, that there will be a centralized switching service that will be provided. You just have to give the authorization, and easily the new bank, the payment instructions will be created through the new bank. So this will create a seamless migration to new account. Using this functionality, customers shall be able to view all the payment flows linked to their accounts and initiate either a full or partial switch with appropriate authorization. So with appropriate authorization, you can do the full or the partial switch. Okay. Or let's say that I want to, from the Bank of Baroda, that is my salary account, I want to continue paying the mutual fund insurance premium because these are the things that are the investment and for my health and such. But the leisure activities, I want to transfer it to the Canara Bank account so that I specifically know that how much I am spending on the leisure activities and such. Okay. So if I want to segregate and if I want to send the payment instructions to the Canara Bank, this can be done. The partial transfer of the payment instructions can be done easily through this centralized switching service, through this pass. Okay, the objective is to provide customers with centralized control over their payment instructions, facilitate orderly transition during systemic changes like bank mergers. Now, coming to the next one, bringing entities. Yes, these initiatives are from the side of the Reserve Bank of India, that what initiatives RBI can take. Okay, so specific initiatives have been mentioned in the Payment Vision 2028. So that these initiatives can be taken by the RBI, and in the future the RBI will be releasing the complete detailed guidelines for each of these initiatives if the RBI continues with it. Okay, so bringing entities playing critical control in payments ecosystem within the regulatory ambit. So what is happening right now, that there are multiple fintech firms, payment apps that have become the new players which are very much involved in the digital payments in the transactions. These entities are no longer just facilitators, they play a critical role in executing and managing the transactions. Okay, so large e-commerce platforms, Amazon, Myntra, Flipkart, and payment intermediaries, they now handle huge volumes of transactions, store the customer data, and control the payment flows. So these aspects shall be examined in detail. RBI has to examine these details, because the large e-commerce platforms and the payment intermediaries, now they handle huge volumes of transactions. They store the customer data like my UPI data or my UPI ID or the card details. They are getting stored if I do not tokenize my card details. Basically, they control the payment flow also. So these aspects shall be examined in detail, and if required, the scope of direct regulations shall be extended to cover such kind of entities also. On similar lines, the case of introducing white label solutions in Aadhaar enabled payment system. So Aadhaar enabled payment system, where you just provide your Aadhaar details and the biometric for the cash withdrawal or for cash transactions for bank transfers. If you are not using the UPI, if you are not using the other services, you can use the Aadhaar enabled payment system, where you are giving the Aadhaar details and your biometric to do the basic banking, to get the basic banking services like the cash withdrawal, the cash deposit, the bank transfer, the bank statement and such. Okay, now it has been said that till now Aadhaar enabled payment system, these were under the banks only. The white label, now it has been said that there is the proposal to introduce the white label solution, that means the non-banks to conduct the Aadhaar enabled payment system, or to provide the Aadhaar enabled payment system. So on similar lines, the case for introducing white label solutions, the non-banks in Aadhaar enabled payment system, this can be seen, and bringing such assisted payment providers. Assisted payment providers means that usually the bank is not directly providing the Aadhaar enabled payment system. The bank is using the business correspondents, that is the extended arm of the banks, the agents of the bank, to conduct this Aadhaar enabled payment system. Okay, so it is said that we need to bring, or there is the proposal to bring such assisted payment providers within the regulatory fold. This would also be explored. So basically the idea is that there are new players involved in the digital payment ecosystem. The large e-commerce platforms, they are having a lot of data, they are having a lot of the control on the payment flows. So these aspects shall be examined in detail, and if required, these entities shall also be brought under the direct regulations under the Reserve Bank of India. On similar lines, the case for introducing the non-bank solutions in Aadhaar enabled payment system can be seen, as well as bringing such assisted payment providers like the business correspondent agents. They should also be brought under the regulatory fold. This is also proposed. Coming to the next one, these are the last two specific initiatives. Okay, reimagine the card payment in India. So basically right now what happens, that let's say you have card of the card network with Visa. Okay, you have a debit card or credit card with the card network MasterCard. Okay, or you have a debit card or the credit card with the American Express card network, or you have the debit card or the credit card with the RuPay card network. Okay, so these card networks, they work individually and separately. There is no interoperability between the card networks. So now it is proposed to build an open and interoperable card ecosystem so that the different networks can work together rather than working separately in their own domains. So right now the different card networks, they have their own system, and they are not interoperable. They work separately. So now it is proposed to build an open and interoperable card ecosystem like the UPI. Even if you are using the Phone Pay, even if you are using the Google Pay, even if you are using the Bheem UPI, all of this is using the UPI ecosystem. Similarly, it is said that it is proposed for the card also, for the card, credit card, for the debit card, to build an open and interoperable card ecosystem to promote competition and innovation. Enhance the security through tokenization. So tokenization, it is proposed that further we need to enhance the security through tokenization. Tokenization basically tokenizes your card details, your card number. Instead of the card number, the token is sent to the merchant, and instead of your CVV details and such, the token is the one that is sent instead of your card number to the merchant. So if like you must have seen, if you are paying through Amazon or Flipkart or Myntra, whenever you are putting in your card details, there is a question that comes from RBI that do you want to tokenize your card details for the protection. You can tokenize your card details. Basically your card number will get tokenized and merchant will only see that token. Okay. Ensure greater choice and transparent pricing for users. So reimagine the card payments in India. There is further proposal to build upon the card ecosystem and to build an open and interoperable card ecosystem to promote competition, innovation, enhance the security through further tokenization, and ensure greater choice and transparent pricing. Coming to the last point that we have to discuss, implementing a uniform domestic legal entity identifier. So a unique identifier for the non-individuals. Non-individuals basically means entities, businesses that are not individuals, that are not people. Okay. So a unique identifier for non-individuals, for the entities, for the businesses, that would enable identification of parties to a transaction. This is crucial for managing risk in the financial system. In this regard, the feasibility. Right now, the PAN number is usually used to identify a particular entity or to identify a particular business. But now it has been said that there should be a case that should be seen where a uniform domestic legal identifier shall be studied. Okay, rather than having the different identification for the different entities. Some entities are providing their PAN, some entities might be providing their registration number, some entities might be providing their GST number. So there are different identification number that can be provided by the entity. Now it is said that rather than taking the different identification number for the different entities, there should be a unique, uniform domestic legal identifier that shall be studied, so that all the entities, rather than providing the PAN number or the GST number or the registration number, rather than providing the different numbers, they provide this uniform domestic legal entity identifier. Okay, and there is a system that can directly check that this domestic legal entity identifier is related to which entity, so that the fraud cases can be reduced. Okay, currently there exist a lot of different identifiers in India, each with their own specific purpose and features, and sometimes it becomes hard to check that the number is correct or not, because there are different platforms to check the number. Okay, so the DLEI, that is domestic legal entity identifier, if found feasible, they could be new or selected from the existing identifiers. Okay. So right now, the non-individuals, the entities, the businesses, for identifying them, there can be different numbers that can be used. The PAN number, the GST number, the registration number and such, the legal numbers and such. So right now it has been said that we need to have a uniform domestic legal entity identifier, so that the different entities do not provide different numbers, different identification forms. Okay, currently there are various identifiers in India, so we can choose from the current identifiers. It can be said that all the entities, they have to provide their PAN number if they are doing the transaction, or all the entities, they have to provide their registration number if they are doing some kind of transaction. Okay, so out of all these different identifiers, one identifier can be selected, or a new identifier can be created for the domestic legal entity identifier. That is the idea. Okay, any confusion, anyone? Now, under the core theme of the Payment Vision 2008, these are the 7 areas under which the 15 initiatives that have been brought. So to promote inclusivity and resilience, a framework for interoperability in trades is also proposed. This we had discussed in the previous session, in the original session of Payment Vision 2028. Now to enhance safety in the digital payment, enabling or disabling transactions across the digital payment mode, the switch on and off facility, a shared responsibility framework with both the customer's bank and beneficiary bank, as well as the cyber key risk indicator. Now a question can come for the 10 marks. A descriptive question can come for the 10 marks, that to enhance the safety in the digital payments under the Payment Vision 2028, what are the specific initiatives? So these are the multiple specific initiatives under the safety. Or the question can be that to promote the inclusivity and resilience and to enhance the safety, what are the specific initiatives that were mentioned in the Payment Vision 2028. So you have to remember that under the inclusivity and resilience, the threats, framework for interoperability in threats, we had discussed this yesterday in the previous session, that in the threats there are 3 areas for development: the interoperability in the threats, the recourse, the factoring with the recourse, as well as there was the threats that should be provided for the export MSMEs also, okay, or the trade receivables discounting that should be provided for the export MSMEs also. So these were the 3 areas of improvement under the threats: interoperability, factoring with recourse, and export MSMEs discounting system for the export MSMEs also. Then to enhance safety, there is the shared responsibility framework, there is the switch on switch off facility, the cyber key risk indicators for the non-bank payment system operators, review of the design and security of the checks. Regarding cross-border payments, there is the review and the report that was also mentioned for promoting ease of doing business and convenience. It was said that the cross-border payment authorization, or the authorized dealers, the authorized persons, rather than taking the separate authorization and license under the 2 acts, there will be a single window platform, okay. It was also said that the small payment system providers will be recognized for the ease of doing business, okay. There will be PASS, that is the payment switching service, that shall be examined to provide flexibility to switch the accounts. To provide the fillip to research, to boost to the research pertaining to digital payments, dedicated research and training capacity will be developed. To promote systemic stability and integrity, entities deemed to be playing a critical role in facilitating digital payment shall be brought under the regulatory fold, that we have discussed that these entities, they should also be brought under the regulatory fold. This is proposed, okay. Next is that DLEI, to promote systemic stability and integrity, the DLEI is also proposed. Innovation in card payment space shall be encouraged so that there is interoperability in the card payment ecosystem and introduction of the electronic checks. So these are the 7 areas under which the specific initiatives have been brought. The question can be on particular areas also, that write a like there can be a question that describe the specific initiatives under the safety and cross-border payments domain, okay. So such a question can come, that's why you have to keep this in mind, okay. Now this is a objective question that you have to answer. See, from the Payment Vision 2028, just focus on the PPTs. I have given you 2 PPTs. I have taken 2 sessions. You have to remember the broad idea. You do not have to remember each and every line, but you have to remember the broad ideas, okay, that under the safety features, what are the actions that have been taken. If you remember about the cyber keys risk indicators framework, you can easily write that, okay, there are the non-bank payment system operators for which there should be the monitoring on the cyber security and the comparison of the cyber security facilities that the different entities have. So just focus on the keywords, just focus on the key ideas, okay. Chalo. Now coming to this question, with reference to the initiatives proposed by the Reserve Bank of India under its payment vision, which of the given above are correct, okay. So this is the question that you have to answer. Try to answer this question. Now coming to the descriptive question, Payment Vision 2028 is anchored in the dual imperative of strengthening the existing payment infrastructure while simultaneously pioneering the futures of payments. Discuss the major initiatives proposed by the Payment Vision 2028 to achieve these objectives. So this is a question for 10 marks. Okay, you have to write 400 words. So even if you write the 5 to 6 initiatives, that will be good for the question. Okay, now this kind of question is more likely to come rather than specific areas. You have to remember all the broad initiatives. Okay, so this is the idea. It's below. Okay, so now starting with the first notification of the Reserve Bank of India, the first news article that we are going to discuss, that is the Master Direction of the Reserve Bank of India, Unique Identifiers in Financial Markets Directions 2026. Okay, so first of all, identifiers such as legal entity identifier and unique transaction identifier, they are key global standards that are accepted by the regulators of the different countries. So the regulators of the different countries, they accept the LEI, they accept the UTI. Now let's say that the businesses, they have the PAN number, right? That is the unique number for the businesses. Like we have the Aadhaar number. Aadhaar number is the unique number for us individuals to be identified as the citizen of India. Similarly, the PAN, it is the unique number, or it is the unique code for the businesses or for the individuals also. So why there is the need for the legal entity identifier to identify the entities? Why there is such a need for the legal entity identifier when we already have PAN to identify the businesses? See, the problem is that the PAN is only recognized in India. The PAN is not recognized all over the world. The other countries, they do not recognize PAN. They do not have the complete understanding of the PAN. But the LEI, that is the legal entity identifier that identifies the entities, this legal entity identifier, it is a global standard. It is a global standard that is allowed and that is accepted by regulators around the world. So I hope you understand that why there is the need for the legal entity identifier for the entities. So that if the transactions are happening at the international level, at the global level also, the entities can easily be recognized and the different entities can be segregated. Okay, so that is the idea. So like you and me, we have the Aadhaar number to showcase that, okay, we are the citizen of India and this is the identity number that we have. Similarly, the businesses also have the identifiers that identify the entities, such as the PAN number, but it is only recognized in India. And that's why the legal entity identifier is accepted for the entities. That legal entity identifier is accepted all over the world by different regulators. Okay, and so the data matches with the different regulators if the international transaction is happening, or if the transaction is happening in a country also, so the entities can uniquely be identified. So identifiers are basically the identity numbers, such as the legal entity identifier that identify the entities that are engaged in the financial transactions. Unique transaction identifier, it identifies a particular transaction. Okay, and which particular transaction, that also we will discuss. These are the key global standards for promoting transparency in the financial markets, and these are usually used for the financial transactions. Okay, now Reserve Bank has mandated the implementation of the legal entity identifier and unique transaction identifier for transactions in the financial markets regulated by it. That means the financial markets that are regulated by the Reserve Bank of India, it is mandatory to use the LEI and to use the UTI, okay, to use the legal entity identifiers and the unique transaction identifier. So all the entities, all the banks, NBFCs, and the other financial entities which are engaged in the financial transactions in the financial markets regulated by the Reserve Bank of India, they have to show the legal entity identifier that identify these entities. Okay, now which financial markets are regulated by the Reserve Bank of India? Anyone can tell me? Which financial markets are regulated by the Reserve Bank of India? The money market, the short-term market, where the interbank lending is happening. Okay, the institutions or the banks, they are lending to each other. The other financial institutions, they are lending to each other. Okay, so where the lending is happening in the call money, the notice money, they come under the money market. Call money is the overnight lending and borrowing between the banks, between the financial institutions. Notice money is the borrowing and lending between the banks, between the financial institutions for a period up to 14 days. Okay, so this is the idea that the money market, the short-term borrowing, lending, this kind of market between the financial institutions, this is the money market. The short-term market, the short-term instruments, they come under the Reserve Bank of India. This is the financial market regulated by the RBI. Another financial market regulated by RBI is the foreign exchange market. Foreign exchange market or the foreign exchange transactions, as well as the government securities market, the T-bills, the dated government securities. So this market is also regulated by RBI. Okay. So this is the idea that there are certain financial markets that are regulated by the Reserve Bank of India, such as the money market, where the short-term transactions, short-term borrowing, lending is happening. There is also the foreign exchange market, the foreign exchange transactions, and there is also the government securities market. So these are the financial markets that are regulated by the Reserve Bank of India. And for all the financial transactions between the different financial institutions, the financial transactions that are happening, they need to be identified clearly and uniquely, and thus the financial institutions which are engaged in the financial transactions in the financial market regulated by RBI, so these financial institutions, they need to provide their legal entity identifier to easily identify the different entities engaged in the financial transaction, engaged in the financial market. This you will understand better in the coming slides. So basically RBI has mandated the implementation of legal entity identifier and unique transaction identifier for transactions in the financial market regulated by RBI. The directions for the implementation of these unique identifiers were issued through various different circulars, but now the RBI has consolidated and issued in this master action the unique identifiers. So now first we will discuss the section A, that is related to the legal entity identifier. The legal entity identifier, it identifies the entities uniquely. So there are unique codes that are given to the entities that can uniquely identify the entities. Okay. So LEI code, it is a 20-character unique identity code assigned to entities who are parties to a financial transaction. Okay. So legal entity identifier, this is the identifier that is assigned to the entities. How many characters does this code has? This code has 20 characters, 20 alphanumeric. Okay. So LEI code is a 20-character unique identity code assigned to entities who are parties to the financial transaction. And LEI code, this has been conceived of as a key measure to improve the quality and accuracy of financial data system for better risk management all over the world, because it is very easy now to identify the entities which are doing the transactions in a country or in abroad. So this number, this LEI, it is recognized at the global level, and thus it is easily identifiable that which entities are doing what kind of transactions. Okay, and which entities are related to which other entities. Let's see that. So every LEI, every legal entity identifier is a unique and can represent only one entity. Each entity's LEI code connects to verified reference information from authoritative local sources. So through the local sources, the information can be taken about an entity that is engaged in the financial transaction. Okay, let's say a foreign institution, a foreign entity, it is investing in our country, it is opening a subsidiary in our country. So if we want to get the information about this foreign entity, we just need to get its LEI code, and easily we can get the information from the local sources, including the entity's ownership structure, that okay, this financial entity which is opening a subsidiary in our country, what is the ownership structure of this financial entity, which other entity owns this financial entity. Okay, this XYZ, this entity from Pakistan, or this entity from the not so trustworthy sources, if those countries are somehow having the ownership of this financial institution, of this financial entity, then we can stop the subsidiary from opening its, we can stop this entity from opening a subsidiary in our country. So through this legal entity identifier code, we can get the information about the entity from the local source, as well as we can know the ownership structure which is accessible in the global LEI index. Okay, so this is the idea that we can easily know that okay, this foreign entity, this financial entity, what is the ownership structure, which other entity owns this financial entity, and it is opening its subsidiary in India, or it is asking for opening its subsidiary in India. So through the legal entity identifier, the international data becomes accessible about the entities that are doing the financial transaction. Okay, so in this way, the LEI is the answer to the question that who is who and who owns whom. Okay, so this is the idea. Yes, correct, Akshu. So now coming to the Next part, the LEI code shall be applicable to all the over-the-counter transactions. Over-the-counter transactions means these are the transactions that are not happening through the stock exchanges, because stock exchanges, they come under the regulation of the Securities and Exchange Board of India. That means the stock exchanges, the NSE, BSE, they are under the SEBI regulation. While here we are talking about the RBI. So all the over-the-counter transactions that are not happening through the stock exchanges. See, in the money market, let's say X bank wants to borrow money and the Y bank is lending the money. And this is the overnight transaction that is happening. Is there any exchange that is involved? No. Is there any other party that is involved? Not necessary. Okay. There can be an intermediary or there might not be. So money market transactions, these kind of transactions where the financial institutions are lending and borrowing for the overnight or for the notice money, that is for a period up to 14 days or for a short period of time, and let's say, so the money market transactions, all these transactions, they are happening over the counter. That means they are not happening in the stock exchanges, because stock exchanges are regulated by SEBI, while the money market, government securities market, foreign exchange instruments, these are regulated by RBI. Okay, the government securities also, let's say X bank has government securities worth 100 crores. It is selling this in the secondary market. It is selling it to the Y bank. Okay, and Y bank is paying to the X bank. So at the personal level, the parties are doing the transaction, or through an intermediary or through the electronic platform, the parties are doing the transaction. There is no involvement of the stock exchanges. So these are the over-the-counter transactions, okay, where the stock exchanges are not involved, where the National Stock Exchange, Bombay Stock Exchange is not involved. So LEI code shall be applicable to all the over-the-counter transactions undertaken by entities other than individuals in the markets, because the LEI code is for the entities. Okay. In the market for the government securities, if the transaction is happening, in the money market instruments, if the transaction is happening, there is the requirement for the entities to provide their LEI code to be able to undertake such kind of transactions. Okay, as well as in the foreign exchange instruments also, if the entities are involved, if the transaction is happening, if the over-the-counter transaction is happening in the foreign exchange instruments, then also the entities have to provide their LEI code for reporting such transactions, and for recording such transactions, the LEI code has to be provided. And in the derivatives covered under section 45U of the RBI Act of 1934. So these are the derivatives that comes under the RBI Act of 1934. So derivative means an instrument to be settled at a future date whose value is derived from some underlying asset. That can be interest rate, foreign exchange rate, credit rating, credit index, price of the securities, combination of more than these, the foreign currency swaps, the foreign currency options, the foreign currency rupee options, and such other instruments as may be specified by the Reserve Bank from time to time. You do not have to remember all these derivatives. What are derivatives? They basically derive their value from some underlying asset. So let's say I am signing a contract that in the future on 30th December, I want to purchase $100,000 at $1 equal to 100 rupees. Okay, so this is a derivative. This is a contract. This is a financial contract which is deriving its value from some underlying asset, that is dollars. Okay, and there is a future date that is determined. So different kind of derivative contracts can happen, and they can have the underlying asset as interest rate, credit rating, credit index, price of the securities, dollars, the foreign currency, and such. So these are the derivatives. If the derivatives, these transactions are happening in the over-the-counter market, that means these transactions are not on the exchanges. So even for these financial transactions, the financial institutions that are involved, the financial entities or the entities that are involved, they need to provide the LEI code. Okay, so this is the idea. So for all the financial transactions that are happening in the over-the-counter, so for all the over-the-counter transactions which are happening in the financial market regulated by the Reserve Bank of India, the entities that are involved in these transactions, they have to provide their LEI code. Okay, the entities, they have to provide their LEI code. So the LEI code shall be applicable. The entities, they have to provide their LEI code to all the OTC transactions, over the counter transactions undertaken by entities other than individuals in the markets governed by the Reserve Bank of India or regulated by the RBI. That is the government securities, money market transactions, the foreign exchange instruments, derivatives. For the non-derivative foreign exchange transactions, okay, there is no need to provide the LEI code until and unless the amount is equivalent to or exceeding the $1 million. Okay. So basically for the derivative transactions, as well as for the government securities, for the money market transactions, there is the compulsory LEI code that the entities have to provide, okay. But for users or client that are taking non-derivative foreign exchange transactions, only for the non-derivative foreign exchange transactions, so LEI shall only be applicable for the transactions involving an amount equivalent to or exceeding $1 million. So this is the idea, that for the over-the-counter transactions that are happening under the Reserve Bank of India regulated markets, such as the money market, the foreign exchange market, and for the government securities market, as well as for the derivatives that are under the section of the Reserve Bank of India Act. So for all these transactions, the entities, they need to provide the LEI if they are doing the financial transaction, if they are doing such transactions. Okay. Now for the money market, foreign exchange, for the money market, for the government securities, for the derivatives, the entities have to provide the LEI without any minimum limit also. For the foreign exchange non-derivative transactions, the LEI shall only be applicable for the transactions involving amount equivalent to or more than $1 million. This is the idea. Any confusion? So LEI ensures that each entity involved in a transaction is clearly and uniquely identified, avoiding confusion due to similar names or structures. Okay, so LEI uniquely identifies the entities which are involved in the transaction. Now, framework for the implementation of LEI: all participants, resident and non-resident, undertaking transactions falling within the scope of these directions, they shall obtain the LEI code from the local operating unit which is recognized by the Global Legal Entity Identifier Foundation. In the case of an LOU, in the case of the local operating unit in India, the LOU shall be an entity recognized by the Reserve Bank of India as an issuer of the LEI under the Payment and Settlement System Act of 2007. So basically the LOU, the local operating unit which provides the LEI, it should be recognized by the Global Legal Entity Identifier Foundation, and in India, if there is the LOU, that should be recognized by the RBI also. Okay, that is the idea. Now, non-residents that are not legal entities in their country of incorporation. So the non-residents which are not legal entities, which are not entities in their country of incorporation, such as the funds operated by the non-resident parent or management company that are each registered as a foreign portfolio investor. So they are not legal entities, they are not entities, they are not organization, they are not institution. They are just some fund. They are just some foreign portfolio investor. So they may use LEI code of the parent or management company. So basically, if there is a fund or the foreign portfolio investor which is not an entity, but they are involved in the financial transactions, if they are involved in the financial transactions under the financial market under the Reserve Bank of India, so they can use the LEI code of the parent company or the management company. So that is the idea. So the non-residents that are not legal entities themselves in their country of incorporation, but they are doing some transaction, financial transaction, they may use the LEI code of the parent or management company. Okay. Now, entities involved in or responsible for executing transactions, reporting or for repository functions in the markets regulated by the Reserve Bank, they shall capture the LEI code of the transacting participants in their systems. So whichever entity that is responsible for reporting or for depository functions or for executing transactions, they have to take the LEI code for the entities that are doing the financial transaction in the financial market regulated by RBI. Okay. Now, entities without an LEI code shall not be eligible to undertake transactions in the financial markets regulated by the RBI. So basically, that is the idea, that if you do not have the LEI code, you are not eligible to undertake transactions in the financial market regulated by RBI if you are an entity. Entities shall ensure that their LEI code is considered current under the rules of the global LEI system and has not been lapsed. Okay, so here what is the key idea that you have to remember, that for the money market transactions, for the foreign exchange transactions, for the government securities transaction, and for the derivatives, there is the LEI code that has to be provided for the over the counter transactions under the RBI financial market. Okay, now for which kind of LEI transactions there is the limit, or for which kind of LEI transactions the LEI code, sorry, for which kind of financial transactions the LEI code will not be required. So if the financial code is less than 1 million, then the LEI code will not be required for the non-derivative foreign exchange transactions. Okay, so if the foreign transaction is happening of the non-derivative foreign exchange transaction, so if for non-derivative foreign exchange transaction is happening of less than $1 million, then the LEI code is not required, but the LEI code shall be applicable only for the transactions involving an amount equivalent to or more than 1 million if the users or clients are undertaking non-derivative foreign exchange transaction. This is the limit, very important. Now coming to the unique transaction identifier. So unique transaction identifier is a unique identifier that is assigned to an over-the-counter derivative transaction. So these are the unique transaction identifier that identifies the over-the-counter derivative transaction. So they are only for the derivative transaction. It has been conceived as one of the key data elements identified globally. So unique transaction identifier, they are also identified globally, and they identify the transactions that are happening over the counter derivative market. Okay, so over the counter derivative transactions, for them there is the unique transaction identifier. Okay, so I have taken a detailed session on the unique transaction identifier that you can see. I will not detail all the points again because that is not required. The same points have been discussed in a separate session. Okay, now section A, that is regarding LEI, that shall come into effect from immediate basis, while section B, that is on the unique transaction identifier, that will come into effect from January 1, 2027. LEI uniquely identifies the counterparties, the entities which are part of the transaction. So the LEI, it identifies the entities. It identifies the entities uniquely, while the UTI, it serves as a single unique reference number for the transaction that is happening, especially the over-the-counter derivative transaction. Okay. Coming to the last article. The net open position for the INR of the authorized dealers. First of all, authorized dealers, they are the entities, they are the dealers that are authorized by the Reserve Bank of India to buy or sell the foreign currency. Okay, so these are the authorized dealers. They are authorized by the Reserve Bank of India to buy or sell the foreign currency. So as per the Master Action on the Risk Management and Interbank Dealings of 2016, the Reserve Bank may prescribe, it was stated that the RBI may prescribe limits for open position involving rupee for exchange rate management depending on market conditions. Okay, so it was said that for the open position in the INR, in the Indian rupees, there can be the limits that can be introduced by the Reserve Bank of India for the authorized dealer. Now we know that authorized dealers, they are the entities that are authorized by the Reserve Bank of India to buy or sell the foreign currency. But what is this open position in the INR? And what is this limit? So basically, under this master action, it was said that RBI has the power to prescribe limits for the open position in the INR. Okay, now what is this? Why the limit is there? So RBI, first of all, see what happens that the authorized dealer, let's say the exporter, they are exporting their product. What will they get? Let's say exporter, they are exporting their product to US, UK, Germany, Italy, Russia. So exporters of India, if they are exporting their product, what will they get? What will they get? The foreign currency they will get dollars basically. They will get dollars. So now exporters, they are getting dollars because for most of the international transactions, for most of the export and import, we use dollars. Okay. So exporters of India, they are getting dollars for the export. Now exporters of India, what they will do of dollars? Are they exporters of India, the companies of India, can they use dollars in the day-to-day functioning? If they have the units in India, manufacturing units, can we use dollars in India for the transaction? No, we use rupees. We use rupees. So exporters basically they have to sell their dollars to the authorized dealer. Authorized dealer will provide the rupees. So what is happening? The US dollars have been purchased from the exporters by the bank. That is the authorized dealer, let's say. Okay, so bank is the authorized dealer that has purchased the US dollars from the exporters. Now let's say the importers, they require the dollars to purchase some machine. So importers of India, how are they going to get the dollars? The Tata Motors or the Reliance Industries, if they want to import some machine from US or from UK, how are they going to get the dollars? The importers, they will go to the authorized dealer to buy dollars. Okay, so basically importers will give the rupees and the authorized dealer will give the dollars to the importers so that they can buy the they can buy the machine. I hope this is clear that the authorized dealers, they are allowed to buy and sell the foreign currency to the people of the country. So US dollars purchased from exporters, US dollars are also received from the foreign portfolio investors. Let's say the foreign portfolio investors, they want to invest in the Reliance shares, they want to invest in the shares or the bonds or the financial instruments of the Reliance Industries or Tata Motors or CDSL. So foreign portfolio investors basically want to invest in the financial market of our country that is regulated by SEBI. So foreign portfolio investors, they want to invest in the capital market basically of India. So they are bringing their dollars. They cannot invest their dollars directly in India. So what they will do, they will provide these dollars to the authorized dealers and they will purchase the rupees that they can invest in the capital markets of our country. So the foreign portfolio investors, they also provide the dollars to the authorized dealer. So basically, how the authorized dealers are getting the dollars? By purchasing it from the exporters and receiving it from the foreign portfolio investors. Now, where the authorized dealers will use these dollars? The authorized dealers will sell these dollars to the importers basically, okay, or to the investors that want to invest in the other countries, or to the people that want to travel to the other countries and such. So this is the idea that how the authorized dealers are getting the dollars. By from the exporters, they are getting the dollars as well as from foreign portfolio investors, where they are providing the dollars usually to the importers, to the investors that are investing outside. They are the sale of the dollars is happening. Okay. Now, long position is basically when the authorized dealer is getting the dollars. Short position is basically when the authorized dealer is selling the dollars. Got it? Now, what is happening here? You can see that the bank, the authorized dealer has got how many dollars? Anyone can tell me? The authorized dealer has got how many dollars? Authorized dealer has got $750 million. In a single day we are talking, in one day. In one day, from the exporters, from the foreign portfolio investors, the bank has got, the authorized dealer has got $750 million. While in this one day, how much sale of the dollars has happened by the authorized dealer? The bank has only sold $300 million. So what is the net open position? What is the net open position in the terms of dollars? In the terms of dollars, the net open position of the bank is, of the authorized dealer, is $450 million. $450 million. Now what is happening? That this $450 million is the open position. While it has been said that RBI has now decided that the authorized dealers, they shall ensure that their net open position in the INR, in the Indian rupees terms, in the onshore, that is in the country, in the onshore deliverable market, shall be maintained within US dollar 100 million. So can the banks keep $450 million? No, the banks can only keep up to $100 million. Okay, so how much extra dollars the bank has? $350 million the bank has extra. Okay, the authorized dealer has $350 million extra. So the banks sell, let's say, $360 million in the interbank market. So the one bank is selling to the other banks, because this bank, this authorized dealer has extra dollars than what it can keep. Okay, the bank authorized dealer has extra dollars, then what is the limit? So the bank is selling the extra dollars to the other banks, to the other multiple banks. The new calculation is that the bank has sold $360 million out of the $450 million. So now the bank has left $90 million, which is under the limit of the $100 million. Now, why the RBI has set this limit, that we will understand. But before that, the RBI has now decided that the authorized dealers that have the authority to buy or sell the foreign currency, they shall ensure that their net open position in the INR terms in the onshore deliverable market, in the country's deliverable market, in the India's deliverable market shall be maintained within $100 million at the end of each business day. So after all the transactions, at the end of each business day, they have to see that their net open position should not exceed $100 million. So authorized dealers shall ensure compliance with the above at the earliest, but not later than April 10, 2026. Yes. So net open position is nothing else. It is the difference between the long and the short position. Okay. How much the authorized dealer has got minus how much the authorized dealer has sold. So net open position is basically the open position, how much dollars the bank or the authorized dealer has. Why is this limit? Why the banks cannot keep $450 million with themselves? Think about it, that right now $1 is equal to 90 rupees. Now the banks, they are getting the dollars. They are getting, let's say, $400 million, or they are getting $700 million. Now tomorrow the banks know, the banks are doing the speculative activity, the banks are doing the speculation that seeing the global condition, the dollars is going to go up to 95 rupees. So what the banks can do, the banks can only sell $100 million or $200 million, and banks will keep the rest of the $500 million with itself. So that the bank is keep buying the dollars at this price, $1 equal to 90 rupees. The bank is keeping the dollars with itself so that the bank can sell it tomorrow when the dollars price increase. So bank hold, if the bank keep on holding the dollars, that is reducing the supply of dollars in the market. If the bank holds the dollars rather than supplying it, rather than providing it in the market, the bank is holding the dollars for the speculations, for the speculative activity that tomorrow when the dollars price go up, then the bank want to sell. Now RBI is saying that if you are not supplying the dollars in the market, that is reducing the supply. With lesser supply of dollars, the price of dollars is increasing, the value of dollars is increasing. Think about it. Gold has limited supply. That's why the gold prices are increasing. So RBI is saying that supply the dollars. Supply your extra dollars. You can only keep $100 million by the end of each business day. You can only keep this much for your activities, for your continuous activities, so that you have some buffer money. But the rest amount, the $400 million, supply it immediately in the market so that it increases the supply of dollars. With the higher supply of dollars, if something is in excess, if there is more supply of dollars, the price of dollars will reduce against the rupees. That means the value of dollars will reduce against the rupees. So right now what is happening, that there is too much depreciation of rupees. Rupees is losing its value against the dollars, and dollar is becoming more powerful. It is appreciating against rupees. So rupee is depreciating against dollars and dollar is appreciating against rupees. This is happening, rupees depreciating very fast. So RBI has said that if the banks keep on holding the dollars for the speculative activity so that the price of dollars increase and the banks sell at the higher rate, so this is the speculative activity that the authorized dealers are doing. That should not be happening because it is further leading to depreciation of rupees. If the banks keep on holding the dollars, they are not supplying it in the market, so there is less supply of dollars, the price of dollars will increase, the value of dollars will further increase against the rupees. So that will further depreciate the rupees because the dollar is becoming more stronger, its prices value is further increasing. So now the RBI is saying that supply your excess dollars in the market so that there is higher supply of dollars in the market. Higher supply means less price of dollars. Less price of dollars means less value of dollars against the rupees. So rupee will stop depreciating, or at least the depreciation will reduce. That is the idea. Any confusion? So if the banks keep on holding $450 million, this is the condition of one authorized dealer. There are number of authorized dealers. So they are holding billions of dollars. So if they keep on holding billions of dollars and they are not supplying it in the market, that means the supply of dollars will reduce in the market and the price of dollars will increase. Okay, this RBI do not want. That's why to maintain the foreign exchange condition, to maintain the value of rupees, the RBI has said that the banks can only hold $100 million at the end of each business day. The excess dollars the bank will have to sell in the market, so that there is more supply of dollars, the price of dollars reduce, and the rupees stop depreciating. Got it? No confusion? Nice. Even if the bank has less dollars they are holding, they should maintain the net open position of $100 million. That this much the banks should maintain. Okay. So this is the idea that the RBI has now decided that authorized dealers shall ensure that their net open position in the INR terms in the onshore deliverable market shall be maintained within $100 million. They cannot hold more than this at the end of each business day, and they have to ensure compliance no later than April 10, 2026. So recently the depreciation that is happening of rupees, to stop this kind of depreciation or to reduce the depreciation of rupees, the RBI has said that the banks have to sell their excess dollars, so that they do not engage in the speculative activity. They do not keep on holding the dollars so that tomorrow they can gain profit. Chalo. Now this is the first question. I hope you will be easily able to answer this question. With the reference to the LEI framework under the master direction, consider the following statements. These are the 4 statements, and which of the above statements is or are correct, that you have to answer. I hope you will be able to answer this question easily. Coming to the next question, that is regarding your UTI. So UTI we have discussed in the previous session. So I hope you have seen that session. If you have not, then go see that session, then you will be able to answer this question. So these are the statements for the UTI, for the unique transaction identifier. Which of the above statements is or are correct, that you have to tell. So this is it. Now let's move forward with the first news article that we have to discuss. So the Corporate Laws Amendment Bill 2026. So what has happened, that the Corporate Laws Amendment Bill 2026, this was introduced in Lok Sabha on March 23rd, 2026, and there are a lot of news articles that are going on related to the Corporate Laws Amendment Bill 2026, because there was a big discussion in the Lok Sabha regarding this bill. Okay, so now the Corporate Law Amendment Bill 2026, it was introduced in Lok Sabha on March 23rd, and it was decided that this bill will be sent to the Joint Parliamentary Committee. Okay, so on the same day in the Lok Sabha, it was decided that this bill will be sent to the Joint Parliamentary Committee, which will give the detailed analysis regarding this bill. Okay, why this particular bill has been sent to the Joint Parliamentary Committee? Because there were a lot of discussions that were happening around this bill. There were a lot of objections that were regarding this bill. Okay, but the Finance Minister of our country, that is Srimati Nirmala Sitharaman, said that already 2 years have been taken to bring this amendment bill, and this amendment bill has been brought with a detailed discussion with the different market players. Okay, so basically the government wants to bring this bill, but there were a lot of objections from the opposing party, and that's why this bill has been sent to the Joint Parliamentary Committee. Okay, that will have to provide its detailed analysis on the bill soon. So before the examination, if the detailed analysis has been released, if the recommendations are being released and the bill passes, then this will become very important for your phase 2. Right now, this is more important from the phase 1 perspective. Okay, so the Corporate Law Amendment Bill 2026 was introduced in Lok Sabha on March 23, 2026. Now, the Corporate Law Amendment Bill 2026, it seeks to amend the Companies Act 2013 and the Limited Liability Partnership Act 2008. Okay, so the Corporate Laws Amendment Bill 2026, this is a bill that was presented, that was introduced in Lok Sabha on March 23rd, and now it has been sent to the Joint Parliamentary Committee, which will soon provide its detailed analysis. Okay, that's why this becomes important, because the Joint Parliamentary Committee is involved, that is going to provide its detailed analysis in the monsoon session, that is soon. So this is the idea, that the Corporate Law Amendment Bill 2026, it amends the Limited Liability Partnership Act of 2008 and the Companies Act of 2013. Now let's get started with the key amendments under the bill. First, we are going to discuss the key amendments for the Companies Act 2013. Okay, so see, the biggest objection that has been presented is against this particular part, that is the corporate social responsibility. So the bill wants to change a certain criteria of the corporate social responsibility, but there were a lot of objections from the opposing party. So now what is this corporate social responsibility? So the corporates, the companies, they basically have the responsibility to provide a certain percentage of their average net profit for the social benefit. Okay, so the corporates, the companies, they have the responsibility to provide certain percentage of their net profit for the social benefit. So corporate social responsibility. So under the Companies Act 2013, the companies meeting either of the following criterias, thresholds, they are required to contribute at least 2% of their average net profit in the last 3 years towards the corporate social responsibility policy. So basically, the companies that are meeting any of the threshold, these companies, they have to provide 2% of their average net profit that they have earned in the last 3 years. So 2% of that they have to provide for their corporate social responsibility. So if the company has the net worth of rupees 500 crores or more, if the company has the turnover of rupees 1000 crore or more, or if the company has the net profit of rupees 5 crore or more in the immediately preceding financial year, so if any of this criteria is being followed by a company, then the company has to provide certain percentage, that is 2% of their average net profit for the corporate social responsibility policy. Okay, now what is the change that is proposed by the bill? So the key amendment under the bill is that the bill changes the net profit threshold to rupees 10 crore or such other sum that may be prescribed by the government. Okay, so this is the particular criteria that has been changed, that rather than net profit of rupees 5 crore or more in the immediately preceding financial year, the new criteria will be the net profit of rupees 10 crore or more or such other sum as may be prescribed by the government. So there is also flexibility that is provided for the government to change this criteria further. Now there was the major discussion that happened around this point, that if the net profit threshold is changed, so basically the government is trying to remove this CSR. So the government or the finance minister Srimati Nirmala Sitharaman clarified that we are only changing one of the criteria, the other criterias have not been changed. Okay, so this criteria is particularly being changed to help the small companies. Because let's say that the small company, it does not have the net worth of rupees 500 crore or more. The turnover is also not 1000 crore, but the small company is following this particular criteria of net profit of rupees 5 crore or more in the immediately preceding financial year. So it might be a small company and we are pressurizing the small company to follow the CSR policy, to follow the corporate social responsibility policy. So the government said, the finance minister Srimati Nirmala Sitharaman said that this particular criteria is being changed, okay, to help the small companies out. So this is the idea. Now coming to the next key amendment. So here in the first amendment, remember that the net profit threshold has been proposed to be changed to 10 crore or more or such other sum as prescribed by the government. Okay, next is the scheme of merger or amalgamation. So the act specifies, the Companies Act 2013, it specifies approval requirements for merger or amalgamation of certain companies, such as between two or more small companies. So if there is a merger or amalgamation that is happening between two or more small companies, or let's say there is merger or amalgamation that is happening between a holding company and its wholly owned subsidiary company, in this case there is certain approval that is required. So in case of merger and amalgamation, there are certain approvals that are required. What are the approvals? So a scheme of merger or amalgamation must be approved by respective shareholders holding at least 90% of the total shares. So this was the criteria before. Now the bill that is the Corporate Laws Amendment Bill, it modifies or it proposes to change this threshold to 75% of the total present members and voting members. So basically what is happening, that before it was said that if the merger and amalgamation has to happen between these entities, then this merger or amalgamation must be approved by respective shareholders holding at least 90% of the total shares. Now, the bill proposes to change this threshold of 90% of the total shares to approval of majority of members that are present and that are voting. So, only the members that are present and that are voting, only those shares that are present and that are voting in the meeting for the merger and amalgamation, only those shares will be considered. Okay, so it has been said that the members that are present and voting who hold at least 75% of the shares among the members present and voting. So 75% of the shares of the members that are present and voting. So this is the new criteria that is proposed by the bill. So before, the criteria for the merger and amalgamation approval was that 90% of the total shareholders, they should agree, or 90% of the total shares holding entities, they should agree. But now it has been said that 75% of the shareholders, 75% of the shares among the members present and voting, they should agree. So 75% is the new criteria, and this should be agreed by the members that are present and voting. If the members are not present, they are not voting, then their shares will not be counted in this threshold. Okay, so that is the idea. Next is the bill also reduces the threshold of approval from the creditors. So let's say that multiple entities have given credit to a particular small company that is under the merger and amalgamation policy, or that is under the scheme of the merger and amalgamation. So multiple creditors have given the credit to this small company. Now this small company wants to do amalgamation with another small company. Okay, so before it was said that 90% of the credit value that has been given, so those creditors, they have to agree for this amalgamation or merger that to happen. Now it has been said that this threshold has been reduced from 90% to 75%. Okay, that is the idea. So for the scheme of merger or amalgamation, if two or more small companies, they want to do the merger or amalgamation, or let's say a holding company and its wholly owned subsidiaries, they want to have the merger or amalgamation, there are certain approvals that are required. Before, it was 90% of the total shares that are held by the shareholders, they should agree, but it has been proposed to change to 75% of the shares of the members that are present and voting. Okay, before 90% of the credit value holding creditors, they should agree, but now it has been reduced to 75% as per the proposal under the bill. Any confusion? Anyone? Next is small companies. See, the small companies criteria is also proposed to be changed. Okay, so under the Companies Act 2013, a small company is a company with paid up share capital not exceeding rupees 50 lakh or higher prescribed amount by the government, but higher prescribed amount, it should not exceed rupees 10 crore. So basically, the small company is a company with the criteria, the small company is the company that is with the criteria that its paid up share capital, the share capital not exceeding rupees 50 lakh. But if the government wants for the class of companies, for a particular class of companies, for a particular segment of companies, the government can also prescribe the higher amount, but that should not exceed 10 crore. Okay, so basically for the small company, paid up share capital not exceeding 50 lakh or higher prescribed amount that should not exceed rupees 10 crore, and turnover that should not exceed, the turnover, it should not exceed rupees 2 crore or higher prescribed amount by the government can prescribe a higher amount for a particular class of companies, but it should not exceed rupees 100 crore. That means even the highest turnover, it should not exceed 100 crores if the company has to be classified as a small company. Now the bill is increasing the upper limit for both the criterias from 10 crore to 20 crore for the paid up share capital, and from 100 crore to 200 crore for the turnover. Okay, so this is the idea that the lower limits, they are still the same, that the paid up share capital should not exceed 50 lakhs and the turnover should not exceed 2 crore. But if the government wants to prescribe the higher amount, the government can prescribe the higher amount, but it should not exceed 10 crore for the paid up share capital, it should not exceed 100 crore for the turnover. But these upper limits are being modified under the bill. They are proposed to be modified from 10 crore to 20 crore and from 100 crore to 200 crore. Okay, so these are the major changes that the government is trying to bring. So the small company means a company other than a public company that is having the paid up share capital of which does not exceed 50 lakh rupees or a higher or such higher amount as may be prescribed by the government, which shall be not more than 10 crore rupees, which shall not exceed 10 crore, and the turnover should not exceed 2 crore. Okay, does not exceed 2 crore, or such higher amount as may be prescribed, which shall not be more than 100 crore. But these upper limits are proposed to be changed. Now coming to the next point, that is compliances. So the bill, it seeks to simplify certain compliances. A company may hold its annual general meeting physically or through video conferencing or other audio-visual means, either wholly or partly. That means some members can be present physically while other members might join through the audio visual form or through the video conferencing, or maybe the whole meeting can happen through the video conferences. But every company shall hold its annual journal meeting in physical mode at least once in every 3 years. So once in every 3 years there should be a compulsory physical mode meeting that is there. Okay, so it has been said that the company may hold its annual general meeting physically or through the video conferences, but at least once every 3 years there should be the general meeting that should happen in the physical mode. As well as under the bill, there is also it has been proposed to replace certain affidavits with self-declaration, as well as for certain class of the companies it has been said that if they are following certain prescribed criterias laid down by the government, then they will not have to have the annual auditor and such. Okay, so this is the idea that there are various compliances that are being simplified. Okay, so the bill seeks to simplify certain compliances. Next, buyback shares. Buyback of shares basically means that the company sold its shares in the stock exchanges, but now the company wants to buy back its shares or wants to buy back its securities from the shareholders, from the holders, or from the investors. Okay, so basically buyback under the Companies Act 2013, a company may purchase its own shares or other specified securities. So basically the company is buying back its shares, buying back its different securities. Okay, so it was previously said that the buyback, it must not exceed 25% of the aggregate total paid up capital and free reserves of the company. The bill adds that for the prescribed classes of companies, for the prescribed section of the companies, the buyback may be up to a prescribed percentage. That means this provides the flexibility to the government to increase the limit also, or to change the limit. So this is the idea that before there was a strict limit of buyback that must not exceed 25% of the total paid up capital and the free reserves of the company. But now it has been said that the government has the flexibility to change the limit for the prescribed classes of companies. Buyback may be up to whatever limit the government decides for the set classes of the companies. Okay, next is valuation authority. So the bill designates the Insolvency and Bankruptcy Board of India as the valuation authority. IBBI will be responsible for granting, for providing, or for renewing the certificate of registration and recognition to the valuers. The valuers are the authority. The valuers are the entities that value the asset that is under the liquidation process or under the insolvency process or under the restructuring process. So valuers, they provide the real value of the asset, so that the asset is not overvalued or the asset is not undervalued. Okay, so this is the idea that the IBBI will be responsible for granting or renewing the certificate of registration and recognition to the valuers that have the responsibility to value the asset, to provide the real value of the asset that is under the liquidation, insolvency process or restructuring process. It will make recommendations, the IBBI, it will also make recommendations to the central government on the formulation and laying down of the valuation standards and policies. It will monitor and enforce that the compliance happens to the rules and regulations, to the standards. Now so these were the changes for the Companies Act 2013. These were the proposed amendments for the Companies Act 2013. For the Limited Liability Partnership Act 2008, what is the proposed amendment that we will discuss? Okay, so limited liability partnership basically means that a legal entity that limits the extent of the economic loss to assets invested in an organization. So under the limited liability partnership, you can understand that there are partners that are investing in a company. Limited liability means that partners have limited obligation, the partners have limited liability. That means their liability is only how much they are investing in the company, how much they are investing in the partnership firm, how much they are investing in the firm, their own personal assets will not be obligated if the firm is under the insolvency, or if the firm closes down, if the firm is under stress. The partner's own um, assets will not be affected. So limited liability, that means you have the limited obligation. So limited liability partnership basically means that there are different partners that are present, and they have the limited liability. If they are investing in the company, only their investment is at the loss. If the loss happens to the company, so only their investment is at the loss. Their personal assets will not be affected. That is the limited liability partnership. So this is the legal entity that limits the extent of the economic loss to assets invested in the organization. Okay. Now, what is the amendment under the bill for the limited liability partnership? Conversion of trust into LLP. So bill provides for conversion of specified trust into the limited liability partnership. So this applies to trusts that have been established under the Indian Trust Act 1882 or any other central or state act, and or they are registered by SEBI or IFSC authority and are engaged in prescribed activities. Okay. So this is the idea, that if there is the conversion that needs to happen of the trust into the LLP, so bill provides for the conversion of specified trust into the LLPs. This applies to trusts that have established under the Indian Trust Act 1882. They are registered by SEBI or IFSC authority and they are engaged in prescribed activities as prescribed by the government. Now the bill decriminalizes various procedural defaults. So what used to happen, that before, if there is any procedural default, so there can be the fines that can be imposed, or there can be the imprisonment that can also happen. So these procedural defaults, they were seen as the criminal basis. But now it has been said that the bill decriminalizes various procedural defaults under the Companies Act and the Limited Liability Partnership Act by replacing the criminal provisions with civil penalties. Okay, so that is the idea. So this is it. The additional information is that after moving the Corporate Laws Amendment Bill 2026 in Lok Sabha on Monday, the Corporate and Finance Minister Nirmala Sitharaman proposed to send the bill to a 31-member Joint Parliamentary Committee. 31 members will be in the Joint Parliamentary Committee to enable further scrutiny and detailed analysis of this amendment bill. The Joint Parliamentary Committee will include 21 Lok Sabha MPs and 10 Rajya Sabha MPs. That will be nominated by their respective chairpersons and make its report on the bill on the last day of the first week of the monsoon session later this year. So soon, in a few, July, I think monsoon session will start. So in the first week, last day of the first week, that is before your examination, the detailed analysis will be released by the JPC. Okay, if your exam happens in August, let's say, or if your exam happens by the end of July, the phase 1 happens by the end of July. So in the start of July, you will see the report, the detailed analysis of the Joint Parliamentary Committee. So that's why this is important. Okay, we have understood the basics. Now before the examination, if the report or the detailed analysis is released, you just have to focus on the important points. Okay, so this is the idea, that the bill has been sent to the Joint Parliamentary Committee. Now, coming to the next article that we have to discuss. So, central government in consultation with the Reserve Bank of India hereby notifies that the inflation target for the period beginning 1st April 2026 ending on March 31st 2031, that is for the time period of 5 years, the inflation target will be 4% with the tolerance band of plus minus 2%. Okay, so that means the inflation should not go below 2%, inflation should not go above 6%. So this is the idea, that the inflation target is still 4% with an upper tolerance level of 6%, lower tolerance level of 2%. Now, see, in May 2016, the RBI Act of 1934, it was amended to provide a legal basis for the implementation of flexible inflation targeting framework. Flexible inflation targeting framework basically means that there is an inflation target and there is the band that is provided. That means certain flexibility is provided, that the inflation can go up to 2% or the inflation can go up to 6%. So this is flexibility. The inflation should be around 4%. This is the inflation target. but there is also the tolerance band, there is also certain flexibility that is provided. So the flexible inflation targeting framework was introduced in May 2016. Under Section 45ZA, the central government in consultation with the Reserve Bank of India determines the inflation target in terms of the consumer price index. Okay, so inflation target, we have to control the inflation. Which inflation we have to control? The retail inflation, the headline inflation, the inflation that affects the consumers. So that is the consumer price index inflation. So this target, the inflation target is for CPI, the consumer price index inflation, that is the inflation that affects the consumers. Okay. Now, once in every 5 years, this inflation target is reviewed, and that's why it was reviewed recently. And it has been decided that the inflation target will be 4% within the range of plus minus 2%. Now, remember that accordingly, first on 5th August 2016, the central government notified in the official gazette that for the time period of 2016 to 2021, the inflation target will be 4% plus minus 2%. Then it was reviewed on March 31st, 2021. And it was decided that again we are going to follow the inflation target of 4% within the range of plus minus 2% for the coming 5 years of 2021 to 2026. Now in the second review that happened on March 25th, 2026, that is recently the review has happened, the central government has further decided to keep the inflation target same with its tolerance band for the next 5 years, that is from 2026 to 2031. So you can remember that this is the inflation target that has not changed. Now, Section 45ZB of the RBI Act provides for the constitution of the 6-member Monetary Policy Committee. And the Monetary Policy Committee, I think tomorrow, it's the Monetary Policy Committee statement for April 2026 will be released tomorrow, I think. Okay. So remember that the Monetary Policy Committee constitution, it is as per the Section 45ZB of the RBI Act. So New Zealand was the first country to implement the inflation target, the inflation target in 1990. It has become the most widely adopted monetary policy framework globally now. Okay, so New Zealand was the first country to implement such kind of inflation target in 1990. Now, coming to the next part, that is the central government has notified the following as the factors. Now, Monetary Policy Committee is the committee that has the responsibility to keep the inflation target around 4% within the range of plus minus 2%, that is the 2%, 6%. But what if the inflation target what if the inflation is above 6%? What if the inflation is going below 2%? So what will happen? What will happen if the inflation is going above 6% or the inflation is going below 2%? That means MPC has failed. But there is a separate criteria for the failure of the Reserve Bank of India. There is a separate criteria for failure. So central government has notified the following as the factor that constitute the failure to achieve the inflation target. So the average inflation is if it is more than the upper tolerance level. So basically 4% is the target. This is the lower tolerance level. 6% is the upper tolerance level. So let's say the average inflation is more than 6% of the for any 3 consecutive quarters, that is for 9 consecutive months. If the inflation is above 6%, then we will say that the RBI, the Monetary Policy Committee of the RBI has failed. If the average inflation is less than the 2%, the lower tolerance level, for any 3 consecutive quarters for 9 consecutive months, then we can say the RBI has failed, the Monetary Policy Committee of RBI has failed. So this is the criteria for failure. It's not like that today, this month, the inflation target is above 6%, so RBI has failed. No, the time period is 3 consecutive quarters, or we can say 9 consecutive months. So if the average inflation is more than or lower than the tolerance level for any 3 consecutive quarter or 9 consecutive months, then only it will be said to be failure of the Monetary Policy Committee of the RBI. Got it? So this is the idea. When the bank fails to meet the inflation target, it shall set out in a report. Now, what happens if the Monetary Policy Committee of the RBI has failed to maintain the inflation target, to be around inflation target, or to be within the range? What if the Monetary Policy Committee of the RBI has failed? So where the bank, the RBI, is failing to meet the inflation target, it shall set out in a report to the central government that why it has failed, the reasons for failure to achieve the inflation target, what are the remedial actions that the Monetary Policy Committee or the Reserve Bank of India are taking, okay, as well as in how many months, an estimate of the time period within which the inflation target shall be achieved. So this is the idea. Any confusion, anyone now? So this is it for today. I hope you understood the points. I hope it is clear to you. There is a lot of discussion that is going on in the newspapers regarding the corporate law amendment bill. So now I hope you know that there are certain major changes that have been brought by the government, and opposition is doing its part. It is objecting to certain criterias. That's why this bill has been sent to the JPC, and that is a big thing. And the JPC will soon be releasing its detailed analysis, so that will be important. Okay, but today I have explained you about the corporate law amendment bill. So this is the first question that you have to answer. I hope you will be easily able to answer the question. Consider the following statements regarding amendments to the Companies Act 2013 that has been proposed. Now, which of the above statements is or are correct, that you have to tell. Okay, so I hope you will be easily able to answer this question. The next question is that as per the Corporate Laws Amendment Bill 2026, which of the statements given given below, okay. So now, starting with the Monetary Policy Statement 2026-27 from April 6 to 8th, 2026. So basically, the meeting, the Monetary Policy Committee meeting, it was conducted from April 6th till April 8th, and yesterday, that is yesterday, there was the release of the Monetary Policy Statement and the Governor's Statement. Okay, so the Monetary Policy Statement for the April 2026, this the MPC, the Monetary Policy Committee, consists of the 6 members. Okay, 3 members are from the Reserve Bank of India only, and the other 3 members, they are nominated by the Government of India. Okay, so there are in total 6 members of the Monetary Policy Committee, and the chairperson of the Monetary Policy Committee is Governor of the Reserve Bank of India. Okay, so Governor of RBI is the chairperson of the Monetary Policy Committee, and he is one of the members from the RBI. So this is the idea. So Monetary Policy Committee consists of the 6 members, including the Governor of the Reserve Bank of India. The 3 members are from the Reserve Bank of India, 3 members from the nominated by the Government of India. So the Monetary Policy Committee held its 60th meeting from 6th April till 8th April 2026 under the chairmanship of the Governor of the Reserve Bank of India, who is Sri Sanjay Malhotra. Okay, so this is the idea. And the Monetary Policy Committee, this is the committee of the Reserve Bank of India that takes the decision and runs the monetary policy, basically takes the decision for the monetary policy on how to control the inflation and maintain the price stability while keeping in mind the objective of growth. Okay, so Monetary Policy Committee has the responsibility to decide regarding the monetary policy, to decide the key rates of the monetary policy, to control the inflation, to maintain the price stability in the country while keeping in mind the objective of growth. And remember that the primary objective of monetary policy, the primary objective of the monetary policy is maintaining the price stability while keeping in mind the objective of growth. Okay, so this is the idea. Chalo, now moving forward, we have understood the basic idea of the Monetary Policy Committee. It has 6 members. We have discussed that the Monetary Policy Committee, it decides the key rate for the monetary policy, and the primary objective of the monetary policy is maintaining the price stability while keeping in mind the objective of growth. Okay, now today what we are going to discuss, the monetary policy statement from the April 2026, as well as we are going to discuss the Governor's statement from the April 2026, in which he has informed about the impact of the West Asia conflict on the Indian economy, as well as there is a information that was provided regarding the depreciation of rupees, that the depreciation of rupees is happening rapidly, and we will discuss that what the RBI governor has said. Okay, so now let's move forward. First of all, let's discuss about the monetary policy statement from April 2026. So after a detailed assessment done by the Monetary Policy Committee of the evolving macroeconomic situation, the situation of the whole of the country. So after a detailed assessment of the situation of the country and the financial developments and the outlook, the Monetary Policy Committee voted unanimously to keep the policy repo rate under the liquidity adjustment facility unchanged. So first of all, the liquidity adjustment facility, it consists of the liquidity adjustment facility corridor, the LAF corridor. It consists of the repo rate in the middle, the SDF rate at the bottom, and the MSF rate in the ceiling. So these are the 3 rates under the LAF, under the liquidity adjustment facility: repo rate, SDF rate, and the MSF rate. Okay, Now, repo rate is the rate at which the banks can borrow from the Reserve Bank of India. Okay, the repo rate is the rate at which the banks can borrow from the Reserve Bank of India. The banks have to provide collateral in the form of government securities to the RBI. So, repo rate is the lending rate of the Reserve Bank of India at which the RBI is lending to the banks. Okay, SDF rate is the deposit rate of the Reserve Bank of India. This is the rate at which the RBI is taking the deposits from the banks. Okay, so SDF is the standing deposit facility. This is the rate at which RBI is taking the deposits from the banks and RBI is providing the interest. The SDF rate, that is the interest to the banks. MSF rate is the rate, it is also the lending rate of the Reserve Bank of India, but this is the penal lending rate of the Reserve Bank of India. Once the bank has utilized the limit of borrowing under the repo rate and has taken the borrowing from the RBI till the limit, then the bank requires more money. The bank can take the higher amount of money from the Reserve Bank of India in case the bank is in the liquidity crunch or in case the bank is in the unforeseen contingency situation. So the bank can take higher loans from the RBI under the marginal standing facility. Okay, this is also the penal rate of the Reserve Bank of India. So basically, the LAF corridor, that is the liquidity adjustment facility corridor through which the RBI manages the liquidity in the economy. The repo rate is the rate at which RBI lends to the banks. RBI injects the money, provides the money to the banks. Okay, the SDF rate is the rate at which the RBI takes the deposits. So RBI is taking the deposits from the banks. That means RBI is absorbing the money from the banks. The MSF rate is the penal rate at which the RBI lends in case the bank is in the liquidity crunch or such. Now the repo rate, the SDF rate, what do you think? That the deposit rate should be higher than the lending rate or lower than the lending rate? Think from the perspective of the bank. If you're a customer in the bank, the deposit rate is higher or the lending rate is higher. The bank will give higher interest rate for deposits or the bank will take more interest rate for loans. So remember that always the lending rate is higher than the deposit rate. So the repo rate, that is the lending rate, it is higher than the deposit rate. The MSF rate, it is the penal rate of interest at which the banks can borrow more. So penal rate, that means it is higher than the repo rate. So this is the idea. Now how much higher? So remember that the repo rate is higher than the SDF rate by 0.25% and the MSF rate is higher than the repo rate by 0.25%. So now it has been decided to keep the policy repo rate unchanged at 5.25%. So SDF rate will be how much? SDF rate will be how much? 5%, because the repo rate is 0.25% higher than the SDF rate and the MSF rate is higher than the repo rate by 0.25%. Okay, so MSF rate is 5.50%. That is the idea. Any confusion? Chalo. Next is the Monetary Policy Committee also decided. So Monetary Policy Committee has unanimously decided to keep the repo rate unchanged at 5.25%. So the SDF rate is 5%, MSF rate and bank rate, they are 5.50%. Now the MPC also decided to continue with the neutral stance. What is the neutral stance? See, the West Asia crisis is going on. The energy prices, I hope everyone knows that there is the crisis that is that is seen, that a crisis can come. The energy prices are rapidly rising. The crude oil prices are rapidly rising. Okay, there is the Strait of Hormuz where the problem is going on that the ships, they are not able to travel very easily through the Strait of Hormuz. So crude oil crisis is going on, energy prices are increasing. The West Asia conflict, if it stretches out more, the energy prices are further going to increase, the crude oil prices are further going to increase. So if the oil prices are increasing, first of all, directly crude oil is required for the petrol, diesel. It is required for various industries. Various industries require the crude oil, as well as for the transportation also, the crude oil is required. The petrol, diesel is required. That comes from the crude oil. So if the prices keep on increasing for the crude oil, if the prices keep on increasing for the petrol, diesel, you can understand that the transportation will become very expensive. The industries, their input cost is going to increase, because this crude oil is the input for, or the petrol or diesel is the input in many of the industries. So the input cost is going to increase, and with the increase of the cost of production, with the increase in the transportation cost, the prices can increase in the economy. That means if the prices keep on rising, that means this is leading to more inflation in the country. So there can be the higher inflation in the country. At the same time, because of all this conflict, what is happening that the external demand is reducing, because the countries, they have the fear that the recession can come, that if this conflict drags on, the production can be impacted, the supply chain can be impacted. Okay, so the countries, like the external demand is decreasing, the global demand is decreasing for the products of India, and that's why the growth is also impacted, because our production will reduce if the external demand is reducing for our goods. Okay, so the growth is also impacted. So right now the MPC is thinking that inflation can increase, the inflation can increase, it is already increasing and it can further increase, or the growth can be impacted, the growth might decrease because of the external factors, because of the external problems. Okay, so now our the Monetary Policy Committee has to reduce the inflation as well as try to boost the growth. So now the MPC has decided to continue with the neutral stance. If the inflation increases at a higher rate in the future, the RBI will decide to increase the repo rate to control the inflation. If the Monetary Policy Committee thinks that the inflation is not increasing, the inflation is under control, but the growth is low, so the Monetary Policy Committee of the RBI can decide to decrease the repo rate. Okay, so when the inflation has to be controlled, the repo rate is increased. Repo rate is basically impacting the interest rate in the economy. So interest rate is increased, and with higher interest rate, there are less loans that are taken. So that means there will be less money that will be flowing in the economy. There will be less demand. Less demand means prices will be controlled and inflation will be controlled. So if inflation has to be controlled, repo rate has to be increased. But if the growth has to be boosted, if we have to boost the growth, if the MPC wants to boost the growth, the repo rate has to be decreased, because at the lesser repo rate, the interest rate will start reducing in the economy. With lesser interest rate, more loans will be taken. More loans means more money will flow in the economy, more demand, more production. Okay, so basically the neutral stance has been taken, that the Monetary Policy Committee will see the coming situation. As the situation evolves, the Monetary Policy Committee will see if the inflation is rising very rapidly, then the repo rate can be increased. But if the inflation is not increasing in the future, then the Monetary Policy Committee can focus on growth and boosting the growth by reducing the repo rate. So repo rate can be increased or the repo rate can be decreased as per the future situation, as per the evolving situation. So the Monetary Policy Committee for now has decided to continue with the neutral stance. Neutral stance means that the repo rate in the future can be increased or the repo rate in the future can be decreased. That is the idea. Now coming to the growth outlook, we will discuss the domestic outlook now. Till now we have discussed the decision of the Monetary Policy Committee to keep the repo rate at 5.25% to take the neutral stance. Now the growth outlook. So first of all, we are focusing on the domestic outlook. Under the domestic outlook, we have to focus on the growth and the inflation. Okay, so first we are going to discuss about the growth. So on the domestic front, the Indian economy remained resilient in the 2025-26. Okay, the real GDP, that is the real gross domestic product, that is basically showing the real production that happened in the economy. This is estimated to grow by 7.6% during the 2025-26, during the year, as per the second advance estimates of the new GDP series. New GDP series basically means that the base year for the new GDP series is 2022-23 rather than 2011-2012. So rather than the base year 2011-2012, for the new GDP series, the base year is 2022-23. So BY is basically base year. So the real GDP is estimated to grow by 7.6% during the financial year 2025-26 as per the second advance estimates that are released by the National Statistical Office. The new GDP series, this is the data as per the base year 2022-23. Okay. Next is private consumption. Why there is the growth of why there is the growth in the production, why there is growth in the real GDP by 7.6% in the 2025-26 financial year. So the private consumption and the fixed investment contributed significantly to overall growth. Basically, the demand in our country was high, because of which the production was high. So the private consumption, the consumption of the households, and the fixed investment, that is the investment in the assets, this contributed significantly to the overall growth in the country, and that's why the real GDP increased by 7.6% in the financial year 2025-26. While the net external demand remained soft, as I've told you that because of the various problems that are going on at the global level, the external demand is decreasing. The external demand for our products, this is decreasing. That means our exports, the merchandise exports, that is the goods exports, they are decreasing. Okay. Next, on the supply side, estimated real GVA growth. So if we see from the demand side that we take the real GDP, the real gross domestic product, but if we see from the supply side, we take the gross value addition. Gross value addition, that is how much value addition has happened. Okay. So on the supply side, estimated real gross value addition growth of 7.7%. This was driven by the buoyant services sector. The services sector is still very healthy, and robust manufacturing activity. Okay, so this is the idea that in 2025-26 the growth was good. For the real GDP, the growth was 7.6%, while for the GVA, gross value addition, the growth was 7.7%. Okay. Next, now looking ahead for the financial year 2026-27, what is the situation? Looking ahead, there is elevated energy and other commodity prices. The crude oil prices is rapidly increasing, coupled with supply shock, coupled with the supply disruptions. The distortions are coming. Okay, there is the supply chain disruption that has happened because of the Strait of Hormuz, as well as because of the war that is going on, or the conflict that is going on basically right now. Because of that, there is the supply chain disruption. Okay, so looking ahead, elevated energy and other commodity prices coupled with the supply chain disruption due to the disruptions in the Strait of Hormuz. So there is the disruption in the Strait of Hormuz, and because of this small area, or because of the small part, the ships are not able to travel very easily through this part, and the permissions have to be taken and such. This has led to the supply chain disruption. Okay, this would act as a drag on the domestic production also in the 2026-27, because the external demand is further going to decrease from India. Heightened volatility in global financial markets, because of this uncertainty, because of the conflicts, there is the heightened volatility in the global financial markets, with its spillover, with its effect on the domestic financial conditions. This would also weigh on the growth prospects and reduce the growth prospects in the 2026-27 for India. Okay. Next is on the external front, that is at the global front we can say, and for India on the external front, the merchandise exports, that is the exports of the goods, they may be adversely impacted from the disruptions to the key shipping routes. And what happens that when the shipping route has been disrupted, so it can increase the freight cost. It can increase the freight cost, or the basically the transportation cost may be increased because of the disruption in the pathway. Okay, as well as the insurance cost can also increase, because there are more risks, there is more uncertainty, or there are more risk of the bombing and such. So the insurance cost is also, or can also increase. So the accompanying rise in freight and insurance cost in case of conflict being long drawn. So if the conflict keeps on going, if the conflict is long drawn, then the freight cost and the insurance cost can further rise. That can further become problem for our country. Okay, on the other hand, so these are the problems. Energy prices are increasing, other commodity prices are increasing. There is the supply chain disruption that has happened. The disruption is there in the Strait of Hormuz, due to which the freight cost and the insurance cost can increase. The merchandise exports from our country are decreasing, they are impacted from the disruptions. So these are the negative effects on the growth. But now on the other hand, there is sustained momentum in the services sector. Persisting impact of the GST rationalization. GST was rationalized. Before there were the 5%, 12%, 18% and 28%. These were the GST rates that were imposed, but now the GST rates are only 5% and 18%. Okay, 12% merged into 5%, 28% was merged into 18%. So now there are the GST rates have been rationalized. Now the GST rationalization, because of that, for certain products the prices have reduced. You can understand before 12% or 28% of the taxes were imposed. So those taxes are not imposed now. So that's why the prices have reduced for certain products, as only 5% or 18% of rates are being imposed. So persisting impact, there is impact of the GST rationalization. There is good impact of the GST rationalization as the prices for some commodities have reduced with the GST rationalization. Rising capacity utilization in manufacturing, there is higher capacity that is being utilized in the manufacturing sector. There are healthy balance sheet of the financial institutions and corporates. So these are the good sides, that at least on the internal front we have the sufficient demand for now. We have the sustained momentum in the services sector, persisting impact of the GST rationalization and such. Now, government is focusing on the scaling up of domestic manufacturing in different areas, in different sectors. This was announced in the Union Budget 2026-27. This is a good announcement for India's growth trajectory, okay? That the government is focusing on the domestic manufacturing and is going to boost the domestic manufacturing. Taking all these factors, the negative factors from the external front, the positive factors from the internal front, taking all these factors into consideration, and on the assumption that the adverse impacts of the conflict would remain contained in the near term, that we are assuming that if the adverse impact of the conflict, they only remain for the short term, then the real GDP growth of India for the 2026-27 is projected at 6.9%. But what if the conflict drags on? So further escalation of the conflict, its continuation over a wider geographical spread, and uncertainty regarding the damage to the energy infrastructure apart from weather related events that can happen in India, they pose downside risk to the domestic growth outlook. So if we see that the conflict is contained in the near term, then it is expected that the real GDP growth for 2026-27 for India is projected at 6.9%. But if the conflict is not contained in the near term, if it drags on to the wider geographical area and such, as well as if there are weather events that happen in India, so they can lead to downside risk to the growth. Now coming to the inflation part. So as per the new CPI series, basically before the consumer price index had the base year 2012, but now the new CPI series have the base year 2024. Okay, so the new CPI series, that means the CPI with the base year 2024. Now CPI is the consumer price index that basically shows that how the prices are being impacted for the consumers, for the consumer goods that are consumed by the people like you and me. Okay, so basically the consumer price index inflation, this shows the inflation, or this shows the rise in prices for the consumer goods that is impacting the consumers in the country. Okay, so this, see, whenever we talk about inflation, whenever the RBI or the Monetary Policy Committee is talking about inflation, they want to control this inflation. Okay, they want to control this inflation. The target is 4%. The inflation should be around 4%, within the range of plus minus 2%. Inflation should not go below 2%. Inflation should not go above 6%. So whenever Monetary Policy Committee wants to control the inflation and wants the inflation to be around 4% or within the range of 2 to 6%, so this inflation is basically the CPI inflation, the inflation that is affecting the consumers. Okay, this is the inflation that is affecting the consumers. So as per the new CPI series, the headline inflation, that is the retail inflation, that is the CPI inflation, it increased to 3.2% in February 2026. So the inflation is within the range of 2% to 6%. And the inflation is around 4%. So that is a good news that the inflation is not going out of bounds in our country. But the inflation has increased from the 2.7% in January to 3.2%. Now, while food inflation increased in February, the core inflation. Now, what is core inflation? Anyone can tell me what is core inflation? Core inflation is basically CPI inflation, excluding the food and fuel prices. That is, core inflation is the CPI inflation minus the volatile prices. So the rest of the prices are taken into account, like for the manufacturing goods, for the precious metals and such. So the core inflation is the CPI inflation minus the food and fuel prices. Okay, so this is the core inflation. This remained unchanged. So that means because of the food inflation, the headline inflation, the retail inflation has increased. Excluding precious metals, if we exclude the precious metals also, the core inflation remained moderate at 2.1% in January and February, suggesting subdued underlying inflation pressures. That means from the manufacturing goods, the inflation is not coming, or from such kind of goods the inflation is not coming. Okay, so inflation is mainly from the food side, and that also is contained because the inflation is only 3.2%. Now, the ongoing conflict has led to the large volatility in the international energy and other commodity prices, imparting considerable uncertainty to the near-term inflation outlook. Because if the energy prices keep on increasing, other commodity prices keep on increasing, that will impact the whole of the India. Okay, if the energy prices are increasing, if the crude oil prices keep on increasing, that means the petrol, diesel, LPG cylinders, they will become expensive. The prices will increase. If the petrol and diesel is becoming expensive, that means the transportation cost will increase, the cost of production will increase. Okay, the pass through of higher global energy prices, because of the higher global energy prices, it has led to the increase in the price of selected fuels such as the premium fuel and LPG and diesel for the industrial use. So because of the increase in energy prices, for now there is increase in the premium petrol and the LPG prices and diesel for the industrial use. But slowly and slowly, if the prices keep on increasing, if the energy prices keep on increasing, there will be faster increase in the prices of the LPG cylinder, diesel and petrol and such. Okay, for now it is contained for the industrial use, but slowly and slowly it can start impacting the consumers also, the other people also. On the other hand, the near-term food supply prospects have been boosted by robust rabi crop, providing some comfort. So at least from the food side, the crops, they are showing resilience and there is healthy growth that is seen. So right now the energy prices that are increasing at the global front, this has led to increase in prices in select fuels such as the premium petrol, LPG and diesel for the industrial use. If the energy prices keep on increasing, it will directly start impacting the consumers also. Okay, considering all these factors into account, CPI inflation for 2026-27 is projected to be 4.6%. So we are expecting that, okay, the inflation will be around 4% and within the range of 2% to 6%, it will not go out of hand. Okay, now the persistently elevated energy prices due to the West Asia conflict and possible El Nino conditions, they could have a negative impact on the southwest monsoon. Okay, so El Nino conditions, they have the negative impact on the southwest monsoon. So that's, if the southwest monsoon is impacted, you can understand that the crops will get impacted. So the persistently elevated energy prices and the possible El Nino conditions, they pose upside risk to the inflation. The inflation can go above also. Okay, it can rise out of 4.6%. So core inflation, that is the CPI inflation excluding the food and fuel prices, is projected at 4.4% for 2026-27, and excluding precious metals, if we exclude the precious metals also, it is even lower, indicating that underlying inflation pressures are expected to remain contained within the limits. Okay, now coming, this is what we have discussed. We have discussed the Monetary Policy Committee statement. The Monetary Policy Committee has decided to keep the repo rate unchanged, keep the neutral stance, as well as considering all the factors. CPI inflation for 2026-27 is projected at 4.6%, and considering all the factors, the real GDP growth is projected at 6.9% for 2026-27. Now coming to the governor's statement, where we will discuss the impact of the West Asia conflict on the Indian economy. Any confusion till now, anyone? Correct, Riya. Well done. Any confusion, anyone? So now, what is the impact of the West Asia conflict on the Indian economy? As per the governor's statement, it was said that there are 5. See, let me briefly, so governor said that let me briefly inform on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. So how the Indian economy is going to be impacted through the ongoing conflict? Are we a part of the West Asia conflict? Uh, is India a part of this conflict? No, we are not directly part of the conflict. Okay, we are not directly engaging in war or engaging in this conflict. So if we are not directly the part of the conflict, if our country is not getting involved in the military operations, then why are we getting impacted? What is the form of transmission of the problem in India? Okay, so what are the channels of transmission through which the Indian economy can get impacted by the ongoing conflict, which is not involved India in any way in the military sense? If in the military sense we are not involved, so how are we getting impacted by this conflict? So there are actually 5 areas where we are getting impacted. First of all, elevated crude oil prices. Elevated crude oil prices could increase imported inflation. See, we import a lot of oil. We import a lot of oil. If the oil prices increase, that means we will have to pay more for the oil. Before, let's say we were paying $1,000 one barrel. One barrel. Now, let's say we have to pay $1,200 per barrel, and we are importing, let's say, 100 of barrels or 1,000 of barrels. So for each barrel, we will have to pay $200 extra. So for 100 barrels, we have to pay $20,000 extra, and we are importing so much of the oil. So you can understand that with the increase in the crude oil prices at the global level, we will have to pay more to get the crude oil. We will have to pay more to get the crude oil. And if we are paying more dollars, that can increase the current account deficit, because current account of the balance of payment, it shows us the trade in goods. It shows us the trade in services of our country with the other countries, and the transfer payments, that is the remittances that we are getting from the other countries. So in the trade in goods, we can see that if we are paying more for our imports, so the trade in goods can further, like the current account can further have the increased deficit, because we are paying more than what we are getting. For the exports have reduced, so we are getting less dollars, but we have to pay more dollars. So we are getting less, we have to pay more, so the current account deficit can further widen. So this is the idea, that the elevated crude oil prices, they can directly increase the imported inflation. If the crude oil prices is increasing, so the prices in the country can increase and widen the current account deficit. Second, disruptions in energy markets. So sometimes it is also becoming problematic to get the crude oil or to get the energy requirements of the country. So there is disruption, there is supply chain disruptions, and disruption in energy markets, the fertilizers and other commodities may adversely impact industry, agriculture and services, reducing domestic output. Here is the article from the PIB. You can see India secures 86 lakh tons of fertilizers via Global Pact. So there were a lot of concerns that we might not be able to get the fertilizers that we need. So it was informed by the ministry that, okay, we are able to get the fertilizers for now, but you can understand that if the supply chain disruptions become increased, then we might not be able to get the products that we want. We might not be, even with the money, we might not be able to import as much quantities as we want. Okay, so supply chain disruptions are persisting. So second, disruptions in energy markets, we are not easily able to access the oil, or we might face problem in accessing the oil. Fertilizers and other commodities, they may adversely impact industry, agriculture and services in reducing the domestic output. Third, the heightened uncertainty. So first was the elevated crude oil prices, due to which the current account deficit is widening, it is increasing. Second, there are disruptions, supply chain disruptions in energy markets. Fertilizers and other commodities, they may adversely impact the industry, agriculture and services. The third is heightened uncertainty. When there is heightened uncertainty, you know that the war, we don't know that how much long this conflict will go on. Will it go into full-fledged war where the countries, they are coming together and fighting basically? So there is a lot of uncertainty. With uncertainty, there is also the higher risk. With higher uncertainty, there is higher risk. Now the risk aversion is increased. That means we do not want to take the risk in this kind of uncertainty, and that's why the investors, they want to invest in the safe haven, and usually the safe haven is the dollars. So many of the investors, they have started to invest more in dollars. So this is the idea, that with the heightened uncertainty, there is increased risk aversion, And safe haven demand could impact domestic liquidity conditions, economic activity, consumption, investment, because rather than investing in India or investing in the developing nations, the investors will want to invest in the US, which is like US dollars, which is considered safe haven. Okay. Fourth, weaker global growth prospects may dampen the external demand. Like I've told you that because of the global conflict or because of the war like situation, because of the conflicts that are going on, there is also the decrease in the demand at the global level. So external demand is reducing. With the reduced external demand, we are able to export less. With less exports, we will be producing, the production will reduce. Okay. So weaker global growth prospects may dampen the external demand of our products and reduce the remittance flows from the other countries. Finally, the fifth transmission through which the Indian economy may get impacted is finally adverse spillovers from global financial markets. If there is a lot of volatility in the global financial markets, it can affect the domestic financial market also basically. And remember that in the other countries also, with the higher crude oil prices, the prices of other commodities will increase and the inflation will rapidly increase. So the other countries will have to increase their interest rate so that the inflation can be controlled. If the interest rate increases in the other countries, so the investors will want to invest where the interest rate is higher, where the returns are higher, right? So this could lead to the tighten of the domestic financial conditions, because the investors will start taking out their money, more and more money, to invest in the countries where the interest rate is even higher. Okay. Raise the cost of borrowing also. This can increase the cost of borrowing because at the global level, the interest rates will increase very rapidly. Overall, the initial supply shock. So now the conflict has impacted the Indian economy through the supply shock, through the supply chain disruption. Now, till this is a supply chain disruption, okay, we are able to handle it. But what we do not want, this supply chain disruption to become the demand disruption. Because if there is no demand, let's say the internal demand is also affected. If the internal demand is also affected, if we also get worried that, okay, what will happen to our economy? We should save, we should not spend now. We have to save for the worst times. Okay. If we reduce our demand, basically, the internal demand will reduce and the production will further reduce. If the production is reducing, the employment will reduce. Employment is reducing, that means income will reduce. And with reduced income, further demand will reduce, further production will reduce. So basically, the RBI governor said the initial supply shock, the supply chain disruption, can potentially transform into a demand shock, and this is what we do not want. Okay. So that's why we have to restore the supply chains, and we do not want the supply chains restoration to be delayed. Okay. So the supply shock, right now it is a supply shock that is impacting the economy, and the supply shock, if it converts into the demand shock, that means internally also the demand reduces, then the problem will become even bigger for the Indian economy. So this is the idea. Any confusion, anyone? Now coming to the last point for today. Any confusion? Coming to the last point, despite stronger macroeconomic fundamentals. See, India has strong macroeconomic fundamentals. We saw that there is higher higher capacity utilization in the manufacturing sector. Service sector is buoyant. There is also the private consumption, private investment that is happening. So we have strong macroeconomic fundamentals. But still, the Indian rupee in 2025-26 depreciated more than the average in the previous years. That means the rupee, its value is decreasing against the dollars. Okay, rupee is getting depreciated basically means that the rupee value is decreasing against the dollars. Before, just taking the example, $1 was equal to 85 rupees. Now let's say $1 is equal to 91 rupees. Further, $1 is equal to 95 rupees. That means we have to give more and more rupees to get $1. So the rupee is depreciating. Rupee is becoming weaker and the dollar is becoming stronger. Dollar is appreciating against rupees, rupees is depreciating against dollars. I hope this is clear first of all. Now what is happening, that the Indian rupee in 2025-26 depreciated more than the average in the previous years. In this regard, RBI governor said that, let me reiterate that our exchange rate policy remains unchanged. So see, India is following what kind of policy? India is following managed floating exchange rate system. Okay, managed floating exchange rate system. That means whenever the RBI feels that, okay, there is too much depreciation of rupees that is happening, or there is too much appreciation of rupees that is happening, so RBI intervenes. So in this case, what will happen that RBI, seeing that there is a lot of depreciation of rupee that is happening and RBI wants to control the depreciation, RBI do not want this much of depreciation to happen of rupees. The rupee should not lose so much of the value. So RBI will start supplying the dollars in the market. RBI has the buffers. Okay, there are nearly $697 billion of foreign exchange reserves that RBI has right now. Okay, so from its reserves, the RBI will, from the foreign exchange reserves that the RBI has, RBI will supply the dollars in the market. When there is more supply of a product, when there is more supply of dollars, if there is more supply of dollars, what will happen? The value of dollars will reduce, the price of dollars will reduce, the appreciation of dollars will stop. Okay, the value of dollars will reduce. Before we were giving 95 rupees for $1. Now the value of dollars is reducing, so we will give 91 rupees for $1. So this is the idea, the intervention. The RBI has said that we will be intervening and we continue to intervene in the foreign exchange market. This is aimed at smoothing the excessive and disrupted volatility without targeting any specific level. So RBI is saying that we are not targeting any specific level. We are not targeting any specific band for the exchange rate. We do not want a specific, we are not targeting a band or a level. But if we see that there is continuous depreciation of rupee that is happening, then we will intervene. Okay, and the RBI has also intervened from time to time. Whenever there is continuous depreciation of rupee that happens, RBI supplies more dollars in the market so that the value of dollar can reduce in the Indian market and the price of dollars can reduce and the rupee depreciation can stop for the time being. Okay, any confusion, anyone? Any confusion? And remember that the foreign exchange reserves of our country went above $700 billion. But now they have reduced, and I think the recent data is $697 billion. Okay, so this is the idea that RBI is continuously supplying the dollars in the market so that with higher supply of dollars in the market, the depreciation of rupee can be controlled. This is the idea. Chalo. If there is no confusion, then this is the first question. I hope you will be easily able to answer the question. Which of the following statements are correct regarding the latest decision of the Monetary Policy Committee? The policy repo rate under the LAF was reduced to 5%. You have to answer this question now. The SDF rate remains lower than the repo rate and the MSF rate remains higher than the repo rate. Okay, so this is the first question, easy question. If you have the understanding, you will be easily able to answer this question. Now, coming to the next question, consider the following statements regarding India's growth performance in 2025-26. Real GDP growth was driven largely by the net external demand. Services sector showed strong performance. Manufacturing activity remained robust. So which of the following statements is correct? That you have to tell. Okay, which of the following statements is correct? Okay, so now let's get started. Am I clearly audible and the screen is visible? Give me a thumbs up if everything is fine. Okay, so it seems that everything is fine. Let's get started. Okay, chalo. So now we are going to start with the first topic, that is the limit for investment in debt and sale of credit default swaps by foreign portfolio investors for the 2026-27, that is for the new financial year. Okay, so the limits for FPI investment in government securities. See, the limits have been determined for the government securities, state government securities and the corporate bonds. So it is said that the FPIs, the foreign portfolio investors, they have the limit of 6% in the government securities. So out of the total outstanding stock of securities. Outstanding stock of securities means total value of securities that are that have not matured in the market. Okay, so the total value of the securities that are still present in the market. So from the total value of the government securities that are present in the market, 6% is the limit for the FPIs. So if the total value of the securities or the outstanding stock of securities, the government securities that are present in the market is 100 crores. So 6 crore is the limit for the FPIs. Okay, now the state government securities, out of the total value of securities in the market, the state government securities, now the investment that can be done by the FPIs is 2% of the total value of the securities. Okay, for the corporate bonds, the limit is 15% for the FPI. So these are the limits first of all, and they have not been changed. And as you
might remember that in the previous years there was a question from the limits directly. Okay, so this is important that the limit for the foreign portfolio investment has been notified for the government securities, for the state government securities, and the corporate bonds. So out of the outstanding stock of securities, out of the outstanding stock of government securities, the limit for FPIs is 6% out of the outstanding total value of securities that have not matured, that are present in the market. For the state government securities, the limit is 2% for the FPIs, and for the corporate bonds, the limit is 15% for the FPIs. This is very important. Okay. Next, now coming to the next point, that is the allocation of incremental changes. Think about it, that the union budget has been released. Now, the union budget that was presented by the finance minister in front of the parliament, in front of the Lok Sabha. So in the union budget, what is notified? What is notified, or what is this union budget talking about? It is talking about the expected expenditure of the government and the expected revenue or the receipts of the government. Can we say that the expected expenditure of the government, if we exclude the borrowings, so expected expenditure of the government expenditure is going to be higher than the receipts of the government? If we exclude the borrowings of the government, then can we say that the expenditure, the government is going to spend more than the receipts of the government? Can we say so? Right? This is the idea, that the government is going to spend more than the receipts of the government. So now if the government is going to spend more than the tax receipts, the dividends that it is receiving, the fees, fines, penalties that it is receiving. So if the government is going to spend more than its general receipts, so how the government is going to spend more? From where the money is going to come for its extra expenditure? For its extra expenditure, the borrowings. The government will be borrowing for its extra expenditure, right? So already through the union budget that was released on 1st Feb 2026. So through this union budget, it was informed that for the 2026-27 financial year, what is the expected expenditure, what is the expected receipts of the government, and the government notified that this is going to be the extra expenditure that the government will be doing. This is going to be the expected fiscal deficit. The fiscal deficit shows the extra expenditure of the government in comparison to the receipts. Okay, so already the fiscal deficit percentage has been provided, that this is going to be the extra expenditure of the government in comparison to the receipts of the government, excluding borrowing. So fiscal deficit actually shows us the borrowing requirement of the government. So government has given a estimate that this is the borrowing requirement of the government for the 2026-27 for the extra expenditure that the government wants to do for the welfare activities, for the different schemes that the government is bringing. So the government has to do extra expenditure, and this is the borrowing requirement of the government for 2026-27. According to this borrowing requirement for the financial year, for the new financial year, the RBI notifies that how much the foreign portfolio investors can invest in the government securities. Okay, so according to the borrowing requirement that the government has notified for the coming financial year, the RBI gives limits to the FPIs that how much they can invest in the government securities, because it is already notified that the FPIs have certain limits of investment in the government securities. So if, let's say, the government in 2025-26 had the outstanding like stock of government securities, this is the total value of the government securities, this is the total value of the government securities that is present for the 2026-27. Okay, from the previous year, this total value of the government securities that did not mature in the previous year, and this continued for the 2026-27. Okay, so this is the previous government securities that were issued in the previous financial year or before that, and these government securities, they have not matured, they are continuing. Now in the 2026-27, as per the government, as per the expected expenditure, as per the expected borrowing requirement of the government, it is said that the government is going to borrow 100 crores more. Now this is what? This is the incremental borrowing of the government, or the government is going to borrow additionally in 2026-27. So the idea is that the government had borrowed previously in the previous financial years the government has borrowed, that is still not matured. The government securities have still not matured. Okay, so still there is the outstanding stock of securities that has continued from the previous years. So the outstanding stock of securities for 2026-27 from the previous year that has continued is, let's say, 1000 crore. Now the government is saying that in 2026-27 particularly the government is going to issue new government securities worth 100 crore. So from this outstanding stock of securities, 6% is the foreign portfolio investment limit for the government securities. Now from the incremental government securities, the new government securities that the government is going to release in this financial year, what is the FPI limit for the government securities? Anyone can tell me? So these government securities, they did not mature and they are continuing. That's why this is the outstanding stock of securities. Now this incremental securities, this new government securities that the government is issuing from this particular government securities, what is the limit for the foreign portfolio investors for the government security? The limit is still 6%. The limit is 6% because once they are released in the market, they are also the outstanding stock of securities, they are also the total value of securities for the government securities. Okay, so 6% is the limit. Okay, that is 6 crores the FPIs can invest. Now it is said that out of this 6 crore from the incremental government securities, 50% should go for the general investors, that are the flexible investors. They trade very frequently in the market or they trade frequently, while the other 50% should go for the long-term investors. Okay, so this is the idea, that the allocation of the incremental changes in the government security limit, that means the new government securities will be released in the market soon, and this has been decided that the government is going to borrow from the market, and so government securities, new government securities will be released. The new government securities will be released, so the government security total outstanding in the market is going to increase. So from that, 6% is the limit. So out of the 6%, 50% or 50 ratio should go to the general investors, to the general foreign portfolio investors that usually trade more frequently, while the other 50% should go to the long-term investors, such as the sovereign wealth funds that usually invest for the longer period of time, or the insurance funds, the pension funds that usually invest for a longer period of time. Okay, so 50% should go to the long-term FPIs, so that there is stable investors that are also present under the FPIs. Under the FPIs, there is also some part of the government securities that is going to the stable investors. Okay, some part of the government securities, that is 50% of the government securities, should go to the stable investors. So this is the total limit. This is the total limit of the foreign portfolio investors. Out of this, basically 50% should go to the general investors that trade more frequently, and 50% should go to the stable investors that are the long-term investors for the government securities, it has been said. While for the state government securities, the entire increase in limits of state government securities, so whatever new state government securities are going to be issued, from that 2% is the limit for the foreign portfolio investors. Now it has been said that only general subcategory of the state government securities, that means this whole 2% limit should go to the general foreign portfolio investors. Okay, that is the idea. So here you can see that the RBI has also given the absolute value of how much is the limit for the FPI. So in the percentage terms, 6% for the government securities, 2% for the state government securities, 15% for the corporate bonds. But the RBI in terms of the absolute value also has given these limits. Okay, that you can see revised limit for the first half of the 2026-27 financial year, and the revised limit for the second half of the 2026-27 financial year. Here you can see that in the government securities, whatever is the limit, 50% is for the general investors, like the increase that is happening in the government securities, that is by 7,257 I guess here, and 7,000, yes, 257 here. So whatever is the increase, that is around 14,500 crores, 14,500 crore rupees. So 14,500 crore is the absolute limit, we can say, for the government securities for the foreign portfolio investors. So 50% of that is going 7,257. This is the incremental limit, okay? Because the previous government securities, previous value of the government securities, that is there, but the increase that is happening in the government securities from the incremental, that is the increase that is going to happen in the government securities in 2026-27, from the incremental changes in the government securities, this new government securities, from this, half should go for the general investors and half, that is 7,257 crores, should go for the long-term investors. Any confusion? No, you don't have to remember the absolute numbers. Percentages are important. 50% for the general, 50% for the long-term investors. For the government securities, this is important. For the state government securities, only general limit. Here you can see whatever increase is happening in the state government securities, it is only for the going for the general investors. There is no increased limit for the long-term investors, okay? Or whatever increment, whatever state government securities are released new, from that only the general investors can invest in, not the long-term investors. This is the idea. This table is just to show you that, okay, for the general investors, long-term investors, there is the equal increase. The incremental changes are equally divided between the general investors and long-term investors. 7,257 crores increase in the for the general investors, 7,257 crores increase for the long-term investors also. For the state government securities, all the increase is going only for the general investors, not for the long-term investors. That is the idea. Okay. Chalo. Yes. So this is important. The points are important. The table is not important. You cannot remember so many of the values. Neither it is required. No need to remember this. Just the idea needed to be clarified. Okay. Now coming to the next point, that is with effect from April 1, 2026, all existing and future investments under the voluntary retention route. Voluntary retention route means that the foreign portfolio investors have promised that they are going to hold their investment for 3 years. For at least 3 years, let's say. So there is a timeline that has been given by the foreign portfolio investors that they are going to voluntarily hold their investment in India for a period of time, for a longer period of time. So under the voluntary retention route, before there were separate limits, okay, before there were separate limits for the voluntary retention route, but now it has been said that this voluntary retention route, this will also be subjected to the investment limits, that is for the foreign portfolio investors under the general route. That means for the voluntary retention route also, it will come under the limits of the general route. So if the investors have to invest, they have to invest under the voluntary retention route, and it has the same limits as the general route limits, okay, or it comes under the general route limits. So general route limits for the government securities, let's say 6%. So if the voluntary retention route, through that the foreign portfolio investors are investing in the government securities, so this will be calculated towards this limit only. Okay. So with effect from April 1, 2026, all existing and the future investment under the voluntary retention route shall be subject to the investment limits, that is for the foreign portfolio investors under the general route. It will not have any separate limits. That is the basic idea. Okay. Now the aggregate limit for the notional amount of credit default swap. Let's say, how many of you have health insurance, or have you ever bought health insurance, or has your family ever bought health insurance? I hope that most of you have it. Why do you purchase insurance? So that whenever someone falls sick from your family, or there is any operation that is required, so you are buying the insurance. Let's say you are buying the health insurance, you are paying the regular premiums, right? You are paying the regular premiums on the monthly basis. Maybe you are paying the premium, or yearly basis you are paying the premium, but you are paying the regular premiums, or you are paying the premium. And what happens that you have the security that in case you are sick, in case someone needs operation in your family, then you have the security that the insurance company will bear the cost. Okay, or most of the cost will be borne by the insurance company. Okay, so this is the idea that you take the insurance for your safety. The credit default swap is nothing else. It is like an insurance. Let's say that I have given a loan. Let's say I have given a loan. I'm a lender, bank A, I have given a loan to XYZ company. Now I'm afraid it is a big company. It has taken a huge loan from me. It has taken a loan of 100 crores from me. Now I am afraid that what if this company defaults? What if this company closes down? So I want to divide my risk. So what I will do that in the market, I will purchase a credit default swap. Now by the term itself, you can understand that here the credit default is being swapped. I am buying this credit default swap by paying some premium amount on the regular basis, or maybe one time payment, or on the half yearly basis, yearly basis, I will pay this premium amount to the to some company, let's say ABC. So I have bought this credit default swap from the ABC company. I'm paying the premium amount to this ABC company for buying this credit default swap. I have paid some one-time amount. I am paying some premium amount also. Now, if the loan defaults, then the risk and the burden of the default will be taken by the ABC company. So this is the credit default swap. Basically, through the credit default swap, the bank A has got the insurance that if the default happens, then the responsibility to pay is of ABC. If the default does not happen, it is good. The free money, the free premium amounts have gone to the ABC. This is the insurance. In the case of insurance also, if you have not fallen sick, insurance company still gets the premium. But if you get sick, then whatever is the cost of the hospital, that has to be borne by the insurance company. So like the insurance company, this ABC company is also working. It is providing the credit default swap. It is getting the premium. It has to insure the loan. Okay, so this is the credit default swap. It is a financial instrument which serve as a form of insurance against the default of an underlying borrower or debt instrument. Let's say you are the investor. You have invested 10 crore rupees in this debt instrument through which company XYZ has borrowed. Now you are afraid that what if this company defaults, what if this company do not pay on time? So you have bought a credit default swap from a company ABC. Now you are paying the premium amount, you are paying some regular amount, some small amount you are paying, and if the borrower defaults, if the debt instrument defaults, then the ABC company has the responsibility to pay for your loss. That is the credit default swap. Got it? Any confusion? So aggregate limit of the credit default swaps that can be provided by the foreign portfolio investors, that can be sold by the foreign portfolio investors, shall be 5% of the total stock of corporate bonds. Okay, so it should not be more than that. This is the limit that has been determined, that if the foreign portfolio investors, they are providing the credit default swaps, it shall be like the limit is, the total limit is 5% of the total value of corporate bonds that are present in the market, not more than that. Accordingly, an additional limit of 3,30,464 crore is set out for 2026-27. Now this is the idea. The amounts you don't have to remember, the percentages are important that you have to remember. So for the credit default swap, what is the limit for the FPIs? It is 5% for the 2026-27. That is the idea. Chalo, moving forward with the next direction for today, that is the master direction on incentives and penal provisions for the bank branches and currency chest. Let me do a RRR, that is revision. What is the limit for the government securities? I want rapid fire answers. Okay, so what is the limit for the government securities? Anyone? What is the limit for the foreign portfolio investors? What is the limit for the foreign portfolio investors for the government security investment? It is 6%. What is the limit for the foreign portfolio investors to invest in the state government securities? What is the limit? And for the corporate bonds? Okay, for the state government securities, it is 2%. For the corporate bonds, it is 15%. Okay, from the outstanding stock of securities. Now, coming to the government securities, from the incremental changes from the increased government securities, how much should go to the general investors? How much should go to the long-term investors? How much should go to the general investors? How much should go to the long-term investors? From the incremental change, the government of this government securities, the 6% is the limit again, but from the 6%, general investors should receive 50% of the investment, and long-term investors, long-term foreign portfolio investors should be able to do 50%. For the state government securities, what is the, from the incremental change in the state government securities, still 2% is the foreign portfolio investment limit. But for the general investors, under this limit, how much they can invest? For the long-term investors, under this limit, how much they can invest? Very good. Very good, everyone. Good to see you all are answering correctly. For the general investors, it is 100%. They can invest till the limit 100%. For the long-term investors, from the incremental change, there is no increase. Okay, so that is the idea. Now, for the credit default swap, what is the percentage limit for the credit default swap for the foreign portfolio investors? What is the percentage limit? 50%. 50%? 5%. 5%. Okay. So for the credit default swap, the limit for the foreign portfolio investors is 5%. Okay. Now coming to the next direction or the next news article. So master action on incentives and penal provisions for bank branches and currency chest in respect of currency operations. So first of all, see the idea, then you will get the better clarity. So first of all, RBI has formulated a scheme of incentives to encourage the banks for setting up requisite currency chest. So first let's understand the definition so that you have the clarity about this topic. Okay, so here, what are the soiled, mutilated and imperfect notes? Soiled notes means a note which has become dirty due to normal wear and tear and includes a two-piece note pasted together wherein both the pieces presented belong to the same note and form the entire note with no essential feature missing. This is a soiled note. Okay, the note has got oil, or let's say the note is dirty, it is not clearly visible what is written, or it has been divided into two. Mutilated banknote is a banknote of which a portion is missing or which is composed of more than two pieces. Okay, imperfect banknote means any banknote which is wholly or partially obliterated, that means it is not visible completely, shrunk, washed, altered, indecipherable, but does not include a mutilated banknote. Now, what is a clean note policy? Clean note policy basically states that the soiled notes, the mutilated notes have to be reduced from the economy, from the members of the public, and the members of the public should be provided with the clean note. So Reserve Bank of India has been continuously making efforts to make good quality banknotes available to the members of public. So that is a clean note policy, that instead of having the soiled or the mutilated notes, the people should be able to have the good quality banknotes. Okay. Now, what is this currency chest? To understand the currency chest, let's take an example that during the demonetization, what do you think that does RBI, like during the demonetization, the banks, they were collecting the old 500 rupee note and the old 1000 rupee note, and the RBI had to provide the new 2000 rupee note to the bank so that the bank can provide it to the public. Now there are multiple bank branches. So does RBI alone, or does RBI regional offices or the RBI head office was sending these new 2000 rupee notes to all the bank branches, and all the bank branches, were they individually sending their old 500 and old 1000 notes to the RBI, and RBI individually was sending the new 2000 rupee note to all the bank branches? Would it not be very cumbersome process? No, right? Actually, there is a middleman, that is the currency chest. The currency chest, they are available in different regions. See, what is the core function of the Reserve Bank of India? The core function of Reserve Bank of India is the monetary policy, the management of the foreign exchange, as well as currency management. Currency management is also a core function of the Reserve Bank of India. The RBI regulates the currency, the banknotes in the country. So RBI issues the banknotes in the economy, as well as RBI has the responsibility of managing the currency in the economy also. So during the demonetization, or normally also, if the bank requires the money, does the bank always, all the bank branches have to go to RBI to take the money? That okay, we have the 100 rupee notes, but we have the 100 rupee notes, but we require the 500 rupee notes to use it in the ATMs, to get it for the ATMs. So does all the bank branches have to go to RBI? No. There are the currency chests that are available. Now, what are the currency chests? To facilitate the distribution of banknotes and rupee coins, the Reserve Bank has authorized select scheduled banks to establish the currency chest. Like in your house, there is a tijori. There is a tijori. that your mother and father, they are able to access this tijori, and whenever your grandparents need the money, or let's say the children need the money from the family, they will get the money from the tijori through the father and mother. So that is the same idea, that the currency chest, it is available. Okay, and whenever the different bank branches in the area, they require the money, they go to the currency chest rather than going to the RBI in the regional offices or in the head office. Okay, so in different areas, in all the different areas, there are the currency chests that are available. So to facilitate the distribution of bank notes, to facilitate the distribution of rupee coins, the RBI has authorized select scheduled banks to establish the currency chest. These are storehouses. They are basically tijori. They are basically the storehouses where banknotes and rupee coins are stocked on behalf of the Reserve Bank of India for distribution of these banknotes, these coins, to the bank branches in their area of operation. So in all the different areas of operation, there are different currency chests that are available. They are basically the scheduled banks that are authorized to work as the currency chest and to provide the different bank branches in their area with the banknotes. Let's say that my bank branch is A. I have multiple 100 rupee notes because the farmers are the depositors in my or the laborers are the depositors in my bank branch. So they are depositing 100 rupee notes. Now I do not need so many of the 100 rupee notes, because for the ATMs I need the mix of 500 rupee notes also, but this is not available with me. So I will go to the nearby currency chest and I will exchange my 100 rupee notes with the 500 rupee notes, because my bank branch need 500 rupee notes or 10 rupee notes, let's say, or 100 or 50 rupee notes I require. So I will take whatever I need from the currency chest, exchange the money. Okay, or let's say I have too many deposits and the bank branch does not have high level of security, so I can deposit, like the bank branch, they can deposit their excess money with the currency chest also, because it is a storehouse, it can store the currency, it has that level of the security, CCTV and such. Okay, so this is the idea, that the currency chest, they provide multiple services to the nearby bank branches. Okay, so the multiple bank branches of the nearby area, they are linked. They are non-currency chest bank branches. They are linked with the currency chest. Okay, this is known as the linkage scheme, where the multiple non-chest branches, they are linked with the currency chest bank branch nearby. So rather than going to the RBI, you just have to go to your nearby currency chest that is available in your area. You need the coins, you need the currency note, you can get it from there. The bank branches, they can get it from there. This is the linkage scheme. The non-chest bank branches, they are linked with the currency chest bank branch. So this is the currency chest. The currency chest are expected to distribute banknotes, rupee coins to other bank branches in their area of operation, and this is the linkage scheme. Okay. Now, these are the storehouses where banknotes, rupee coins are stocked on behalf of the Reserve Bank of India. RBI wants to provide the new notes. RBI will provide the new notes to the currency chest, and the currency chest, the bank branches can go with their old 500 rupee note, old 1000 rupee notes, and deposit it in the currency chest and take the new notes. The currency chest will send these old notes to the RBI. So only the currency chest are connected with the RBI. The bank branches are connected with the currency chest. Okay, so this is the idea. Now, bank for distribution to bank branches. As on February 28, 2025, there were 2,691 currency chests, and currency chests are nothing else. They are the authorized select scheduled banks. Okay. Chalo, moving forward, I hope currency chest is clear to you now. So RBI has formulated a scheme of incentives. So RBI will be providing the incentives to encourage the banks for setting up requisite currency chest, because in all areas of operation there should be a currency chest so that the RBI can distribute the banknotes easily in that area or the coins easily in that area. Okay, so currency chest should be available in all areas of operation, especially in the far off areas also the currency chest should be available. And facilitating, the RBI has also formulated the scheme of incentives to facilitate distribution and exchange of notes and coins. Further, the RBI has also prescribed a scheme of penal interest or penalties in order to ensure accurate and timely reporting of currency chest transactions and provision of proper customer service to the members of public by the currency chest branches and the ATMs of the bank. So basically, there is the scheme of incentive The scheme of incentive incentivizes for the establishment of the currency chest and facilitating the distribution of the clean notes. There is scheme of penalties. The penalties are for such kind of banks or such kind of bank branches, such kind of currency chest or the ATMs that are not following the rules and regulations. They are not providing proper customer service. So for them, there is scheme of penalties. Okay. So first, why the schemes have been launched, why the scheme of incentives, why the scheme of penalties. So in terms of preamble of the Reserve Bank of India Act and as per the section 45 of the Reserve Bank of India Act and the Banking Regulation Act, the Reserve Bank of India issues guidelines, instructions for realizing the objective of clean note policy. Clean note policy is basically where the RBI wants to provide good quality banknotes to the member of public, right? So RBI issues guidelines, instructions for realizing the objective of clean note policy and enhancing the efficiency of currency management operations. So to enhance the efficiency of currency management, to complete its objective or to realize the objective of clean note policy, the RBI has released the scheme of incentives and the scheme of penalties. Okay, so this is the idea. Now, coming to the applicability, scheme of incentives and penalties mentioned in chapter 2. The chapter 2 is scheme of incentives, chapter 3 is scheme of penalties. Okay, will be applicable to all banks. All banks. There is no criteria, like there is no segregation that is given. All the banks, they will be under the scheme of incentives and penalties. Penal provisions for deficiency in operations of currency chest will be applicable to all banks having currency chest. So the penal provisions for deficiency in operation of currency chest, see, currency chest are directly under the Reserve Bank of India. They are authorized by the Reserve Bank of India to work as the currency chest. So the penal provisions for deficiency, if they are doing deficiency in operation, if they are not providing proper services to the bank branches, so they will be penalized by the RBI. Okay, so basically if the currency chest, they are having deficiency in their operations, they are not providing the proper services to the bank branches. Let's say the bank branches need 500 rupee note or they need 50 rupee note, the currency chest is not fulfilling the requirements and not sharing the requirements of the bank branches with the RBI. So in any deficiency in operation of currency chest, they will be penalized and such. This is the idea. Okay, next is these directions shall become effective on the day these are released on the website of the RBI. So they have already been released. Okay, now starting with the scheme of incentives, first we will discuss the scheme of incentives. The scheme of incentives incentivizes the bank branches including the currency chest based on the performance in rendering the customer service to the members of public. So scheme of incentives is for all the banks as well as for the bank branches that have the currency chest. This is to encourage all the banks or bank branches to provide better customer service as well as achieve the objective of clean note policy. So let's see the incentives now. So nature of service and the particulars of incentives. First of all, see, if a bank agrees to open or if a bank is opening and maintaining currency chest in the northeastern region and at inaccessible or hilly areas or hilly places of Jammu and Kashmir and Ladakh Union Territories. So if there is the opening of and maintaining the currency chest in the northeastern region or at the inaccessible and hilly places of Jammu and Kashmir and Ladakh Union Territories, so in this case, the RBI will be incentivizing such bank that is opening its currency chest with a capital incentive of up to 100%. So capital expenditure is the one-time expenditure for the fixed assets in relation to the currency chest, because if currency chest has to be developed, that means security of that bank branch has to be increased, the CCTV has to be installed, the proper surveillance and security measures have to be adopted and such. So the one-time expenditure on the fixed assets, for that there will be 100% incentive, 100% reimbursement that will be done. So capital cost up to 100% of the capital expenditure is eligible for reimbursement subject to the ceiling of 50 lakh. So if a bank branch has done the expenditure of 52 lakhs for the establishment of the currency chest, so only up to 50 lakhs will be reimbursed. If let's say a bank branch has done 40 lakhs of the capital expenditure for the currency chest in the particular area, so the 100% will be provided, the 100% will be reimbursed, the 100% of the capital cost will be reimbursed up to the ceiling of 50 lakh. That is the ceiling, that is the highest. Okay, so this is the idea. The capital cost, the one time expenditure on the fixed asset for the currency chest. So up to 100% of the capital expenditure is eligible for reimbursement subject to the ceiling of 50 lakh rupees. Revenue cost, this is basically the cost of maintenance of currency chest, because if the CCTV has been installed once, the installation cost is once. But if there is any repair, if there is any maintenance that is required, so that is revenue cost, the maintenance cost as well as the operational cost of the currency chest. So the maintenance cost and the operational cost of the currency chest, for that 50% of the revenue expenditure is eligible for reimbursement for the first 5 years of currency chest operations. So let's say there is revenue expenditure of 10 lakh. Okay, 50% of that means 5 lakh will be reimbursed by the RBI. So you can understand capital cost 100% reimbursement till the limit of 50 lakhs. Okay, revenue cost 50% of the reimbursement for the starting 5 years. 5 years. So that is the idea. So revenue cost, 50% of revenue expenditure is eligible for reimbursement for the first 5 years of currency chest operations. The revised instructions would be applicable to the new applications for opening of currency chest in these areas received on or after April 25, 2025. So the already established currency chest in these areas will not get the reimbursements, but the new, like the currency chest that established on or after April 25, 2025, they will get the reimbursements. That is the idea. Capital cost and the revenue cost, I have explained you. Capital cost is the one-time expenditure incurred for acquiring the fixed asset for the currency chest. Revenue cost are the recurring expenses, the maintenance cost, operational cost. Okay. So this is the idea. Coming to the next nature of service, that is exchange of soiled notes, adjudication of mutilated notes over the counter at the bank branches or currency chest. So incentives will be provided to the bank branches or to the currency chest if they are receiving. See, currency chest, bank branches. So there are certain banks which are providing the currency chest operations, So does this bank branch or this bank branch cannot provide any other operations, or does this bank branch cannot take the deposits, cannot provide the loans? Is it so? No. This bank branch which is doing the currency chest operation, this branch is also providing the deposits, is also providing the loans. It is just having the additional authorization to work as the currency chest and to provide the currency chest functions and to provide the currency chest facilities to the linked bank branches. That's it. Okay, but this currency chest operation is done by the bank branch that has been authorized. Okay, so let's say the people, the members of public, they are exchanging their soiled notes, they are adjudicating their mutilated notes over the counter at the bank branches or the currency chest. So if the bank branches are receiving the soiled notes and mutilated notes, the exchange of soiled notes, ₹2 per packet. This is the incentive that will be provided by the RBI. That exchange of soiled notes, ₹2 per packet. In one packet, there are 100 notes. Okay, for exchange of soil notes in the denomination of ₹50 and below. So basically through this table you might be able to understand better that let's say the bank has received 5500 soil notes, okay, of 10 rupee denomination, and the bank has received, let's say 20 rupee soil notes of 7500 rupee denomination. So in one packet, how many notes are there? In one packet there are 100 notes. So in total there are 55 packets. After taking the deductions, after taking into account the total discrepancy, let's say 53 packets are there. 53 packets means per packet 2 rupee of the incentive. So that means 106 rupee of the incentive will be provided to the bank. Okay, and here we are only talking like in small numbers, but if you see in the big numbers, the incentive can be higher. So this is the idea, that exchange of soiled notes per packet 2 rupee is the incentive for the banks for the exchange of soiled notes that are 50 rupee and below. Let's say the notes are above 50 rupees, so for that there is no incentive. For the bank. Okay, so this is the idea, that if the bank is exchanging the soiled notes, basically the bank is receiving the soiled notes and is sending the soiled notes to the RBI. So the bank will get the incentive of 2 rupee per packet for exchange of soiled notes in the denomination of ₹50 and below. If the adjudication of mutilated notes is happening, that means the customer, it came to the bank to give the mutilated note. Now the bank has taken this mutilated note, gave a new note to the customer. Now this mutilated note was sent to the currency chest, and the currency chest will send this mutilated note to the RBI. RBI will give the incentive through the currency chest. Currency chest will distribute the incentive to the bank branch from where the mutilated note came. So this is the basic idea. In the soiled note category also, the bank is receiving the soiled note from the customers, and the bank branch is giving the clean notes to the customers. These soiled notes are sent to the currency chest, and from the currency chest, these soiled notes, they go to the RBI. The RBI provides the incentive to the currency chest distribute the incentive to the bank branches. This is the idea. Okay, so I hope this is clear that for the exchange of soiled notes, there is incentive of 2 rupees per packet. In one packet there are 100 notes. Okay, so rupees 2 per packet for exchange of soiled notes in the denomination of rupee 50 and below. For the adjudication of mutilated notes, 2 rupee per piece. This is the incentive. Now distribution of coins, see, this is a problem that in the economy there is not as much coins that are available that is required by the people. So it is usually felt that the coins are not present in the sufficient quantity in the economy. That's why the RBI is saying that for the distribution of coins, there will be incentive that will be provided to the bank branches, to the banks. So basically, distribution of coins, what is one bag of coin? What is one bag of coin? So for incentive calculation, 5,000 pieces of 50 paise coins, 2,500 pieces of 1 rupee, 2 rupee, 5 rupee coins, and 2,000 pieces of 10 rupee or 20 rupee coins would be deemed to constitute one bag. Okay, and 65 rupees per bag, this is the incentive for the distribution of coins, 65 rupees per bag. In an additional incentive of 10 rupees will be provided if the bag of coins is provided in the rural or semi-urban areas on the submission of a concurrent auditor certificate to this effect. So basically 65 rupees per bag for the distribution of coins. 65 rupees is the incentive per bag for the distribution of coins in the urban areas, and 65 rupees plus 10 rupees, that is 75 rupees. This is the incentive per bag. This is the incentive per bag for distributing the coins in the rural or semi-urban areas. This is the idea. Okay. Next is cash deposit by non-chest bank branches. Now let's say the currency chest is providing the services to the non-currency chest bank branches. So currency chest bank branches, it is providing the services to various different non-currency chest bank branches in its area. Is it doing for free? The currency chest will provide these services for free. It is taking the 100 rupee notes, providing the 500 rupee notes. It is taking the deposits or providing the security and such. So currency chest will it do for free? No, there is a service charge that is taken. Okay, so cash deposit by non-chest branches under linkage scheme with currency chest. So basically for the cash deposit, it will take the service charge. Okay, for the other facilities, it will provide for no service charge or such. But for the cash deposit, let's say non-chest branches, non-currency chest branches, they want to deposit their money with the currency chest, because these non-chest currency chest branches, they do not have much security, but they have got huge deposits, so they can deposit their money with the currency chest to remain so that the money remains safe. So cash deposit by non-chest branches under the linkage scheme with the currency chest, service charge to be levied by the currency chest on the non-chest branches. Large modern currency chest, if we are talking about the large modern currency chest, rupees 11 per 100 pieces of the banknotes. This is the service charge. Other currency chest, rupees 8 per 100 pieces of the banknotes. This is the service charged. So cash deposit by non-chest branches under linkage scheme with the currency chest will garner the service charge of rupees 11 per 100 pieces from the large modern currency chest, and other currency chest can take the service charge of rupees 8 per 100 pieces. Large currency chest is basically the currency chest that have the large modern currency chest. They are the currency chest that have the modern facilities and the chest balance limit of at least 10 billion rupees. So that is the idea. Okay, so this is the service charge that is levied by the currency chest on the non-chest branches for taking the cash deposit. This is the idea. Any confusion? Now shall we do a rapid fire before going forward? Let's do a rapid fire round. For the currency chest that is being operated and maintained and established in the northeast region and in the hilly inaccessible region of Jammu and Kashmir. So what is the capital cost reimbursement that will be done? What is the capital cost reimbursement that will be done? Tell me fast. Capital cost reimbursement will be 100% subject to the ceiling of 50 lakh, while the revenue cost reimbursement will be 50% for the period of how many years? 5 years. Okay. Next, so this is clear. Next point is the coins. For the distribution of coins, the incentive is how much? In the urban areas, rupees 65 per bag of coins. Okay. And in the rural areas, in the semi-urban areas, what is the incentive for the distribution of coins? Rupees 65 plus rupees 10, that is rupees 75 is the incentive, 10 rupees additional. Okay. Now, if the soiled notes, they are being deposited, or if the mutilated notes are being provided in the bank branches or in the currency chest, okay, and the bank branches are providing these soiled notes to the currency chest, which is further sending these soiled notes, mutilated notes to the RBI. So what is the incentive for the soiled notes? What is the incentive RBI will provide for collecting the soiled notes? Rupees 2 per packet. But soil notes, the incentive will be provided only if the soil notes are of 50 rupee denomination or lower. Okay. For higher denomination soil notes, there is no incentive basically. Now, for the mutilated notes, what is the incentive? Anyone? What is the incentive for the mutilated notes? Rupees 2 per piece. Not packet. Mutilated notes, rupees 2 per piece, and there is no such limit of denomination. Okay. So this is what we have discussed. The last point was that the cash deposit done by the non-chest branches to the currency chest, what is the service charge by the large modern currency chest? So it is 11 rupee per 100 pieces, and by the other currency chest, the service charge is rupees 8 per 100 pieces. This is the idea. Chalo, so this is what we have discussed. Okay, the exchange of soiled notes. For the exchange of soiled notes, see, basically the bank branches is taking the soiled notes, is taking the mutilated notes from the customers and returns the good notes, the clean notes to the customers. The bank branches send the soiled notes, mutilated notes to the currency chest, which further sends it to the RBI, and RBI provides the incentive through the currency chest, and further currency chest sends the incentive to the bank branches. This is the idea. This, let's understand this more. So the incentives. Now, operational instruction on payment of performance in based incentive. So what are the operational instructions? We have discussed about the performance-based incentive. If the banks are collecting the soiled notes, if the banks are collecting the mutilated notes, if the banks are distributing the coins, so there are performance-based incentive. Now, operational instructions on payment of performance-based incentive. So the incentives in respect of bank notes shall be paid on the basis of the soiled notes that are actually received in the issue office of the RBI. So let's say the customer gave the bank branch the soiled notes and the mutilated notes. Now the bank branch is giving this to the currency chest is giving this to RBI. Now some of the notes were found missing, that the notes were not present at all in the packet that was sent to the RBI. Or let's say some notes were counterfeit notes, fake notes. The bank branch accepted fake notes. So against that also RBI will not provide any kind of incentive. So the actual soiled notes, see here you can see. So out of the total notes, 110 notes were found like to be in shortage or mutilated or counterfeit in pieces. And that's why the number of notes were counted less. That actually RBI received less. And so rather than 55 packets, RBI gave incentive only on the 53 packets. So for the soiled notes, 2 rupee per packet. So this is the idea, that this incentive will be given only on the notes that is actually received by the issue office of the RBI, not what is claimed by the bank branches. Adjudicated notes, that is the mutilated notes, if they are received along with the soiled note or sent separately by the registered or insured post in a sealed cover to the RBI, so the incentive will be given on those mutilated notes also, rupee 2 per piece. Okay. Next is the incentive for distribution of coins shall be paid on the basis of net withdrawal from the currency chest. The idea is that the incentive for distributing the coins, if the distribution of coins is happening, let's say the bank took a bank branch has taken 65 coins from the currency chest, but the bank branch has also deposited 55 coins with the currency chest. So can we say that the bank branch is increasing the distribution of coins by 65 in the economy? So 65 coins have been withdrawn from the currency chest to provide to the public, while 55 coins have been deposited in the currency chest. So in total, the net withdrawal is only of 10 coins. The net withdrawal is only of 10 coins. So the incentive for distribution of coins, the incentive that will be provided, 65 rupees per packet, per bag of coins, 65 rupees per bag of coins, and rupees 75 per bag of coins in the rural or semi-urban areas. So this incentive will be provided on the net withdrawal from the currency chest. If the banks are withdrawing, let's say 10,000 coins, 10,000 number of coins have been withdrawn from the currency chest, but the bank branches have deposited back 7,000 coins. So in total, only 3,000 coins the bank branches are distributed in the economy. So the distribution is not increasing by 10,000 that has been withdrawn, because the 7,000 was deposited back to the currency chest. So this is the idea that the incentive for distribution of coins shall be paid on the basis of net withdrawal from the currency chest. Okay, so this is the idea. Next is the currency chest holding banks shall raise invoice to the RBI for claiming the incentives. Like I have told you that the bank branches are not directly connected with the RBI in terms of the currency management. The bank branches will send the soiled notes, the mutilated notes to the currency chest. Currency chest will send it to the RBI, and the currency chest will also raise an invoice to get the incentive. So currency chest will receive the incentive. Now currency chest branch shall pass on the incentive. Currency chest branch has raised the invoice, has got the incentive for all the soiled notes, for all the mutilated notes, and the currency chest has the responsibility to transfer the incentives to the bank branches. So currency chest branch shall pass on the incentive to the linked branches for the soiled notes deposited or coins distributed or mutilated notes that have been adjudicated by them on pro rata basis on the same rate basis that the RBI is providing the incentive of. Okay, the distribution of coins shall be verified by the RBI regional offices that the coins are actually distributed amongst the public or not through the inspection of currency chest, incognito visit to branches, etc. Okay, so this is the basic idea. Any confusion? So basically, the bank branches, they are collecting the soiled notes, they are collecting the mutilated notes, they send it to the currency chest send it to the RBI and raise the invoice for the incentive. To get the incentive, RBI will provide the incentive to currency chest, and currency chest will share the incentive to the linked branches on the basis of how much soiled notes, how much of the mutilated notes have been received from a particular bank branch, how many bags of coins has been distributed by the branch, bank branch. So according to that, the incentive will be sent by the currency chest. Okay, so this is the idea. We have discussed the preliminary, we have discussed the multiple definitions for the soiled notes, currency chest, clean note policy. We have discussed the applicability, that is to all the banks. We have discussed the short title. See, the short title is basically this: the master action on incentives and penal provisions for bank branches and currency chest in respect of currency operation. This is the short title of the master direction. Okay, so first chapter is done. The second chapter, scheme of incentives, this is also what we have done. Now the third chapter, that is penalties, the scheme of penalties, that we will do in the next session, because it has multiple data points and I do not want you to get confused with the different data points. Focus on the session that I have taken today, where we have discussed the two chapters and the limits for the FPIs. In the next session, we will discuss the scheme of penalties and the penal provisions. These two chapters are important. The fifth chapter is not so important. Okay, so two chapters have been done. The two chapters will be done in the next session. So this is it. Now the Utkarsh 2029 has also been Utkarsh 2029 has also been released by the Reserve Bank of India yesterday only. I will take a session. So in the next session, we will complete this master direction, and in the coming session, that is on like Tuesday, I will take the master action on Thursday. I will take the Utkarsh 2029. Okay, this document. This is very important document. Okay, any confusion? How many coins are there in one bag? So I have shown you that there are 5,000 pieces of 50 paise coins, 2,500 pieces of 1, 2 or 5 rupee coins, 2,000 pieces of 10 or 20 rupee coins would be deemed to constitute one bag. Any confusion, anyone? Now, okay. Thank you then. Thank you for attending the session. Next, in the next session, we will also talk about the penalties. See, too much data in one session not required, or you cannot remember all of that. So right now focus on whatever has been provided, and the next two chapters we will discuss, like all the chapters, the next chapters we will discuss in the next session, but these two chapters are more important. The last one is not so important. Okay, so we will discuss it on Tuesday. We will finish it on Thursday. I will take this very important document of Utkarsh 2029. Now this is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding limits for investment in debt and sale of credit default swaps by FPIs. Which of the above statement is or are correct, that you have to inform. I hope you will be easily able to answer this question. Now coming to the second question, RBI has issued master action on the incentives for currency distribution. We have discussed the scheme for incentives. So according to that, which of the below statements is or are correct in regards to the master action? So try to answer these questions. Okay. So this is the second question. Try to answer. Now, starting with the master action, see, the RBI has formulated, and under this master action, the RBI has provided a scheme of incentives to encourage the banks for setting up requisite currency chest infrastructure and facilitating the distribution and exchange of notes and coins, so that the soiled notes can be reduced from the public domain, as well as the mutilated notes can be reduced from the public domain, and the clean notes can be provided to the public, to the members of public. Further, the RBI has also prescribed a scheme of penal interest or penalties in order to ensure that accurate and timely reporting of currency chest transactions happen with the RBI, as well as provision of proper customer service is provided to the members of public, so that the bank branches and the banks with the currency chest, they provide the proper customer service to the members of public, okay, by the currency chest branches and the ATMs of the banks. So the scheme of penal interest or penalties is applicable to all the banks in order to ensure that all the banks, they provide the accurate and timely reporting of the currency chest transactions and the provision of proper customer service to the members of public by the currency chest, by the bank branches and the ATM of banks. So this is the basic idea. Okay, now what is the currency chest? This we have already discussed in the previous session, that the currency chest, it facilitates the distribution of banknotes and rupee coins on behalf of the Reserve Bank of India. So RBI has authorized select scheduled banks to establish currency chest. Okay, so there are certain banks that are the scheduled banks, they are authorized by the Reserve Bank of India to work as the currency chest also. Okay, so they are basically the currency chest, they are basically the tijori from where the other bank branches in the nearby area, they can access the banknotes. Okay, these are storehouses. So currency chest, they are the tijori, they are the storehouses where banknotes and rupee coins are stocked on behalf of the Reserve Bank of India, because the Reserve Bank of India has the core function of currency management and maintaining the money supply in the economy. Okay, so this is the idea, that the currency chest, they are expected to distribute banknotes and rupee coins to other bank branches in their area of operation. Now we have started the session, we have started with the scheme of incentives, and we have discussed the scheme of incentives in the previous session, where we discussed the RBI scheme of incentives for the banks. Okay, so there we have discussed about the currency chest in detail, where we have discussed about the mutilated notes, the definition of the soiled notes in detail. So now let's proceed with the scheme of penal interest or penalties. Okay, so in the previous session we have already discussed the short title of the master action, as well as we have discussed that this master action is applicable from when the notification is released, as well as we have discussed the applicability of the master action, that is on all the banks. Basically, we have discussed the definitions of currency chest, mutilated notes, soiled notes, and all the other important definitions we have discussed. We have discussed the scheme of incentives. Now in today's session, first we are going to discuss about the penalties for deficiency in rendering the customer service. So starting with this, so in order So basically, in order to ensure that all bank branches, they provide proper customer service, the bank has formulated the Reserve Bank of India. Bank means the RBI has formulated a scheme of penalties for bank branches, including currency chest for deficiency in rendering customer service to the members of public. So basically, this is the scheme of penalties that we are going to discuss. So let's get started. Now the data points will be provided to you, and I will inform you that how you can keep these data points in mind, okay? So first of all, we are going to discuss the penalties for the bank branches for deficiency in rendering customer service. So for all the bank branches, these penalties will be applicable if they have any deficiency in rendering the customer service, such as below. So deficiency in service in providing the exchange facilities as dictated by the RBI officials. So if the RBI officials, they see that the bank branches, they have the deficiency in service, they are not issuing the coins to the member of public even when they have the stock of coins. If the RBI officials see that their bank branches, they are not accepting the lower denomination notes in their deposits, and they are refusing the bank branches, if they are refusing to exchange soiled or mutilated notes or imperfect notes tendered by any member of the public. So this is the idea. So if there is any deficiency in service by the bank branches, either they are not issuing the coins even if they have the stock of coins, if they are not accepting the lower denomination notes, if they are refusing to exchange the soiled notes or mutilated notes, in any of these cases, the penalty will be applied on the bank branch which is having the deficiency of service, 10,000 for any deficiency of service, and 5 lakh rupees in case there are more than 5 instances of deficiency in service by the branch in a calendar year. So in 1 year, if there are 5 instances of deficiency in service, then there will be the 5 lakh rupees that will be levied as penalty. So the levy of such penalties shall be placed in public domain. So that means public should be aware that which banks or which bank branches have been penalized. Penalty shall be levied on the immediate basis. So 10,000 rupees for any deficiency of service, but if there are more than 5 instances of deficiency in service, then 5 lakh rupees will be the penalty, okay? Now here you can see point 3. So refusal by any bank branch sees the small finance banks up to 2 years from the commencement of their banking business, and the payment banks, they may exchange mutilated or imperfect notes at their option. So that is the idea, okay? Now coming to the next point, that is counterfeit notes detected in ATM dispensations. So let's say that this ATM belongs to a particular bank, let's say XYZ. Now in the ATM, there were counterfeit notes, that means fake notes that were detected, that were found. So if the counterfeit notes are detected in the ATM dispensations or disbursement over the counter, the bank branches over the counter in their bank branches, they are disbursing the counterfeit note, or there is willful non-impounding of counterfeit notes detected at the banks. The banks, they are willingly, they are not seizing. Willfully, they are not seizing or not impounding the counterfeit notes. In any of this case, a monetary penalty of 10,000 rupees per instance shall be imposed for the counterfeit notes that is detected in the ATM dispensations, disbursement over the counter, or the willful non-seizing, non-impounding of the counterfeit notes detected at the banks. Even the white label ATM operators, that are the non-bank ATM operators, even in this case also, this same thing will be applicable. The same penalty will be applicable if there are counterfeit notes that were detected in the ATM dispensations. So the monetary penalty of 10,000 per instance will be applied. This is the idea, okay? Now coming to the next one. So we have discussed about the penalties for bank branches for deficiency in their services. Next is penalties for ATM cash out. ATM cash out is basically you went to the ATM, the ATM is working, but the cash is not available in the ATM, okay? So non-replenishment of the ATMs, that means non-replenishment of the ATMs with the cash. So there is cash out that is happening. Cash is not available in the ATM. Even though the ATM is fully functioning, there is no problem with the ATM, but still there is cash out in the ATM. So cash out at any ATM of more than 10 hours in a month. So in 1 month, if there is the cash out of more than 10 hours, this will attract a flat penalty of 10,000 per ATM. This shall also be applicable to the white label ATM operators also, that are the non-bank ATM operators. Okay, so this is the idea. So banks and white label ATM operators, they are required to submit system generated statements regarding ATM downtime caused due to non-replenishment of cash. So because of the cash out, for how many hours, for what time the ATM was down, the ATM was not functioning because the cash is not available there. Okay, so this kind of system generated statements have to be provided to the concerned RBI issue office under whose jurisdiction the ATMs are located. So basically, if a bank branch or if a bank has the ATM, or if the white label ATM operators, they have a ATM where the cash out has happened and the cash out is more than 10 hours, or the cash out is more than 10 hours in a month. So in this case, these bank branches, these white label ATM operators, they have to submit a system generated statement regarding the ATM downtime that was caused due to non-replenishment of cash. This reporting is applicable only for those ATMs where the cash out exceeds 10 hours. And this kind of statement has to be provided to the concerned RBI issue office under whose jurisdiction the ATM is located within 5 days of the following month. Okay, so this is the idea. Now coming to the penalties for deficiency in operations of currency chest. We have discussed about the penalty for deficiency in the bank branches for the customer service. Now coming to the penalties for deficiency in operations of currency chest. So these penalties will be levied particularly for the currency chest. And remember that the currency chest, they are authorized by the Reserve Bank of India for their functioning. Okay, so the bank branches, there are certain banks that can have the currency chest. So they operate their normal functioning also, they do their normal functioning also, as well as they are also handling the currency chest business, for which they earn some extra service charge also, okay, for which they earn some extra money also. Now if the RBI has authorized the currency the bank branches with the currency chest, then these bank branches, they also have to follow certain additional norms. Okay, there is the memorandum of agreement that has happened. As per that, the currency chest has to follow certain guidelines as per RBI. Okay, so now penalties for deficiency in operation of the currency chest. Basically, if there are shortages of notes in soiled note remittances, currency chest, they are sending the soiled notes to the Reserve Bank of India, so that the Reserve Bank of India can provide the clean notes against these soiled notes. Okay, because the RBI will provide the clean notes to the currency chest against the soiled notes. So now it has been found that the currency chest informed there were 1,000 soiled notes, but the RBI found that no, there are only 900 soiled notes. Okay, or the denomination is different basically. So if there is shortages of notes in the soiled note remittances that have been sent to the Reserve Bank of India, and if there are shortages of notes and coins in the currency chest balance, so currency chest balance, in the currency chest there are shortages in notes and coins. In this case, what will happen, that there will be a penalty for notes in denomination up to 50 rupees. So 50 rupees. So if there are shortages of notes in soiled note remittances, or if there are shortages of notes and coins in currency chest balance, so for notes in denomination up to 50 rupees, if they are lacking, or if there are shortages in the denomination up to 50 rupees, so 50 rupees per piece, this will be the penalty plus the loss that has happened. So let's say 10 rupee notes, they have been lost, plus so the 10 rupee is the loss amount and the 50 rupees the penalty. So this much, 60 rupees, let's say, the bank will, the currency chest will have to provide to the Reserve Bank of India. So this is the idea, that for notes in denomination of 100 rupee and above. See this example, that for notes in denomination of 100 rupee and above, in this case, the equal of the value of denomination per piece in addition to the loss. So loss, let's say loss has happened of the 100 rupee note, and the penalty is also 100 rupees. Okay, loss has happened for 200 rupee note and the penalty is rupee 100, is 200. So this is the idea, equal to the value for notes in denomination of 100 rupee and above, equal to the value of denomination. The penalty will be equal. The penalty will be equal to the denomination, as well as loss amount has to be paid. So here the example is given, shortage of 200 pieces. 200 pieces of rupees 20, they are missing. So that means this is the loss value, this is the loss that has happened. So loss amount has to be paid by the bank, as well as the penalty for each piece. For each piece, the penalty of rupees 50 for each piece, for each 200 piece. So this much has to be paid. So this is the recovery or credit, recovery of loss. So 20 rupee 200 pieces have been lost. So this is the loss that has happened, and this has to be recovered by the RBI from the banks, and the penalty amount is 50 rupees for per piece. This is the idea. So I hope this is very much clear that for notes in denomination up to rupees 50 per piece, this is the penalty plus the note denomination. This has to be paid. Okay, the loss has to be covered. Okay, for notes in denomination of 100 rupee and above, so whatever is the loss, so that has to be recovered, and whatever is the denomination, let's say 100 rupees is the denomination, so that has to be recovered, plus the same penalty will also be levied per piece. This is the idea. Now for coins in all denomination equal to the value of the denomination per piece in addition to the loss, so let's say the 10 rupee coin is missing, plus the equal amount of penalty will also be applied. Okay, same as denomination. So for the coins, if they are in shortage in the currency chest balance, so equal the penalty will be equal to the denomination, as well as the loss has to be recovered from the bank. So the recovery of loss and levy of penalty shall be done immediately on detection of shortage, irrespective of number of pieces. Now here penalty as above. Let's say that there are shortages of 100 rupee notes by 5, but there is excess of 200 rupee notes by 2. So it has been found that okay, the loss has been recovered to some extent, that 500 rupee is the loss that happened because of the shortage of 100 rupee note by 5 numbers. So 5 pieces of 100 rupee note, they are in loss, so or they are in shortage, so that means 500 rupee is in shortage. The excess rupee 200 rupee note is in excess by 2, so that means 400 rupees is in excess. So that means the loss is somewhat recovered, and only 100 rupees is actually the loss, actual loss that has happened. So the value of excess shall be adjusted against the loss amount at the time of recovery, but the penalty will be applied on all the notes that have been lost, that have been in shortage. So basically usually what happens, that the loss amount has to be recovered as well as penalty is applied. Okay, the loss amount has to be recovered and the penalty is applied. So the RBI recovers the loss amount as well as penalty is applied. But in case the excess notes are available, so against the excess notes the loss will be recovered, but the penalty will still be applied. So if 5 notes have been in shortage for the 100 rupee notes, so for them the penalty will still be applied even though the loss has been recovered through the excess notes. This is the basic idea. Okay, any confusion, anyone? Next is, so here we have discussed the basic idea. Read it once again so that you can keep the important information in mind. For notes in denomination up to 50 rupees, the penalty is 50 rupees per piece in addition to the loss. Loss is always the denomination of the currency or the banknote that has been lost. Okay, so the for notes in denomination of 100 rupee and above equal to the value, the penalty is equal to the value of the denomination per piece in addition to the loss that has been happened. Now next is counterfeit notes detected in soiled note remittances. That means currency chests are sending the soiled notes to the RBI for their replacement with the clean notes, but it has been found that certain soiled notes, they are counterfeit fake notes. So if the counterfeit notes are in denomination of 5 rupee, 10 rupee, 20 rupee, then there is no penalty that is levied, only the loss is recovered. That means if the fake note, if the counterfeit note is of rupees 5 in 10 pieces, so rupees 50, that is the loss that will be recovered by the RBI from the currency chest. So recovery of loss to the extent of notional value, that is the face value of counterfeit note. So there is no penalty, there is no separate penalty, only the loss will be recovered by the Reserve Bank of India. Okay, denomination of 50 rupees, so a penalty of 50%. So in the case of denomination of 50 rupees, a penalty of 50% of face value. Let's say 50 rupee, there were 50 rupee one note that was missing. So penalty will be 50% of the face value of the note plus the loss has to be recovered. That means the 50 rupee this has to be recovered. Okay, so this is the idea. A penalty of 50% of the face value of the counterfeit note in addition to the extent of recovery of the face value of counterfeit note. So 50% of face value, this is the penalty, plus the 50 rupee, this is the recovery of loss. Similarly, denomination of 100 rupee and above, in this case there will be a graded penalty. Okay, 100% of the notional value will be the penalty, or the 150% or 200%. So there will be a graded penalty on the basis that how many counterfeit notes, how many fake notes have been found in the per million pieces of soiled notes. So per million pieces of soiled notes, in the per million pieces of soil notes, if there are counterfeit notes per million pieces of soil notes, it is less than 5. So 100% of the penalty will be levied. 100% of the face value of the counterfeit note, this will be the penalty that will be levied in addition to the recovery of loss. That is basically the face value only. Okay, if let's say in the currency per million, in the counterfeit notes per million of the soil notes, they are more than 5 but less than 20. So in this case, 150% of the face value, this will be the penalty. In addition, the recovery of loss the RBI will do. The RBI will get the money of the face value also. Okay, so this is the idea. So if the denomination of 100 rupee and above, these are the counterfeit notes that are detected in the soiled note remittances. So a graded penalty will be levied on the basis of the counterfeit notes that have been found per million pieces of soiled notes. Okay, so RBI will be recovering the loss. RBI will be recovering the loss that, okay, 100 rupee was counterfeit note. So 100 rupee, this is the recovery of loss, plus penalty has to be paid for the counterfeit note. That will be, let's say one piece has only been found in the counterfeit per million soil notes. So that is the counterfeit notes per million is less than 5. So 100% of the notional value of the face value, that is 100% of rupee 100. This is the idea. So penalty is 100% of notional value, face value of the counterfeit notes. If the counterfeit notes per million is more than 5 or equal to 5 or more than 5 and less than 20. So in this case, 150% of the notional value of the counterfeit notes, this is the penalty. Counterfeit notes per million is more than or equal to 20. So 200% of notional value, 200% of the face value, 200% of the face value, this is the penalty, plus the recovery of loss in addition to the recovery of notional value, face value of the counterfeit notes. This will also be done. Got it? When the notes have been found, immediately, like it was written here also, na, the recovery of loss and levy of penalty shall be done immediately on the detection of shortage irrespective of number of pieces. Okay, so when the detection has happened, as soon as the detection has happened that, okay, counterfeit notes are there in the soil note remittances done by the currency chest, so currency chest is sending the soil notes to get the clean notes from the Reserve Bank of India, but there are certain counterfeit notes that have been found. If the counterfeit notes are of small value, so they are difficult to identify also, and that's why the RBI is saying that, okay, there will be no penalty, but you will have to, the currency chest will have to pay the recovery of loss. Okay, the currency chest will have to pay for the denomination of the notes that have been lost. For the denomination of 50 rupees, there will be a penalty of 50% of the face value of the note plus the face value of the note separately. So if the note is of 50 rupees, the face value plus 50% of face value, 50% of 50 rupees, that is 25 rupees. But if the denomination is of 100 rupee and above, the counterfeit note should have been identified, and in this case the penalty is levied, and with that there is the recovery of face value that should also happen. So recovery of face value should happen, plus there is some penalty that is also levied, and this is a graded penalty as it keeps on increasing with the number of counterfeit notes per million soil notes. Now coming to the next one. Counterfeit notes detected in currency chest balance during inspection or audit by RBI. So if the counterfeit notes have been detected in the currency chest balance, that means in the currency chest, in the vault, if it has been identified that there are certain counterfeit notes that have been found. In this case, if the counterfeit notes are of denomination of small value, 5, 10 or 20 rupees, then there is no penalty that is levied, only the recovery of loss to the extent of face value of the counterfeit note. Okay, but if the counterfeit notes in the balance of the currency chest, if the counterfeit notes are of denomination of 50, so penalty of 50% of the face value of the counterfeit notes in addition to the extent of recovery of the face value. So again, the same thing, that 50% of the face value, this is the penalty, and the recovery of loss will be equal to the denomination of the note that has been lost. Denomination of 100 rupee and above, so a penalty at 200%. So directly here there is no grading or such. If the counterfeit note has been detected in the currency chest balance, directly a penalty of 200% of notional value. So penalty of 200% of the face value of the counterfeit note in addition to the recovery of loss of the face value, if the denomination is 100 rupee and above. Okay, next is mutilated notes, including deliberately cut notes and built up notes detected in soiled note remittances and currency chest balances. So if the mutilated notes, they have been found, currency chest is sending the soiled notes to the RBI. In the soiled notes, if the mutilated notes have been identified, or if in the currency chest vault the soiled note, the mutilated notes have been found. So in the currency chest balances, in the currency chest vault, or if in the soiled note remittances the mutilated notes have been found, so 50 rupee per piece, irrespective of the denomination, in addition to the loss. So 50 rupees per piece, this will be the penalty plus the recovery of loss, or in addition to the loss. Okay, so this is the idea. For the mutilated notes, if they are found in the SNRs, in the soil note remittances and the currency chest balances, so 50 rupee per piece, this will be the penalty. Directly in the amount terms, penalty has been given, no denomination, no face value here. Directly 50 rupees will be the penalty plus the, in addition to the loss of the mutilated note or whatever denomination the mutilated note was in. Okay, so this is the idea. Recovery of loss and levy of penalty shall be done immediately on detection, irrespective of the number of pieces. Next is non-compliance with the operational guidelines by the currency chest. I have told you that the currency chest, they have been authorized by the Reserve Bank of India. So there are certain proper guidelines for the currency chest to be followed. Non-compliance with the operational guidelines by the currency chest detected by the RBI officials, that means there is non-functioning. Currency chest, it is the vault that is carrying the money of the Reserve Bank of India. It is carrying huge amount of money that has to be sent to the different bank branches. You can understand that if the CCTV is not working, if the operational guidelines are not being followed by the currency chest, that means it can be a major loss that can be seen in the long term if there is any attack or something that happens. Okay, so non-functioning of CCTV, non-compliance with the rules guidelines pertaining to CCTV, branch, cash or documents kept in strong room, that is currency chest vault. I have told you that the bank branch, it has been authorized by the Reserve Bank of India. So the bank has been authorized by the Reserve Bank of India to work as the currency chest. But the bank is also providing loans. It is also taking the deposits from the public. So currency chest operations should be separately done from the loans and the deposits and the other functions of the bank. Now, if certain documents of the bank branch, they have been found in the currency chest, that should not be there. So bank branch cash or documents without having the proper records, if they have been kept in the strong room in the currency chest vault, so that is wrong. Okay, non-utilization of the note sorting machines, you must have seen if you have gone to the bank branch to deposit your money, there is a note sorting machines. Okay, for sorting out the notes. Non-updation of note sorting machines, if they have not been updated as per prescribed standards, then also this is non-compliance by the currency chest. Okay, non-conduct of surprise verification of currency chest balances at bi-monthly intervals by officials unconnected with the operation of currency chest. So it has been laid down in the operational guidelines by the currency chest of the Reserve Bank of India. So in the operational guidelines of the currency chest, it has been laid down that the bank members or the bank employees of the different branch or of the same branch that are not connected with the operations of the currency chest, they must conduct the surprise verification of the currency chest balances. If the surprise verification is not happening, this is also non-compliance. So if in any case there is non-compliance with the operational guidelines by the currency chest, penalty of 5,000 for each instance of penalty shall be enhanced to 10,000 in case of repetition or recurrence of irregularity in consecutive inspection cycles or earlier. Penalty shall be levied immediately. Now next is violation of any terms of agreement with the Reserve Bank of India. I have told you that the currency chest, they sign a memorandum of agreement with the Reserve Bank of India as they are holding the money of the Reserve Bank of India. So violation of any terms of agreement with RBI for opening and maintaining the currency chest as detected by the RBI officials in their inspection, or denial of facilities or services linked to the linked branches. So currency chest has the responsibility to provide the banknotes and provide the coins as per the requirement of the bank branches that are linked with the currency chest. So this comes under the linkage scheme, where the different bank branches of an area, they are linked with the currency chest. If the currency chest has denied the facilities or services to linked branches of other banks, so this is a violation. Detection of by RBI of mutilated build-up counterfeit notes in reissuable packets prepared by the currency chest branches to further issue it in the public. So in this case also, this is a violation of terms and conditions with the RBI. So 10,000 for any violation of the terms of agreement, and 5 lakh rupees in case there are more than 5 instances of violation of terms of agreement by the currency chest. Any confusion here? Next. So this is any confusion? So we have discussed the third chapter also. Now moving forward with the fourth chapter. So just the basic idea you need in the fourth chapter, important points we'll be discussing. Any confusion, anyone? No confusion? Chalo. So penal provisions. Now we are going to discuss the penal provisions in reporting of transactions or balances. Till now we have discussed the penalties for the bank branches for deficiency in rendering customer service, or penalties for ATM cash out, or penalties for deficiency in operations of currency chest. Now we will discuss that what are the penal provisions in reporting of transactions or balances. So in the reporting with the RBI, if there is delay that is happening, if there is any misconduct that is happening, so how that will be penalized. So let's understand this. So penal provisions for reporting of transactions or balances at the currency chest. So reporting procedure and all we are going to discuss. Next, minimum transaction amount. First of all, the minimum amount of deposit into or withdrawal from currency chest shall be 50,000. So the linked bank branches that are linked with the currency chest, they can deposit their money with the currency chest, or they can withdraw the money from the currency chest. The minimum amount of deposit or withdrawal from currency chest shall be 50,000, and thereafter in multiples of 10,000. Okay. Reporting timelines. The currency chest shall invariably report all the transactions through the currency management currency chest portal on the same day by 7 p.m. That means on the daily basis. On the daily basis, the reporting has to happen to the Reserve Bank of India. So the currency chest shall invariably report all transactions that has happened in one day from the currency chest through the currency management currency chest portal on the same day by 7 p.m. Okay. Now, currency chest reporting in currency management currency chest portal on Sundays or holidays, in case currency management currency chest portal is available on the specific day when the currency chest is working, is operating on a local holiday, let's say, the currency chest shall report the transactions through the portal on the same day by 7 p.m. Let's say that this is a nationwide holiday. The nationwide holiday is happening, global holiday is happening, second or fourth Saturdays of the month or Sunday, in which the currency chest portal is not working, is not available on the said day. In this case, the currency chest shall report the denomination wise consolidated deposit withdrawal by 7 p.m. to the concerned issue office of the Reserve Bank of India through email, and report day's transactions in currency management currency chest portal on the next working day. That means on the daily basis, anyhow the currency chest has to provide the reporting. If the currency management currency chest portal is not available, then the mail has to be sent to the concerned issue office of the Reserve Bank of India on the same day by 7 p.m. and by the next day the update should happen in the portal. Okay, so this is the idea. Next, under the business continuity plan, basically it has been said that let's say that because of any connectivity issue or technical issue, because there are currency chests in the hilly areas, in the far off areas, so if the currency chest is facing any connectivity or technical issues, in this case the bank's back office, so the currency chest is belonging to a bank, let's say State Bank of India. So the bank's back office, the State Bank of India back office administrator can temporarily map the user ID of another currency chest with the same bank to carry out transactions on its behalf. That means the currency chest. Now the State Bank of India has been authorized by the Reserve Bank of India to carry out currency chest operations, or the SBI has been authorized with the currency chest operations. Okay, so State Bank of India has a bank branch in Northeast, that is a currency chest, and the State Bank of India has a bank branch in Gujarat, let's say, with the currency chest. So it can be done that if a currency chest is facing connectivity or technical issues, the bank's back office administrator can temporarily map the user ID of another currency chest with the same bank to carry out transactions, so that the Gujarat bank branch currency chest can operate on behalf of the Northeast, or not Gujarat because it is very far off. So let's say in Sikkim, the issue is coming. So from Assam or from the local area, if in the Sikkim in a particular area the issue is coming, so from another area of Sikkim the issue can be handled. Okay, so this is the idea. So this is the business continuity plan that has to be provided. So under the business continuity plan, the RBI allows flexibility in using the currency management currency chest portal. Okay, so now let's continue. So next is nature of irregularity. Okay, I hope this is clear. If there is any problem, if there is any issue, kindly inform me so that I can clarify. Under the business continuity plan, the RBI allows flexibility in using the currency management currency chest portal to ensure uninterrupted reporting by the currency chest. So if a currency chest is facing issue, so from the same bank, the another currency chest can carry out the transactions on its behalf. Once the transactions are completed, access rights must be restored to the original currency chest. That is the idea. Now coming to the next one, delayed or wrong reporting of the currency chest transaction. If there is a delayed reporting or wrong reporting, in such event of the delayed or wrong reporting currency chest transactions, penal interest at the rate of 2% plus the bank rate. So this is, the bank rate is currently I think 5.5%. So whatever is the bank rate plus 2%, this is the penal interest rate. This is the penal interest. Okay, so in the event of delayed or wrong reporting the currency chest transactions, the penal interest at the rate of 2% over the prevailing bank rate shall be levied on the amount that is due from the currency chest for the period of delay or till the date of receipt of corrected advice by the Reserve Bank. So basically, if there is any delay or wrong reporting that is happening, the currency chest has to provide bank rate plus 2% of the penal interest rate. Okay, the interest shall be calculated on the day the transaction has happened and the reporting has not. This is the idea. Now next is penal provisions for reporting for levy of penalty. Okay, so soil note remittances, if they are sent to RBI, they shall not be shown as withdrawal from the currency chest. So if the withdrawal is happening from the currency chest, so that means the actual money has been withdrawn. Okay, so withdrawal by currency chest, so it shows that the amount has been withdrawn, the new banknotes have been withdrawn. Okay, so the soil note remittances, they shall never be shown as withdrawal by the currency chest, because the currency chest, when the withdrawal is happening, that is basically from the currency chest, new banknotes are being withdrawn by the bank branches. Okay, so that is withdrawal from the currency chest. From the currency chest, the bank branches are withdrawing the money. But in the case of the soil note remittances that the currency chest is sending to the Reserve Bank of India, if the currency chest is sending the soil note to the Reserve Bank of India, this is not withdrawal from the currency chest vaults. Okay, so soil note remittances sent to RBI shall not be shown as withdrawal by the currency chest, as this is not withdrawal by the bank branches from the currency chest. In such case, if the reporting of soil note remittances to RBI is shown as the withdrawal from the currency chest, a flat penalty of 50,000 shall be levied irrespective of the amount that was involved. Okay. Next is reporting of diversions. Diversions usually happen when the currency chest, they are leading to cash, like cash transfers. Okay, so diversion is basically the transfer of cash from one currency chest to another currency chest in need. So to maintain the regional balance and to handle the regional imbalances, if the currency chest requires more money, so from one currency chest the cash can be transferred to another currency chest also. So all the currency chest diversions of the cash transfer, both between the currency chest of the same bank or between the currency chest of the different banks, they have to be reported through the diversion module of the currency management currency chest portal, that from this currency chest the money has been sent to another currency chest. Okay, from the Sikkim currency chest the money has been sent to the Assam currency chest, or from the local region, from one local region of the Sikkim currency chest, the money has been sent to the another local region 2 of the Sikkim. Okay, so this is the idea, that if the currency chest, if divergence is happening, if the transfer of cash is happening, so that has to be reported properly. The currency chest sending the diversion should initiate the entry, and receiving currency chest should acknowledge the same. Diversion should not be reported as deposit or withdrawal, and in any case of any such wrong reporting, see, the money is just being transferred from one currency chest to another currency chest. The bank branches are neither depositing the money, the other bank branches, the linked bank branches, they are not depositing their money. The bank branches, they are not withdrawing the money. So actually from the currency vault, the money is not being transferred to the linked bank branches. Just from one currency chest, the money is being transferred to another currency chest. Okay, so in case of such diversions, currency chest diversions, in case of the cash transfer to the another currency chest, it has to be reported as a diversion only. It has to be reported as diversion only. It cannot be reported as deposit or withdrawal. But if the reporting of diversion is happening as deposit or withdrawal, a flat penalty of 50,000 will be levied. Okay, this is the idea. Now coming to the last point, that is delayed reporting where currency chest had net deposit. Let's say there is delayed reporting or wrong reporting where the currency chest transaction, see, if the delayed reporting is happening or the wrong reporting is happening, the bank rate plus 2%, this is the penal interest that is levied. Okay, in the case delayed reporting is happening where the currency chest has net withdrawal from the currency chest, the money has been taken out, and then there is a delayed reporting from the currency chest, the bank branches have taken, the other bank branches, the linked bank branches has taken the money, so there is net withdrawal, the amount has been withdrawn in the net amount from the currency chest. In this case, if the delayed reporting is happening, then the penal provisions will be levied, bank rate plus 2%. But let's say the delayed reporting is happening, the delayed reporting of currency chest transaction where currency chest had net deposit. They actually have got more deposits, more money from the bank branches. From the linked bank branches, the currency chest has got the net deposits. In this case, the penal interest rate will not be allowed, will not be carried forwards. So in the case, the delay is happening in the reporting, but the net deposit, the delay of the reporting has happened, but there is the net deposit. Okay, so in this case, there will be a flat penalty of 50,000 rather than having the bank rate plus 2% of the penal interest rate. There will be a flat penalty of 50,000. So if there is a delayed reporting of currency chest transaction where currency chest had net deposit, had more money from the bank branches, a flat penalty of 50,000 rather than bank rate plus 2%. This is the idea. Now coming to the last points, operational guidelines. This is your last chapter, last point from this article. Kashish, I will answer. Akshu, I will answer when the topic finishes. Okay, it is just going to finish. So operation guidelines, competent authority, the officer in charge of the issue department of the regional office of the Reserve Bank of India, under whose jurisdiction the defaulting currency chest, bank branch, ATM is located, is the competent authority to determine the nature of the irregularity and impose the applicable penalty. Okay, so competent authority will be penalizing or will be imposing the applicable penalty. The controlling office of the currency chest or bank branch may appeal against the decision of the competent authority to the regional. So there is the right that is given to the currency chest to the bank branch to appeal against the decision of the competent authority. So the controlling office of the currency chest or the bank branch may appeal against the decision of the competent authority to the regional director or chief general manager or the officer in charge of the regional office concerned. Within 1 month the appeal has to happen. Okay, now the appeal should not be done. The appeals should not be done. Let's say that okay, the staff was lacking, the staff was new. In such cases the appeal should not be done, because if your staff is lacking, then it is your responsibility to train them. If the staff is new, then you should have trained them better. So RBI has basically said that appeals for waiver of penalty made on grounds such as staff being new, untrained, lack of awareness, corrective action have been taken or shall be taken, shall not be considered. The RBI will not be considering such kind of appeals. Appeals will only be considered, appellate authority will only consider such appeals where the representations are on account of genuine difficulties faced by currency chest, especially in the hilly or remote areas and those affected by the natural calamities. Then you are saying that the cash out happened in the ATM, that was a genuine reason. Natural calamity has happened, no ATMs can be filled at that point of time. Or let's say there is a reporting delay that has happened because of the natural calamity. So yes, that is a genuine reason. So only for the genuine reasons the appeal can be made, not for such kind of reasons. Okay, so this is the idea. Now what are the questions? Do we have to remember all the number? We have to cram everything. See, I will suggest you some points that how you can remember the data. In the case of penalty for bank branches, 10,000 is the main data that you have to remember, and the 5 lakh. Okay. Next, when it comes to the ATM cash out, 10,000 is the data. Okay. Then when it comes to the nature of irregularity and shortage of notes in soiled note remittances and coins, so you have to remember the important points that okay, 50 rupee per piece in addition to the loss, or for notes in denomination of 100 rupees equal to the value of the denomination. Okay, this is the penalty plus the loss. So these kind of important data you have to remember. This is same as this one, just in the 100 and above. Here the penalty at 200%, this is the flat, but here there is the graded penalty. So counterfeit notes detected in soiled note remittances and the counterfeit notes detected in currency chest balance, so they are mostly the same. Mutilated notes, flat 50 rupees penalty plus the loss that has happened. So here 10,000 rupees, 10,000 rupees, 5,000 rupees. So these are the important data that you have to remember. At one go, when you are just studying this, the data might seem very difficult, but if you read it twice, you will see that okay, the data is recurring in nature and you are able to remember it easily because the data is recurring. Okay, so that is the important idea. Again, for the penal interest, it is bank rate plus 2%, and the penal interest usually is kept by the RBI, bank rate plus 2%. If we are talking about the penalty, not penal interest, if we are talking about the penalty, that is 50,000. Okay, so these are the important data that you will have to remember. Chalo. Now this is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding the penalties for deficiency in customer service. A penalty of 10,000 per instance is imposed for deficiency in customer service. A penalty of 5 lakh is imposed if there are more than 5 instances in a year. Penalty is imposed only if ATM remains out of cash for more than 24 hours in a month. So which of the above statement is or are correct, that you have to tell. Okay. Next question is regarding counterfeit of 100 rupee notes are found in remittances sent by a bank to RBI, sent by the currency chest bank branch to RBI, and the counterfeit notes per million is 25. What penalty applies? Okay. So here the counterfeit notes per million is more than 20. So what penalty will apply, that you have to tell. Hours. So now let's start with the topic. Okay, nice. So Utkarsh 2029, see, this is the medium-term strategy framework of the Reserve Bank of India. Here the RBI is not releasing the guidelines for the banks. Here the RBI is not releasing the guidelines for the regulated entities. Here the RBI is releasing the strategic pillars that RBI will be following. So basically this is the document of the RBI for its own guidance. Okay. So the Utkarsh 2029, this is the medium term strategy framework where the RBI lays down, where the RBI communicates the strategic priorities of the RBI, as well as the focus areas that the RBI will be focusing on, as well as the deliverables that RBI will be pursuing. Okay, the deliverables that the RBI will be delivering and will be pursuing. So this is the idea that the Utkarsh 2029, it lays down the strategic priorities of the Reserve Bank of India, where the RBI is prioritizing the focus areas of the RBI and the deliverables that the RBI will be focusing on, that the RBI will be pursuing. So what are the deliverables? What are the focus areas? What are the strategic priorities that we are going to discuss one by one? But this Utkarsh 2029, this document is for the Reserve Bank of India, where the RBI is internalizing and RBI is focusing on itself and what priorities it has to focus on, what areas it has to focus on. Okay, so this is the idea. Now, the Reserve Bank of India had first formulated its medium-term strategy framework, Utkarsh 2022, in July 2019, replacing its annual action plans. So before 2019, there were annual action plans in which RBI used to lay down that, okay, what action the RBI should be taking on the annual basis. This year, what action RBI should be taking. Now you have to understand that the annual action plans, they were for the short period, they were only for one financial year, so they were insufficient to pursue strategic objectives that used to take time. That's why the RBI thought that rather than following the annual action plans, the RBI will be formulating the medium term strategy framework that provides RBI the 3-year timeline, so that the RBI can focus on the strategic priorities, the focus areas, and the RBI can pursue the different deliverables in this time period. Okay, so this is the idea. The first framework was the Utkarsh 2022 for the time period of 2019 to 2022. Then second framework was Utkarsh 2.0, that was for the time period of 2023 to 2025. Now the third framework that is recently released by the RBI is the Utkarsh 2029, that is for the time period 2026 till 2029. And here we are talking about the financial year, that is from April 2026 till March 2029. So Utkarsh 2029, this is the framework for the 3 financial year time period, okay, for the medium term. So this is the medium term strategy framework. Here we are not focusing on only the 1-year timeline. Here we are not focusing on the 10-year timeline. Here we are focusing on the 3 years, that is the medium term, where the RBI will be focusing on its priorities, the focus areas, and the deliverables that it want to pursue. Okay, so the RBI had first formulated its medium term strategy framework in July 2019. Now, continuing the previous 2 frameworks, the Utkarsh 2029 has been released, and this Utkarsh 2029, this communicates the medium-term strategic priorities of the Reserve Bank of India, where the RBI will be focusing on over a 3-year time horizon, that is financial year 2026 to financial year 2026 to 29. Okay, that is from April 2026 till March 2029. So this is the idea. Now, any confusion till now? Okay, so spanning 3 years from April 2026 to March 2029, Utkarsh 2029 lays down the foundation for the following long-term deliverables. So remember that the Utkarsh 2029, it is for a 3-year time period from April 2026 to March 2029. The Utkarsh 2029, it lays down the foundation. So this document, it lays down the foundation for the long-term deliverables that the RBI is pursuing, that is the Project Samudra, for modernizing the currency management system of the Reserve Bank of India. The RBI has a core function, that is currency management. So currency management is the core function, one of the core function of the RBI. So Project Samudra is for modernizing the currency management system, expanding the CBDC, that is the central bank digital currency, for supporting the cross-border payments efficiently, scaling up the ULI, that is the unified lending interface. How many of you are aware about the ULI? Anyone? Any idea about ULI? You must have heard about the UPI that we all use, the Unified Payment Interface. You must use it directly, or at least you must have seen your friends using the UPI, right? So we all know about the UPI, but what is this ULI? ULI is the Unified Lending Interface. Okay, so that means that all the banks will be lending together? No, actually what happens that usually the rural and the micro, small and medium enterprises, they find it very difficult to take loans, as they have to deposit, as they have to deliver various documents. Okay, so rural and the micro and smaller medium enterprises, the rural agriculture laborers or the farmers and the micro and small and medium enterprise borrowers, they face long delays, extensive documentation. They have to, like, let's say in the case of agriculture, the land records are required. Let's say the yield data is required from the different departments, government departments, or the existing loans if the farmer has taken the loans, or what deposits the farmer has. So all of the data is required. Okay, the income statements are required and such. So a lot of data is required, a lot of documents are required. So that is very difficult to garner, or that is very difficult to gather, or it can take a lot of time. So that's why the ULI has been released. Now this ULI, it is built on India's digital infrastructure. It is connecting securely to government databases, satellite imagery, and financial data sources through secure RBI backed infrastructure. So ULI is very, very important as it is connecting securely to the government databases, satellite imagery, financial data sources, and such. So that from the different sources, the documents can be taken easily. Okay, so this is the idea, that from state land records department, or from the tax department, from the like utility records if they are required, if the utility bills are required. So from different departments, from different government departments, from the different financial data sources, the data can be easily taken through the ULI that is built on the India's digital infrastructure, that is connecting securely the to the government databases, to the financial data sources. Okay, so through the ULI, there is the easy connection that can be done with the government databases with the financial data sources. And there is the plug and play model that is followed under the ULI. That means the banks, the lenders, the NBFCs, basically, they can connect, they can plug into the ULI, and they can connect, and through that they can connect to the multiple data sources, to the multiple financial data sources. So rather than connecting with the state land record department, rather than connecting with the tax department, rather than connecting with the utility records, multiple like let's say telephone department, or rather than connecting with the telegram department, and so departments, or rather than connecting with so many of the financial institutions, the banks, the NBFCs, they just have to plug into the ULI, which is already connected to data sources, multiple data sources. Okay, so this is the plug and play model, that is you just have to plug into the ULI that is providing the connection with the government databases and the financial data sources, and it will make it very easier for the lenders, very easy for the banks and the NBFCs to gather the documents, to take the documents directly, and it will expedite, it will make the process faster. So this is the whole idea of the ULI. Any confusion, anyone? So cut lending cost by 60%. This is given in the website of RBIH. I hope you have heard about the RBIH. It is the wholly owned subsidiary of the Reserve Bank of India. So Reserve Bank Innovation Hub, in its website, this data points are given that with the ULI, it will cut lending cost by 60%, reduce loan processing from weeks to only minutes, with automated verification, real-time data access, and standardized APIs that handle everything from the KYC to the property search. So this is the idea of the ULI, that is the unified lending interface. Before, the data had to be collected from multiple sources. The documentation used to take a lot of time, but now through the ULI, that is built on the India's digital infrastructure, there will be easy connection with the government databases, with the financial data sources. So the lenders will be easily able to gather the documents that the lenders need. Okay, or the borrowers will be able to give the consent, and the lenders will be able to get the documents easily. It will increase, or it will boost the credit appraisal, and the time will be reduced. Okay, so credit appraisal will happen faster, more efficiently, and the credit appraisal time will reduce significantly. So quicker turnaround, minimal documentation from the borrowers, as directly the lenders will be connected with the ULI, fulfilling unmet credit demand. That is the idea. So scaling up ULI, this is a major focus area of the Reserve Bank of India for the inclusive credit delivery, so that the rural borrowers, the farmers, the agricultural laborers and such, as well as the MSMEs, that is the micro, small and medium enterprises, they can easily get the loans with the proper documents. Okay, developing frameworks for use of emerging technologies such as AI and quantum in our financial sector. So this is the idea that under the Utkarsh 2029, the focus is also given to developing the frameworks for use of emerging technologies such as the artificial intelligence and the quantum in the financial sector, and other focus areas are also there. So this is the important idea that I hope you have understood. Now Utkarsh 2029, it is focusing on the long-term deliverables, as well as it is also continuing the long-term deliverables for which the foundation was laid in the previous Utkarsh 2.0. So internationalization of INR that initiated or that was focus area in the Utkarsh 2.0. So that is also focused under the Utkarsh 2029, UPI to revolutionize the cross-border payments. So this was the focus area under the Utkarsh 2.0. This is also the focus area under the Utkarsh 2029. Okay, so Utkarsh 29 has certain particular areas where it is focusing, like the project Samudra, expanding CBDC for the cross-border payments, scaling up the ULI, developing the frameworks for the emerging technologies, for the use of emerging technologies, as well as Utkarsh 2029 is also focusing on continuing the long-term deliverables for which the foundation has already been laid, such as the internationalization of the INR and UPI to revolutionize cross-border payments. Now, coming to the Utkarsh 2029 structure and vision. Okay, so what is the structure of Utkarsh 2029? So basically, Utkarsh 2029 has been fine-tuned into a 3-layered structure consisting of 6 strategy pillars. So there are 6 strategy pillars. Now these strategy pillars, they are guided by the vision and the values. And under these 6 strategy pillars, there are the deliverables that RBI will be focusing on. Okay. So now vision statement, now 6 strategy pillars. What are the 6 strategy pillars? What are the values, the deliverables? All of this we will be discussing, but let's first start with the vision, the first step. Okay, the vision statement of the Utkarsh 2029 is basically continue excellence. What is the meaning of Utkarsh? Anyone has any idea? Utkarsh in Sanskrit means excellence. Okay, Utkarsh in Sanskrit means excellence, and that is what RBI is pursuing. Okay, so vision statement of the Utkarsh 2029, it focuses on continue excellence while enabling a stable, inclusive and technologically robust financial system. So this is the vision of Utkarsh 2029. Remember it very clearly. Continue excellence, because Utkarsh means is excellence, while enabling a stable financial system we want. Inclusion is a main point, and technologically robust. RBI is continuously focusing on innovations and the technological advancement. Okay, so continue, very easy now. Continue excellence while enabling stable, inclusive and technologically robust financial system. That's it. Okay, so this is the idea, this is the vision of the RBI of the Utkarsh 2029. Now coming to the values, next step is to discuss the values. What do you think? What are the values? Can anyone tell me what can be the values of the Reserve Bank of India? Like we have certain values that, okay, we should not steal, we should not harm anyone, we should not disrespect anyone without any poking and such. So we should not directly disrespect someone. So these are certain values that the people follow. What are the values of the RBI as an organization? RBI focuses on public interest. RBI also focuses on innovation. RBI also focuses on integrity and independence. Whenever you think about the RBI, you know that it is an independent body, from the sense that, okay, the RBI takes the decisions independently to control the inflation and such. So integrity and independence. So there are certain values, there are 5 values that are 5 values of RBI that are mentioned under the Utkarsh 2029. Okay, public interest. So RBI ensures public interest by following customer-centric approach. Integrity and independence. RBI maintains highest standards of integrity and independence and foster trust by sustaining transparency and accountability. Okay. So RBI is one of the organization in the country which actually follows the standards, which actually follows the integrity and independence, responsiveness and innovation. So RBI is agile and it is responsive to changing technological requirements of the financial ecosystem. Diversity and inclusiveness. So RBI promotes diversity and inclusion in all its activities, introspection and pursuit of excellence. So this is, again, excellence is a key term in the whole Utkarsh 2029. Introspection, that we will discuss in the coming slides also, that RBI is actually introspecting. RBI is actually trying to improve its own operations. So RBI pursue professional excellence and stay committed to continuous self-appraisal. Okay. So this is the idea. So the values are public interest, integrity and independence, responsiveness and innovation, diversity and inclusiveness, introspection and pursuit of excellence. So these are the values of the RBI that RBI follow. I hope you will be able to remember this. Okay. And where Utkarsh 2029 is covered in the course, that also I will show you. It has already been covered, so I will show you it. Utkarsh 2029, it pursues the values of Utkarsh 2029 and the Utkarsh 2.0. So in the Utkarsh 2022, the Utkarsh 2.0, these same values were laid down, and the Utkarsh 2029 also pursues the same values. Okay, so this is the idea. Now, coming to the strategy pillars, as I've told you that there are 6 strategy pillars. So the strategy pillars of Utkarsh 2029 and its focus areas. So what are the strategy pillars? What are the priorities of the RBI? Think about it. What are the priorities of the RBI? Robust regulations, because RBI is the RBI is the regulating authority. It is regulating various regulated entities, right? So robust regulations will be simplified and made more resilient. The complex regulations, they are harder to follow. That's why complex regulations, they are harder to understand and harder to follow. So the regulations should be simplified and made more resilient. Okay, customer centricity and inclusive finance. So there should be accessibility of the services. Customer services should be provided by the scheduled commercial banks in a more accessible manner. So there should be accessibility and interconnectedness. The financial institutions, the financial system is more interconnected, so there should be proper risk assessment that should also happen. So should be customer centricity and inclusive finance. Okay, competitive markets, financial deepening. So there should be competitive markets. The money market is under the regulation of the Reserve Bank of India. Government securities market is under the regulation of the Reserve Bank of India. So there should be competitive financial markets. The financial deepening should happen, digitalization should happen. Okay, effective technology, that is innovation and cyber security. If we are innovating, we also have to focus on the security. Future ready organization, so RBI should focus on upskilling and sustainability. Global India, that is we have to follow the global standards, and standardization is what we have to focus on, and internationalization. So these are the strategic pillars and their focus areas. Remember this very, very carefully, because you know that from the digital payment index, there were multiple questions on its parameters, on its sub-parameters. Similarly, here also there can be questions from the strategic pillars and their focus areas. Okay, or which focus areas are under which particular pillar. So robust regulations, simplification and resilience, customer centricity and inclusive finance, accessibility and interconnectedness, competitive markets, financial deepening and digitalization, effective technology, innovation and cybersecurity, future ready organization, upskilling and sustainability, global India, standardization and internationalization. So Utkarsh 2029 has been shaped through inputs from the central office departments, regional offices and RBI subsidiaries to ensure internal inclusivity. Okay, the framework is aligned with the aspirational goals for RBI at the rate 100 and national priorities, the priorities that the government of India has laid down, such as the Viksit Bharat 2047 and Panch Pran. It comprises now under the strategic pillars, there are 49 deliverables. So there are 49 deliverables under the 6 strategic pillars. Okay, each pillar represents a key priority of the Reserve Bank of India. So this is the idea. Now let's discuss all of these strategic pillars one by one, so that you can understand that under these strategic pillars, what are the deliverables that are the focus area. Okay, so robust regulation, RBI endeavors to review, rationalize and simplify the instructions periodically, so that the regulations, the master direction, the master circulars, they are aligned with the evolving need of the economy, and reduce compliance. The RBI is also focusing on reducing the compliance burden for the regulated entities, promoting ease of doing business, minimizing the procedural redundancies, provide operational flexibility to the regulated entities and promote responsible innovation. So this is the robust regulation where the RBI is focusing on simplification and resilience. Okay, next is customer centricity and inclusive finance. So RBI's strategy focuses on assessing customer service in scheduled commercial banks, and the customer services should be improved in the scheduled commercial banks, as well as there should be more accessibility, that means customer services should be made more accessible for the customers. Services, the financial products, the financial services should be made more accessible for the customers. Okay. So this is the idea, this is the idea that the financial products, the financial services, they should be made more accessible for the customers, and RBI will be assessing the customer service in the scheduled commercial banks, accelerating the grievance redressal so that the grievances of the customers can be addressed in a faster manner, enabling the grievance escalation to the higher authorities. RBI ensures, now see, this is the accessibility. RBI wants the financial products, financial services to be accessible. Now RBI ensures continuous self-assessment through citizens charter review. What is citizen charter? Citizen charter basically contains the services that the RBI provides to the regulated entities and the customers or the public basically. Okay. So these are the services that the RBI provide to the regulated entities and the citizens. Any confusion, anyone? So citizen charter is basically the services. Citizen charter consists of the services that the RBI is providing to the regulated entities and the citizens. Okay, so here you can see that different departments of the Reserve Bank of India, they are providing different services like closure of currency chest, opening of the currency chest, shifting of the shifting or expansion of the currency chest. So there are different services that RBI provide to the regulated entities and to the citizens through different departments. So citizen charter consists of the different services that RBI is providing. Okay. Now, RBI ensures continuous self-appraisal, the self-assessment through the citizen charter review. And the RBI also publish a periodic metric on the same, that how many applications the RBI has got. Out of this, applications that is processed during the month, how many of the applications were completed within the timeline? That is 99.8% of the applications were within timeline, but 0.2% of the applications went beyond timeline. So you can understand that the RBI is very much focused on the self-assessment, on the self-appraisal and improving its own operations. So RBI ensures continuous assessment through the citizen charter review. Citizen charter is basically consisting of the services that RBI provide to the regulated entities and the citizens. RBI also publishes periodic metrics on the same on its review on the citizen charter. RBI strategy aims at financial inclusion by expanding the ULI, Unified Lending Interface, reducing lending costs, promoting inclusive credit delivery, and strengthening the contingent risk assessment, underscoring interconnectedness in the financial system. Because there is interconnectedness in the financial system, there are various financial entities that are very much interconnected. Okay, NBFCs and the banks, they are very much interconnected. NBFCs themselves, banks themselves are also very much interconnected. So when the financial institutions, they are getting more and more interconnected, there should be the contingent risk assessment that should be strengthened, so that if one bank fails, how it will impact the other banks, how it will impact the other NBFCs, that should be identified. Okay, so that is the contingent risk assessment that should be strengthened, underscoring the more and more interconnectedness in the financial system. Next is competitive markets. This pillar focuses on enhancing the market competitiveness, strengthening the market infrastructure by automating the processes, increasing the central clearing, reducing the risk, enhancing the market access, along with reduced auction turnaround time, because there are auctions that happen in the government securities market and such. So the turnaround time should be reduced. Price transparency should be there, expanding the retail participation in the markets. Effective technology. So RBI shall also use the technology in various areas of its own operations and eliminate paper or email based interactions, ensuring end-to-end digitalization of internal workflows. So RBI is going to focus on the effective technology in the internal workflows, as well as RBI will also deploy tech driven supervisory tools for the better supervision, for the efficient supervision, develop indigenous AI tools, that are developed in the country itself, upgrade systems like eCubay 3.0, and modernize the currency infrastructure, and promoting responsible innovation through AI frameworks, sandboxes, and asset tokenization. Asset tokenization basically means converting real world assets like government bonds into small digit units on a secure system enabling common investors to be able to buy fractional ownership and trade them easily. Okay, so this is the idea that asset tokenization basically means that real world assets, it can be different assets that are converted into small digital units. Okay, now future ready organization. RBI strategy is to build a future ready institution through continuous upskilling of resources. You will be RBI Grade B officer, so continuous upskilling will be done, reviewing functions across its offices, strengthening two-way communication with stakeholders, and embedding sustainability and climate awareness in its actions and decisions to further institutional excellence. Global India, that focuses on standardization and internationalization. The RBI, bank is RBI, okay, aims to enhance global cooperation by promoting UPI adoption abroad, expanding INR based international trade settlement, the Indian rupee based international trade settlement, expanding cross-border central bank digital currency arrangement, and adopting global standards to enhance global competitiveness. Okay, so this is the idea that RBI will be focusing on adopting the global standards to enhance the global competitiveness. The RBI also aims to actively pursue the leadership role India could play in different international discourses. This is the idea, and we have discussed the values, we have discussed the vision, we have discussed the 6 strategic pillars in detail. We have discussed the focus areas under the 6 strategic pillars also. Okay, so now each pillar encompasses overarching, forward looking and medium term deliverables. The regular functions of the RBI will continue under the annual action plan of respective departments. See, the Utkarsh 2029, it consists of the strategic pillars that RBI will be focusing on, the focus areas that RBI will pursue, and the deliverables that RBI will be targeting. Okay, now there are also the annual action plan of the respective departments, which consist of the regular functions that RBI will be doing or the RBI departments will be doing. So the regular functions of the RBI will continue under the annual action plan of the respective departments. The RBI attaches high importance to its medium term strategy and monitors its implementation and progress through a subcommittee of its central board. Okay, so this is the idea. Now, before going to the questions, first let me show you the document that is prepared for the course. So here, this is the document that is prepared for the course for the Utkarsh Framework 3.0. As you know, Utkarsh is a very, very important document that is released by the RBI. So we have also prepared, like the team has also prepared this document released by RBI. Background: Utkarsh 2022, Utkarsh 1, Utkarsh 2, Utkarsh 3. It was launched. Okay, when it was launched, it is a medium term strategic framework that has replaced the annual action plan. The objectives of the Utkarsh, like the project Samudra, CBDC, scaling up of ULI, all of this has been explained and laid down in a very systematic manner so that you are able to revise it very, very thoroughly. The vision statement, the values that are pursued by the Utkarsh framework, so all of this has been laid down. The strategic pillars, the strategy pillars and their focus areas. So here you can see the strategy pillars and the focus areas. So everything has been laid down in a very systematic manner so that you are able to remember the things more clearly and in a systematic manner. Okay, so as there are 6 pillars, so the pillars have also been explained, the important terminologies have also been explained in a very good manner, like the e-Kuber, asset tokenization, all of these important terms have been explained. So remember this, that the Utkarsh Framework 3.0, for this the team has prepared a document that here you can see, in which the important data points, the important points have been laid down. Everything has been provided in a very systematic manner. Okay, citizen charter. Citizen charter is basically the citizen charter. It basically consists of the services that RBI provide to the regulated entities and the citizens. Okay, so the Reserve Bank of India is agreeing or is providing the services such as the closure of currency chest or opening of the currency chest, the final approvals, the shifting of or expansion of the currency chest, exchange of notes received through the postal covers. So RBI is providing various services, right? The different departments of RBI, the Department of Currency Management, Department of Government and Bank Accounts. So different departments, multiple departments of the RBI, they are providing different services. So citizen charter basically contains all the different services that RBI is providing, that the RBI departments are providing to the regulated entities and the citizens. So RBI also reviews the citizen charter, the services that the RBI is providing. And there is the periodic metric that is also released on the RBI's website. On the RBI's website, this metric is released that, okay, how many applications were pending at the beginning of the month, applications that have been received during the month. So what are the total applications that the RBI has received? What are the total applications that the RBI has received? Out of that, how many the RBI has fulfilled within the timeline? How many are beyond timeline? So beyond timeline, that is crossing the timeline, are very less applications. So through this, RBI is able to see that if it is internally doing well or not, if it is internally able to follow the timelines or not. So I hope this is very much clear now. Sure, any confusion, anyone? Correct. Citizen charter is the place that contains, or citizen charter, it contains all the services that the different departments of RBI are undertaking for the regulated entities and for the citizens. So different services that the RBI departments are providing. So they are laid down, they consist under the citizen charter, and the RBI also reviews the citizen charter and provides the periodic metrics on the same. Okay, this is the idea. Chalo. Now this is the first question. I hope you will be easily able to answer this question. So which of the following are not the values under Utkarsh 2029 of the Reserve Bank of India? So I hope you remember the values. I hope you remember the strategy pillars and their focus areas. Very, very important. Okay. So try to answer this question. And this is your second question with reference to the strategy pillars and focus areas under Utkarsh 2029 of the Reserve Bank of India. Consider the following statements. Which of the statements given above are correct? That you have to tell. Okay. So the statements are given where the strategy pillars and their focus areas have been laid down. So you have to see that which statements are absolutely correct and you have to answer accordingly. Okay. So now let's get started. The first article that we are going to discuss is regarding the IRDAI that has released the 2025-26 list of domestic systemically important insurers. So recently the IRDAI has released a press release in April 2026 with the list of the domestic systemically important insurers. These are the insurers that are very important for the smooth functioning of the insurance sector in the country. Okay, so domestic systemically important insurers, they are the most important insurers in the country. Okay, now how this list is prepared, that also we will discuss. So first of all, IRDAI has completed the annual exercise of identifying the domestic systemically important insurers for the financial year 2025-26, and this list was recently released in the press release of April 2026 by the IRDAI. Now the following insurers, they continue to be identified as domestic systemically important insurers, and there is no change from the financial year 2024-25. So these are the domestic systemically important insurers, that is the Life Insurance Corporation of India, LIC, the New India Assurance Company Limited, and the General Insurance Corporation of India. So these are the three insurers or the insurance companies, we can say, that have been identified as the domestic systemically important insurers. Okay. Domestic systemically important insurers, they refer to insurers of such size, market importance, and domestic and global interconnectedness. So domestic systemically important insurers, they refer to the insurers that are very important on the basis of their size, market importance, domestic and global interconnectedness. Okay, whose distress. Now if these domestic systemically important insurance if they are in distress or if they fail, this would cause a significant dislocation in the domestic financial system. It will create a huge problem for the domestic financial system. Okay, so that's why these are the domestic systemically important insurers. Therefore, the continued functioning of these entities is critical for the uninterrupted availability of the insurance services to the national economy, Now, these domestic systemically important insurers, they are too big to fail. Insurers, they should not fail basically. So given the nature of their operations and the systemic importance of the domestic systemically important insurers, these insurers have to carry forward their efforts to raise the level of corporate governance, to have the better corporate governance and identify all the relevant risk and promote a sound risk management framework and culture. So these are the two activities that they have to pursue: raise the level of corporate governance and identify all relevant risk and promote a sound risk management framework and culture. Now, domestic systemically important insurers are subjected to enhanced regulatory supervision from the IRDAI. Now, as I was going through the articles here, you can see that this was the article this was the press release of the IRDAI from the September 2020. Okay, now here the methodology for identification and supervision of domestic systemically important insurers have been mentioned. So in order to identify the domestic systemically important insurers, the IRDAI has developed a methodology for identification and supervision of these insurers. Okay, the parameters as per the methodology for identification of these entities are these. These are the 4 parameters that you have to keep in mind. The size of operations in terms of total revenue, including the premium that has been underwritten and the value of assets that are under management of this insurance company. The global activities across more than one jurisdiction, lack of substitutability, so that is showing the market importance of the insurer, because this insurance company, this insurer, it has the lack of substitutability. There is no other substitute that is present of this insurer. Okay, so there is lack of substitutability of their products and or operations. Last is interconnectedness through counterparty. So there is domestic interconnectedness through counterparty exposure. So there is counterparty exposure and macroeconomic exposure to the whole of the economy. So these are the 4 parameters according to which the domestic systemically important insurer is identified: the size of operations, global activities, lack of substitutability, and interconnectedness. So before we have discussed that the domestic systemically important insurers refer to insurance of such size, market importance, and global and domestic interconnectedness. So these can be seen through the parameters that we have seen here. Okay, the size of operations, the global activities, the domestic interconnectedness, and the lack of substitutability. These are the 4 parameters according to which the domestic systemically important insurers are identified. It was also said that these parameters were assigned different weights to cover the various aspects of their operations. The authority, that is the IRDAI, would identify domestic systemically important insurers on the annual basis and disclose the name on the annual basis, and that the IRDAI has been doing since 2020-2021. Okay, so this is the idea. I hope this is very much clear. The parameters, the 4 parameters, I hope these are clear, as well as the 3 domestic systemically important insurers. The name you have to remember, it is LIC, okay, it is New India Assurance, and the GIC. Okay, the Life Insurance Corporation, the New India Assurance Company, and the GIC, that is the General Insurance Corporation. And these are the 4 parameters. Now, moving forward, at the global level, the framework of systemically important insurer is implemented by International Association of Insurance Supervisors. Now, coming to the next article, that is regarding the launch of various IT platforms by chairman of the SEBI to improve the ease of doing business. So first of all, SEBI has launched 3 IT solutions to improve efficiency and speed of communication with external entities to digitally enable quasi-judicial proceedings. What are the quasi-judicial proceedings? That we will understand. And to strengthen cyber security supervision of SEBI regulated entities. So there are 3 IT solutions that have been launched. First is to improve the efficiency and speed of communication with the external entities. Second is for digitally enabling quasi-judicial proceedings. And the third ID solution is to strengthen the cyber security supervision of the SEBI regulated entities. Now let's understand them one by one. So the first one is Subcoms. What is the full form of Subcoms? Very important to remember. Single universal platform for communications. Okay, so single universal platform for communications. By the name itself, you can understand that this is going to be the single platform for communication with the SEBI. So SEBI is going to have this single universal platform for communication to communicate with the external entities, to communicate with the intermediaries of the SEBI, to communicate with the brokers, dealers, investment advisors, research analysts, and to communicate with the mutual funds and such. So SEBI is going to have this single universal platform for communication, rather than having the fragmented trail mails. Because what happens that, okay, right now one officer of SEBI is discussing something with the broker, that why they have violated such kind of rule and regulation, or there is some violation that has happened, or there is some complaint against the broker, or the broker has requested the broker has requested something. So there is discussion that is going on the trail mail. But the trail mail, like, sometimes they can be missed because there are so many of the mails that are coming to the SEBI because of so many of the different brokers, investment advisors, research analysts that the SEBI is connected to. So the break can happen in the trail mails, or the break can happen in the mail. And this can lead to a lot of confusion and a lot of communications getting missed. So this platform, that is single universal platform for communications, this platform is designed to replace traditional email-centric interactions with the SEBI. This transition ensures that going forward, all the communications with the external entities remain easily accessible for both SEBI and the entity through this single universal platform for communications. So the implementation of Subcoms leads to the creation of a robust institutional memory that is going to record the communication with a particular entity at one place, so it is easily identifiable, it is easily approachable. Okay, the platform ensures an audit trail of communications and prevents fragmented communication and broken reply chains. So in the email, there can be many broken reply chains, that there is a new trail mail that has started, a lot of confusion is there. So instead of that, this is the solution. Okay, so this is the idea. Goodbye to the email chaos. Now there is one unified platform for all the communication. This will lead to centralized interaction, secure and accessible institutional memory that is going to record the communications and keep the communications at one place. Okay, so this is the idea. Now the Subcoms application is now live and accessible through the e-services portal. All registered intermediaries and the external entities that regularly interact with the SEBI can utilize this facility by obtaining a login on the portal. This initiative will promote the ease of doing business, trust and transparency. Okay, so this is the idea. Now coming to the E-Adjudication portal. Now to understand the E-Adjudication portal, first you have to understand the quasi-judicial proceedings. So first of all, see, the SEBI Act provides the SEBI Act provides the Securities Exchange and the Securities Exchange Board of India. Sorry, I don't know what happened. Sorry. So the SEBI Act, it provides the SEBI with the authority to undertake the quasi-judicial proceedings. Okay, so through this SEBI Act, the SEBI has the authority to act as the quasi-judiciary. Now quasi-judiciary is like the court, but the SEBI here has the authority to do the hearings, to examine the evidence and to take the decisions on the specified issues that are related to the securities domain, that are related to the securities market or the capital market. Okay, so this is the idea, that the SEBI, it works as the judiciary for its own domain. So that is quasi-judiciary. That is just like the court, as if the SEBI has the court-like powers. Okay, judiciary-like powers, as it can undertake the hearings, examine the evidence and take the decisions for the disputes, for the violations that are happening in the capital market, in the securities market domain. So that is known as the quasi-judiciary. So not a full court. The SEBI is just getting the authority through the SEBI Act to work as a quasi-judiciary. So it is not a full court, but the SEBI has the statutory authority, has the legal authority under the SEBI Act to act as the quasi. That is just like a court in the securities matter, that is in the capital market. Okay. So this is the idea. So the SEBI, it can act as the quasi-judiciary, and quasi-judicial proceedings, these are the proceedings that are conducted by the regulatory body. These are the proceedings that are conducted by the regulatory body to handle the disputes, or to handle the violations that are happening to the rules and regulations and the laws under the capital market. Okay, so this is the idea. I hope the quasi-judicial proceedings is very much clear, that the quasi-judicial proceedings, these are the proceedings undertaken by the regulatory body to handle the violations, to handle the disputes, to handle the breaches in its own domain. That is, for the SEBI, the domain is the capital market. Okay. So the E-Adjudication portal, this digital initiative, it aims to provide an alternate, transparent platform, the electronic platform for all the parties that are involved in the quasi-judicial proceedings, especially the adjudication proceedings. Adjudication proceedings, this is the formal legal proceedings that are undertaken for handling the case of the violation. Okay, so if there is any violation of the rules and regulation, or if there is any violation in the securities market, in the capital market under the domain of SEBI, so to handle such kind of violation, the adjudication proceedings, the formal legal process is undertaken. Now SEBI, it appoints the adjudication officers to handle the adjudication proceedings. So I hope this is very much clear, that quasi-judicial proceedings are basically the proceedings undertaken by the quasi-judiciary, and these are the proceedings that are undertaken under the regulatory body to handle the violations, to handle the breaches, to handle any kind of disputes that are happening in its own domain. Adjudication proceedings, these are the formal legal process that are undertaken to handle the violations that are done by certain entity, and under the adjudication proceedings there can be monetary penalty that can be imposed, or there can be the directions that can be imposed on certain entity. And for the adjudication proceedings, SEBI appoints adjudication officers to handle the whole adjudication proceeding, the formal legal process, to handle the violation. So the E-Adjudication portal, this is the digital initiative aimed to provide an alternate, transparent platform. So rather than having the physical meetings and having the physical proceeding, there will be the electronic proceedings that can be undertaken. So this digital initiative aims to provide an alternate, transparent platform for all the parties involved in the proceedings, especially the adjudication proceedings. The portal is designed with the objective to improve the speed of the quasi-judicial proceedings and ensure a paperless regulatory framework. So the portal is designed to facilitate direct interaction with the external entities against which the case is going on, and provides the following facilities. So through the E-Adjudication portal, you can see and download the show cause notice issued by the SEBI. So SEBI has first issued the show cause notice that, okay, you have done this violation, or we have come to notice that you have done the violation. So this is the show cause notice. Now you have to show the cause, that why you have done the violation, or is the violation actually correct, or you have to provide the evidence that, okay, the violation actually has not happened, or it is just a technical glitch. Okay, then you will have to submit the reply. So respond to the show cause notice and submit the post hearing submissions. You can request the adjudication officer for certain actions like document inspection and extension of time for your reply, as well as through this portal you can also attend the hearings online through a dedicated module. So you can understand that the whole process through the E-Adjudication portal can be made online, can be made electronic, rather than having the physical documents, rather than having the physical appearance and the hearings. So view and download the show cause notice issued by the SEBI on this portal, respond to the show cause notice, submit the post hearing submissions that you have to submit, as well as the document inspection or any request to the adjudication officer can be made through this portal only. Attend the hearings online through this portal. That is the whole idea. So the E-Adjudication portal has been made operational. Here you can see that this is the online platform to manage and facilitate quasi-judicial proceedings by SEBI. So the portal is integrated with the internal case management of SEBI to support the workflow of various internal departments involved in the quasi-judicial proceedings. Okay, that are the proceedings undertaken by the regulatory body to handle the violations, hearings, or disputes in its own domain. That is the idea. Now, coming to the last idea, or coming to the last IT platform, that is the SeeSAC. SeeSAC is Cyber Securities Audit Compliance. Remember the full form. First of all, the full forms are always very important, especially for the phase 1. The whole idea is more important from the phase 2 perspective. Okay. Now, SeeSAC, that is Cyber Security Audit Compliance. This enables automated analysis of cyber audit reports, facilitating identification of compliance gap. Let's say that there are multiple intermediaries. There are so many of the brokers, dealers, investment advisors, or let's say research analysts, the SM REITs, real estate investment trusts, small and medium, and the InvITs. They are sending their reports, because these are the intermediaries under the regulation of the SEBI. So SEBI regulated entities, they are sending their cyber audit reports. If the AI is not used, if the automation is not used, you can understand that it will become very difficult for SEBI to go through each and every audit report one by one, and it takes a lot of time also, right? So SeeSAC, that is Cyber Securities Audit Compliance, this enables automated analysis of the cyber audit reports, facilitating the identification of the compliance gaps, risk areas, and actionable insights. So through this automated process, through this automated analysis, the identification of the compliance gaps, risk areas, and actionable insights, this will become easier and faster and smoother. So this platform enhances efficiency, reduces manual effort, and supports timely data-driven supervisory decisions, because the SEBI has the supervisory role in the securities domain in the capital market, and SEBI supervises the regulated entities in the capital market domain. So SEBI also supervises the cyber audit report, or supervises the cyber security in its domain. Okay, so this platform enhances efficiency, reduces manual effort, supports timely and data-driven supervisory decisions, reinforces the SEBI's commitment to leveraging using the technology for robust cyber security oversight. Okay, now SeeSAC shall analyze the cyber audit report submitted to SEBI by the regulated entities of the SEBI on SEBI intermediary portal. So basically, on the SEBI intermediary portal, the reports will be submitted, and the SeeSAC will analyze these reports and share the analysis with the entities upon submission of their compliance report to SEBI through email. This is the idea. SeeSAC also provide risk scores and comparative analysis of cyber audit reports of the regulated entities, so that the risk score can show you that in your, like, if we are talking about the brokers, Zerodha is there, then IND Money is there, Grow is there. So in the list of the brokers where you are, what is your score? Are you at the higher risk category or lower risk category? Okay, so the SeeSAC also provides the risk score and comparative analysis of the cyber audit reports of the regulated entities. This will aid in enhancing risk-based supervision approach of SEBI. So these are the 3 initiatives that we have discussed. Any confusion anyone has in any of the point? I will take the extra queries. I have brought a spacious slide for all of you, so do not worry about it. Any confusion here? Anyone? No confusion? Give me a thumbs up if everything is clear. Chalo. Now, SEBI has launched these IT solutions. The Subcoms, it is a platform to streamline communication with external entities and enhance the institutional memory, so that the record can be maintained for the long period of time, as well as it can be easily approachable and transparent in manner. E-Adjudication portal, it is a next generation platform to digitally enable quasi-judicial proceedings. Cybersecurity audit compliance, and an AI-enabled platform to strengthen cybersecurity supervision of SEBI regulated entities. Okay, so this is the idea. So cyber security audit compliance. This is SeeSAC. This is the AI-enabled platform to strengthen cybersecurity supervision of SEBI regulated entities. Now, coming to the next point, the last topic that we have to discuss, SEBI launched an important investor protection measure. So see what has happened. First of all, that there is the increase of fraudulent trading apps. Like you must be trading in shares or you must be trading in the stock market through the Grow app or Zerodha or IND Money, but there are multiple of apps that have come now. Okay, so there is the increase of fraudulent trading apps that has posed a serious threat to retail investors, with scammers impersonating the genuine apps that eventually deceive the gullible investors. So rather than investing through a genuine app, now you are investing through a fake app. Think about it. Let's say you have invested or you have given the automation or you have given a auto debit approval. Through the auto debit approval, the money is being deducted from your account on the monthly basis. Now you are giving the access or you are giving the permission to this fake app to take the money from your account. Now you are thinking that the investment is happening on the regular basis, and usually like after 1 year you will check that okay, how much you have invested in the mutual fund. So you will realize that okay, you have invested through this fake app, and actually instead of your money going to the mutual fund, it has actually gone in the pockets of the fake app owners. So this is the idea that scammers, they are impersonating the genuine apps, and eventually they are able to deceive the gullible investors in believing that their investments done through the fake apps are directed to the regulated securities market, which is not. The fake apps are just pocketing the money with themselves. Okay, so this is the idea that with the increase of the fraudulent trading apps, the SEBI identified that there is need to provide the clear idea to the investors that which app is fake and which app is genuine, or which app is basically genuine and the other apps will be fake then. So SEBI in collaboration with Google has taken this initiative to implement at a first of its kind verified batch on Google Play. So this is the idea that SEBI in collaboration with Google has taken this initiative to implement a first of its kind verified batch on Google Play. So Grow Stock Mutual Fund verified, SBI Securities verified, Share Markets verified, SDFC Securities verified, Angel One verified. So here you can see this is the verified batch. This is the verified batch. So if you go to the Google Play and you see the trading apps, then you will be able to see these verified batch. And what this verified batch is telling you that okay, these are the verified apps. These are the verified apps. They are not the fake apps. Okay, so SEBI in collaboration with the Google has taken the initiative to provide the verified batch on Google Play to start with for all the stock trading apps in India. So for now, these verified batches are for the stock trading apps in India that are offered by entities that are registered with SEBI. So verified stock trading apps that are linked with the SEBI registered entities. So these apps that are linked with the SEBI registered entities will now display a verified label in the Google Play Store. Subsequently, the verified label will also be extended to other apps of other regulated intermediaries of the SEBI. So this is the idea. Okay. Now, this is the tagline. I can say पहले पहचान करे फिर निवेश करे. First identify, then invest. First identify, then invest. Okay. So this is the batch, that is verified batch. This is the batch. Okay. Now there is also the, like, while closing the event, Chairman SEBI requested investors to follow SEBI CVV. Now what is the CVV? C stands for check, V stands for validate, and the last V stands for verify. So this is the CVV: check, validate, and verify. So check means SEBI check. Have you heard about SEBI check? This is also quite in news. So instead of taking a separate session on SEBI check, I have brought the idea here only. So see, the SEBI check, this is available in the Sarthi app. So you can download the Sarthi app of SEBI, and in the Sarthi app, in the start only, you will see the SEBI check. SEBI check is basically, you can check the verified UPI ID. You can post the QR code and you will get the information that okay, this is the verified UPI ID, the name where you are sending the money, the name of the entity to which you are sending the money is this, the registration number is this. You can also put the UPI ID of the broker that you are dealing with, or let's say the investment advisor, if you are sending the money to the investment advisor or research analyst, and you want to see that okay, this is the actual genuine or authentic investment advisor or research analyst registered with SEBI. So you just have to use the photo of the QR code, or you have to type the UPI ID, and you will be able to check that the UPI ID is genuine or not, it is related to the SEBI registered entity or not. Okay, this is the idea. As well as you can also, like, let's say you have not got the QR code or you have not got the UPI ID, you have got the account details for the safe NEFT and RTGS transfers. So you want to transfer the money to the broker or the investment advisor or the research analyst or the mutual fund or any other regulated entity under the SEBI. If you want to transfer the money, you can check the details. Okay, you just have to put the IFSC code, you just have to put the account number, and it will be shown to you that okay, this is the verified account with the verified registered entity of the SEBI. Okay, so here this is the SEBI check. SEBI check is basically able to check the UPI IDs as well as the UPI QR codes and the bank accounts of the SEBI registered entities where you are sending the money, and is able to show that okay, the account is genuine or not. It is genuinely related to the SEBI registered entity or not. So this is the idea. The check is, the C is for check bank accounts through SEBI check. You can check the bank accounts through the SEBI check, and this SEBI check is available in the Sarthi app. It is very easy to use. I just went to the Sarthi app and I tried to like put the details and such, and I was able to see all the information. Okay, and here these are the snippets directly from the app. This is just an example. Now, coming to the next one, that is validate. Now, for validate, see, what has happened that the UPI ID, like there are regulated entities under the SEBI that collect the money from the investors, such as the brokers, the investment advisors, research analysts, small and medium real estate investment trust, such kind of entities, they collect the money or they take the money from the investors. Now, to identify these regulated entities, are they really connected with the SEBI? Are they really regulated or registered under SEBI? So you can just see that their username will be the entity characters, the characters that the entity has decided, the entity name basically, or the character that the entity identifies with. Dot BKR. BKR is for the broker. For mutual fund, there is the MF. So there are different tags for the different entities. For broker, for mutual fund, for the investment advisors, there are different tags. Then @ validate and the bank name. So @validate, this is @valid, this is basically the handle. This is basically the handle that is showing that this ID is valid, this UPI ID is valid, and it is related to the SEBI registered entity. So all the SEBI registered entities, all the SEBI regulated entities, they will have this @valid handle. So username, this will be a readable name that is chosen by the intermediary, by the SEBI registered entity, by the intermediary under the SEBI. So the entity name followed by a mandatory suffix that clearly identifies their category. BRK for the broker, MF for the mutual fund, for investment advisors, research analysts, there are different suffix. Okay, intermediaries are also, so @valid, this is the thing that you will see in the handle, in the UPI handle, to show you that okay, this is the valid ID of the intermediary. Okay, this is the idea. Now when you have put the UPI ID, this @valid will be like there in the UPI ID. This here you can see that if you have got the QR code, so in the QR code, if the QR code is of the SEBI registered entity, or if the QR code is of the intermediary related to the SEBI, then here there will be a Q that will be shown to you. So intermediaries are also required to generate a QR code that prominently features the logo for investor convenience, and the logo is a triangle, green triangle with a thumbs up. Okay, so this is the idea that the UPI ID is made safer. If you want to transfer the money to an intermediary under the SEBI, if you want to transfer the money to a broker, dealer, investment advisor, small and medium real estate investment trust, so all these intermediaries should have this @valid in their handle. Okay, as well as this is the correct name that they should be carrying. Next, if QR code, you are paying through the QR code to the intermediaries of the SEBI or to the SEBI registered entities. So here in the QR code, you should get this Q. So V is for validate UPI ID handles having the word valid, @valid basically, which can be checked. And these handles, they can be checked through the SEBI check also. So you just have to put the handle and the details will be shown that okay, these details or this handle is valid or not. This is really related to SEBI registered entity or not, or SEBI regulated entity or not. Okay, or you can put the QR code here and you can see that okay, the details are valid or not, and the bank details are they valid or not. So this is made to protect the customers from the fake apps that are going on, from the fraudsters that are present. Okay, so whenever you invest and you are sending the money through the UPI ID, you are sending the money through the QR code, you are sending the money through the bank accounts directly. So you can check that are you really investing, are you really sending the money to the SEBI registered entity or not. The UPI IDs now have the proper handle, the QR codes now have a proper queue, as well as even if you are still not sure, you can go to SEBI check to check further, and the green will be shown if it is valid registered entity, red will be shown, red will come if it is not valid registered entity. Okay, this is the idea. C is for check, V is for validate. At the rate valid handles are provided for the UPI ID. V is for last, V is for verify, verified labels for stock trading apps in Google Play Store. So this is just launched, verified handles for the stock trading apps in India. So check, validate and verify. This is the idea. So chairman SEBI advise investors to follow पहले पहचान करे फिर निवेश करे, first identify then invest. While closing the event, chairman of the SEBI requested investors to follow SEBI CVV. C is for check, V is for validate and the other V is for verify. So check for SEBI check, validate at the rate valid handles and verify verified label. Hello everyone. Welcome to EduTap and welcome to today's Finance 360-degree session. So today's session is going to be a very special session because first of all, we will be discussing a very important notification of the Reserve Bank of India that is regarding the floating rate savings bonds, for which the operational guidelines have been updated in 2026, in April 2026. Okay, so what is the change in the operational guidelines? What are the new operational guidelines? What are the facts that you have to remember from the phase 1 as well as from the phase 2 perspective? All of this we are going to discuss in today's session. And remember that the operational guidelines have been changed in April 2026. So this notification of the RBI becomes very important. Okay, so today we will have the detailed discussion about the changes and about the facts. So RBI has retained the bond structure. What is the bond structure and what are the upgraded operations for the savings bond? So this we are going to discuss, and the team has prepared the whole article in a very systematic manner so that all the important points you can remember from the examination point of view. Okay, that's why this is a very special session, because the article or the notification of the RBI is very lengthy, but the team has prepared it in a very systematic manner. So today we will discuss the important points so that you are able to remember the important points from the examination perspective. Okay, so first of all, what has happened? So the floating rate savings bond 2020, first of all, floating rate savings bonds, these are taxable. Okay, for these bonds, the operational guidelines were released in 2020 and they were updated in 2022. Now the Reserve Bank of India has reviewed the operational guidelines for the floating rate saving bond and the revised operational guidelines. After the review, the revised operational guidelines are being issued, and these revised operational guidelines have to be followed. Okay, and the operational guidelines were revised in April 2026. So this is the article. I hope now you understand that first of all, the floating rate savings bond, for these floating rate saving bond, the operational guidelines were released in 2020 and they were updated in 2022, but now they have been reviewed. The operational guidelines have been reviewed, and after the review, the revised operational guidelines have been released in 2026, and these are very important operational guidelines as they are directly affecting the investors, Okay, so first of all, give me a thumbs up. I hope I'm clearly audible. Okay, so now let's get started with the article. Now we are going to understand the operational guidelines that have been updated. Okay, so this is the RBI News Tab document in which you get the RBI notifications, RBI press releases, as well as here you get the RBI circulars, the RBI master directions that are released by the RBI. Okay, now here, floating rate saving bond 2020 taxable operational guidelines. The Government of India introduced the floating rate saving bond 2020. This was issued through the RBI with effect from July 2020. Okay, so basically the floating rate saving bonds, these are the government backed investment instruments. So floating rate saving bond, they are the bonds, they are the bonds. Okay, what are the bonds? What are the government bonds or the government securities? So the bonds, they basically, from the investors, the money is collected and this money goes to the government of India. Okay, so the government backed bonds are usually the bonds from which the investors money is collected. Okay, so this is usually the debt instrument, and here in the bond the details are laid down that okay, the government of India is collecting, let's say the bond value is, the face value is rupees 100, or the bond value is rupees 200 or something, and the interest that will be paid will be 8% per annum or such. So basically the investors invest in these bonds and they get the interest on the per annum basis or on the half yearly basis, and this money the investors invest, they get the returns, and it is written on the bond itself that after 5 years or after 7 years the bond will mature and the government of India will return the money to the investors. This is the basic idea. Okay, so the FRSBs, the floating rate saving bonds, they are the bonds. Floating rate means that the interest rate fluctuates, the interest rate keeps on changing, or the interest rate can change. So floating rate savings bond, they are the government backed investment instruments where the investors can invest in. This is designed primarily for the retail investors, so it is not for the big investors or such. This is primarily for the retail investors that are seeking stable and relatively low risk returns. Okay, so the FRSBs are for the retail investors that want to invest in the stable and relatively low risk returns. Now, what's new? So now RBI is replacing the original operational guidelines that were released in 2020 with the revised and more comprehensive set of guidelines that are released from April, that are released and that are effective from April to 2026. Okay, floating rate means that the interest rate changes. For the saving bonds, the interest rate changes. When does it change? All of this we are going to discuss. Okay, but floating rate usually means that periodically there is the change in the interest rate. So for the saving bond, for the bond, the interest rate of 8% per annum, this is not fixed. The interest rate is the floating rate. That means the interest rate can periodically change. So that's why the savings bond, this bond is floating rate savings bond. That means interest rate can change. Okay, now the investment key guidelines of RBI on FRSB floating rate saving bonds, that is updated recently. So first of all, investment and subscription features. So who are the eligible investors that can invest in the floating rate saving bond? So resident individuals, that means a person resident in India, a person resident in India. So individual residents or resident individuals and the Hindu undivided family. That's why it was said that this floating rate saving bond, it is particularly for the retail investors. It is majorly for the retail investors, for the resident individuals and Hindu undivided family. Now investment structure. So first of all, the issue price. The bonds will be issued at the value of rupees 100. Okay, so that means per bond unit price will be 100 rupees, but the minimum amount that has to be invested by the investors is 1000 rupees. Okay, so the bonds will be issued at the value of rupees 100. So this is per bond unit price. This is per bond unit price, but the investors, they will have to invest the minimum amount of rupees 1000, and the investment should be in the 1000 rupees or and later on in the multiples of 1000. Okay, so it's not like that you are investing 50 rupees, you are investing 200 rupees, you are investing 300 rupees. No, the minimum investment is of 1000 rupees and later on in the multiples of 1000 only. So this is the idea that the bonds will be issued to the investors at the minimum investment of 1000 rupees and in multiples thereof. And it is said that the bonds are issued exactly at their face value. What is the meaning of this? So there are certain bonds that are issued at the discounted price, Let's say that the bond value is rupees 1000. Okay, now the issue price is 950 rupees. On maturity, that is after let's say 1 year, you are going to get 1000 rupees. So what is the returns that you are getting? What is the return that you are getting? The issue price that you are paying is 950 rupees. You will be getting 1000 rupees on maturity after 1 year. So what is the return that you are getting? Anyone? Anyone? What is the return that you are getting? You're getting the return of 50 rupees. So that means you got the bond at a discounted price. The issue price was 950 rupees, while on maturity you are getting 1000 rupees. Okay. So this is one type of bond that is issued at a discounted price. The another kind of bond that we have discussed is that, okay, you are paying 1000 rupees. Okay. And you will be getting the interest of 8% per annum. Okay. Or you are getting the interest of 9% per annum. So here you have to pay 1000 rupees. This is the issue price, as well as the face value is also 1000 rupees. That means you will be getting on maturity 1000 rupees. So issue price, the price that the investor is paying 1000 rupees, you will be getting 1000 rupees on maturity. The investor will get back 1000 rupees on maturity. But here the interest is of 8%. That means you will be making you will be getting the returns of 80 rupees. So got it? So these are the bonds that are issued at the face value only. The issue price is equal to face value. So issue price is equal to face value. So if you are investing 1000 rupees, you will be getting the bonds worth 1000 rupees. That is the whole idea. Any confusion here? Any confusion here? If there is any confusion, kindly ask me. No confusion? So I hope this point is very, very clear, that the minimum investment should be of 1000 rupees. The investors have to invest minimum 1000 rupees. Any investment beyond 1000 must be made in the multiples of 1000 rupees. And the bonds are issued exactly at their face value. That means the issue price is equal to the face value. You are not getting the discounted price. You are getting the issue price that is equal to the face value, but you will be getting the interest. You will be getting the interest. Got it? First point of what? See, the bonds, see, the bond, it is issued at the per unit of the floating rate saving bond is issued at 100 rupees. Okay. But the minimum amount that has to be invested by the investor is how much? The minimum amount that has to be invested by the investor is rupees 1000. Okay. So the investor is, let's say, investing 1000 rupees. So if the investor wants to invest more, can the investor invest 500 rupees next? Can the investor invest rupees 200 next? No. The investment should always be in the multiples of 1000. So the minimum investment should be of 1000, and if you want to invest more, you can only invest in the multiple of thousands. Okay, 10,000, 20,000, 30,000, or 21,000, 23,000. So in the multiples of 1000. I hope this is clear now. Correct, Ria. So this is the idea, that the floating rate saving bond per unit is of 100 rupees, but the minimum investment, the minimum amount that should be invested is 1000 rupees. That means at least 10 bonds have to be purchased in one lot. Okay. And the investment should be in the multiple of thousands only. You cannot invest 500, 200 or something. You should invest in the multiples of 1000. Minimum investment is of 1000, and you have to invest in the multiples of 1000. That is all. I hope this is clear. Chalo, going to the next point, maximum investment limit. Is there any maximum investment limit? There is no upper ceiling on investment. That means there is no maximum limit. You can invest as much as you can as a retail investor. But the minimum investment should be of how much? The minimum amount that has to be invested, or the minimum amount that will be issued to the investor, is 1000 rupees. The minimum investment should be of 1000 rupees and in the multiples of 1000. Got it? Lock-in period of the bond. So the bond shall be repayable on expiry of 7 years from the date of issue. So that means if a bond is issued on 21st of April 2026, That means the bond shall be repayable on expiry of 7 years once the 7 years have expired. So the lock-in period is of 7 years basically, but the lock-in period changes for the senior citizen. For the senior citizen specifically, there are certain different lock-in periods that we are going to discuss. But otherwise, the bond shall be repayable on expiry of 7 years from the date of issue. Okay. Next, issuing agency. Who is the issuing agency? Now, usually what happens that the Reserve Bank of India is the one that issues the government securities, the bonds on behalf of the government of India. Now, can the RBI take the responsibility to issue all the government securities to the public on behalf of the government of India? So usually the RBI do not have so much of the bandwidth to keep on issuing the government securities on behalf of the government to lakhs of the citizens, to thousands of the people. Okay, so there are certain issuing agencies that are receiving office. Receiving office means select commercial banks or any other entity that is authorized by the RBI to issue and service the bonds. Okay, to issue the bonds and to service the bonds. So receiving office means select commercial banks or any other entity that is authorized by the RBI to issue the bonds to the general public and to service the bonds. That means to pay the interest on behalf of the government of India. Okay, service the bond basically means to pay the interest on behalf of the government of India. So this is the idea that the Reserve Bank of India issues the bond on behalf of the government of India, but the RBI itself cannot take all the responsibility. So RBI have some authorized receiving office. Okay, receiving office means select commercial banks or any other entity that is authorized by the RBI to issue the bonds or service the bonds. Application channel. Now, how you can apply as a investor, how you can apply? You can apply directly at the receiving offices, branches, or through the brokers. Okay, so you can apply directly at receiving offices, branches. That means at the bank branches or other entities branches you can directly apply, or through the brokers also you can directly apply. Like there are brokers that are connected with the receiving offices. So the receiving offices, they have some brokers also. Okay, next is application submitted by the investors. The application that is submitted by the investor must be with PAN, permanent number, right? In case the applicant does not have a PAN, he or she can submit a declaration in form number 97 as specified in rule 159 of the income tax rules 2026. So remember that as per the update in the income tax rules, as per the income tax rules of 2026, it has been said that if you do not have the PAN, do not worry about it. You can still invest in the bonds. You just have to provide the form number 97, the declaration in form number 97. That is the idea. Now, what if you are a minor? What if you are a minor? In the case of a minor, let's say you are not earning anything. So let's say I'm a minor and I want to invest. Okay, I'm a minor. I'm only 16 years old, but I want to invest in the floating rate saving bond. So I do not have a PAN number. I am not earning anything. So my parents or my guardians' PAN number can be provided. Okay. But let's say I'm a minor. I'm also earning. I'm also earning. There are many YouTubers that are less of age, but they are still earning, right? So I'm a minor, but I'm still earning. So in this case, the form number 97 can be provided. Okay, so yes, minors can also invest in the bonds. Now, mode of payment can be in cash up to 20,000 rupees, and above that, check, demand draft, or electronic mode. In that form, the cash can be provided, the money can be provided, sorry. So if you want to buy the bonds, you can buy the bonds by paying the cash up to 20,000, and above that, if you are investing above that, you have to provide the check, demand draft, or in the electronic mode, you have to provide the payment. Any confusion till now? Any confusion? Anyone till now? Next, branch access rule. So bank ROs, that is the bank receiving offices, they shall accept applications and collection of subscription amount, that is investment amount, at all branches that are handling the government business. While the non-bank receiving offices, non-bank means that other entities that are authorized by the RBI to function as the receiving office, except the CCIL, they shall accept the applications as well as the collection of subscription amount at all branches. So for the bank ROs, for the bank receiving offices, they have to accept the application, they have to collect the subscription amount at their own branches that are handling the government businesses, while the non-bank ROs, they have to accept the applications and the subscription amount at all the branches. Handling the government business or not, doesn't matter, okay, except for the CCIL. Next is ROs shall also provide a facility for online submission of application. So do you always have to go to the bank branch to get the bond, to buy the bond? So if you want to buy the floating rate saving bond, do you always have to go to the bank branch? No. It has been said very clearly that the receiving offices, they shall also provide a facility for online submission of application for the bonds. Now above points, both these points where the branches are providing the facility as well as where the online facility is being provided, these above points may be ensured on or before September 30, 2026, that is by September 30th, 2026. These facilities have to be provided at all the bank branches that are handling the government business from the bank side. So the application form should be present and the subscription amount should be collected. The receiving offices should also provide the online submission of application. Okay, withdrawal of subscription. Let's say that today you decided that you want to invest 30,000 rupees, but tomorrow you realize that okay, I have given the money, like I have filled the form to buy the bond and I have given the money 30,000, but I need this money, I do not want to invest. So can you withdraw your subscription? See, immediately if you realize that okay, you do not want to continue with the investment, so it is allowed. You can withdraw your subscription, you can get back the money that you gave for the investment purposes, but this is allowed only before subscription amount is sent to the RBI's central accounts section. So the banks, are they the ones that are releasing this bond? No. Are they the ones that from their own pockets will they pay the interest? No. They are just, the banks are just the entity that is connecting with the general public on behalf of the government of India, on behalf of the RBI, like RBI. Okay, so banks, they are doing the RBI's duty on behalf of the government of India. They are issuing and servicing the bonds with the general public. So the banks, they collect the money, okay, they collect the money, as well as they are the ones that have to pay the interest, but the government of India finally pays. So let me just clear this first of all so that you have better clarity. Just a second. Okay, so here, see, the banks, they connect with the general public, they provide the bonds. Okay, they are basically selling the bonds and they are paying the interest, as well as on maturity they pay the final amount also. So this is the idea that the banks are the ones, or the receiving offices are the ones that are connecting with the general public. But basically behind that, the government of India is the one that has to pay all the amount. Okay, now the government of India pays to the RBI, RBI pays to the banks. Okay, so government of India is the one that is getting the money through the bonds, that is basically that has to pay the interest. So government of India pays to the RBI. Okay, pays to the RBI. Government of India pays the interest amount to the RBI. RBI pays this interest amount to the receiving office, and the receiving office finally pay to the general public. So I hope this is clear first of all, that how this cycle goes on, that RBI on behalf of the government of India, RBI is issuing the government securities. Now RBI cannot do all of this alone, so RBI has some authorized receiving offices that are usually the bank or the other authorized entities. They connect with the general public to sell the bonds. Okay, so the receiving offices are selling the bonds, they are collecting the money, the invested money they are collecting, the receiving offices pays the interest and pays the maturity amount. On maturity, they pay the maturity amount. Now, the receiving offices, whatever money they have collected for investment, that is paid to the RBI. To which department of RBI or to which section of RBI? That is the CAS, that is Central Account Section. Okay. So, RBI's Central Account Section receives the investment amount, and the Central Account Section takes the interest from the Government of India and pays it to the receiving office, which finally pays it to the general public. This is the whole cycle. So banks from their own pocket, they are not paying anything, or they are not collecting the investment for their own pockets. They are basically giving the money to the Central Account Section of the Reserve Bank of India, which is further transferring the money or getting the money from the Government of India, because finally the Government of India is responsible. It is a government backed instrument. I hope this cycle is first of all clear. But the receiving offices, they have the responsibility to do the transaction with the investors to the general public. Okay. So first of all, what is happening? That the withdrawal of subscription, you have invested the amount, you invested the amount 30,000. You invested the amount 30,000, but yesterday you invested the amount, but today you want the money back. Okay, you want the money back. So it is said that the withdrawal of subscription is allowed, but only if only before subscription amount is sent to the RBI Central Account Office. Once the money has been sent by the bank, so let's say you went to the bank branch, you gave 30,000 rupees, you got a receipt that, okay, you have given 30,000 rupees to the bank branch, which will provide you the bond in a few days. Okay, so you are the investor A. Now the bank branch has sent the money to the Central Account Section of the Reserve Bank of India. If the bank branch has already sent the investment amount to the Central Account Section, then withdrawal of subscription is not allowed. You cannot withdraw your subscription, you cannot withdraw your investment. It is locked for 7 years. But let's say the bank branch has not sent the money in, the bank branch sends it next day. Okay, or let's say the bank branch is going to send it within 2 days. So now the bank branch has not sent the money, you are immediately going to the bank branch. If the bank branch has not sent the money to the Central Account Section, so the bank branch can return the money to the investor. I hope this is very much clear first of all. So the withdrawal of subscription is allowed only before subscription amount is remitted, is sent to RBI Central Account Section. Once the subscription amount is sent, not allowed. Okay, withdrawal where allowed must be of full amount. You cannot say that, okay, out of 30,000 you only want to invest 15,000 or such. Okay, if you are withdrawing your subscription, you have to withdraw it in the full amount, not partial. That is the idea. Now coming to the next point, that is bond holding and account structure. So withdrawal of subscription, I hope you have understood. Now coming to the next point, bond holding and account structure. So bond ledger account. What is a bond ledger account? Bond ledger account is an account with the receiving office to hold the bonds in the electronic form on behalf of the bondholders, on behalf of the investors. So basically, bond ledger account, it is like a demat account. You have a demat account. See, if you have a demat account, in the demat account, all your securities, your shares, your bonds that you have bought, they are stored. So this is the demat account that is usually with the NSDL or CDSL. CDSL and NSDL, these are the entities in the capital market that keep the demat accounts, that make the demat accounts for the investors. And in the demat account, you are storing your shares, your bonds that you have bought. Similarly, if you are buying the floating rate saving bond, your BLA account will be opened. That is the bond ledger account. This account is opened with the receiving office that holds the bonds in the electronic. So this BLA account, it holds the bonds in the electronic form for the investors, on behalf of the investor. Okay, so where your FRSB is being kept, where your bond that you have bought is being kept. So if you have bought the bond, it is being kept in the BLA, in the bond ledger account. This account is with the receiving office, okay, that is keeping the bonds in the electronic form on behalf of the investor. A separate BLA having unique account number for each investor. So for each investor, there shall be separate account, and for one investor, there should be one BLA account. Okay, new or multiple BLAs shall not be opened or maintained for the same investor. See, if let's say you have invested in the floating rate saving bond, uh, let's say in April. Now in May, again you are investing in these bonds. In June, again you are investing in these bonds. So if you are one investor, there should be one BLA only. All the different investments that you have done in this bond will go to your BLA account. Okay, it's not required that if you are investing in different months or if you are investing in different lots, then you have to again and again open the BLA. No, not required. One BLA should be for one investor. New or multiple BLAs shall not be opened or maintained for the same investor. Next is BLA identification. As it has been said that a separate BLA shall be opened with unique account number for each investor. Now, what is this unique number for the BLA? So how the BLA can be identified? So each account carrying a unique 6-digit code. So each account, that means for the investor, this is a bond ledger account. So each account will carry a unique 6-digit code. So this is the code. Let's say I am the investor. So Kritika, I am the investor. Okay, I am the investor. So for me, this is the bond ledger account that I have. Okay, so each account carry a unique 6-digit code. So this is the 6-digit code for my account with an alpha prefix. Now there should be a prefix that will show you the bank and the branch. The bank is State Bank of India, so SBI, and the branch is Pune branch. Okay, so this is the idea. So BLA identification, how you can identify the BLA, the bond ledger account can be identified through the unique 6-digit code with an alpha prefix, with a prefix that is this, that is the bank and the branch, and the 6-digit code is unique for the different BLAs. Okay, form of bond. So bonds are issued in electronic form and they are kept in the BLA, that is bond ledger account. Okay, certificate of holding. Now the receiving office issues a certificate of holding, COH, that is certificate of holding to the investor within 3 working days from the date of receipt or realization of funds. So basically what happens that the bank is receiving the investment money from the investor and the bank has to transfer the money within 2 days to the central account section of the Reserve Bank of India, and within 3 days the bank has to issue the certificate of holding to the investor. That is the idea. Okay, I hope this is very much clear. So now tradability, any confusion here? Just give me 1 minute. Okay, I have to see the comments and my system has gone off, so just give me 1 second. Sorry, I was not able to see the comments. Okay, just give me 1 second. Okay, all clear? Yes, I will be sharing the PDF. Do not worry about it. Okay, right now focus on the topic. Chalo, let's continue. Any confusion here? So basically the bank receives the investment money. This investment money has to be sent to the central account section of the RBI within 2 days and within 3 days. So within 3 working days from the date of receipt or realization of funds, the certificate of holding has to be issued to the investor. That is the idea. Now tradability, the floating rate saving bonds, are they tradable? They are not tradable. They cannot be bought or sold in the secondary market because this is the floating rate saving bond. This is the risk-free instrument that is provided to the retail investors. So they are not tradable. They cannot be bought or sold in the secondary market. I hope this is very much clear. Now next is loan eligibility, not eligible as collateral. So the floating rate saving bond, they are not eligible as collateral for availing the loans from banks, financial institutions, NBFCs. Okay, now coming to the third point, nomination and the death related claims. So here the important point will come in the lock-in period. That is what you have to remember, because as I have told you that for the senior citizen, the lock-in period of 7 years is not valid. There are different lock-in periods. Okay, so that will be the most important point in this area. Nomination facility. So receiving offices, the ROs that are basically issuing and servicing the bonds, they must encourage the investors to register nomination while applying. Okay, so nomination, there should be some nominee, so that in case of untimely death, the money of the investor can be given to the nominee. Okay, eligible nominees. Now, who can be the nominee? Only a resident or non-resident Indian is nominated by the applicant or investor. Overseas citizen of India, they are not permitted to be nominee for the bond. So this is very, very clearly written that eligible nominee are only the resident or non-resident Indians. They can be the nominee, but the overseas citizen of India, they are not permitted to be nominee for the bond. Type of nomination: single common nominee for all the investment. Let's say you have done multiple investments in the FRSB in the different months. So a single common nominee or the nominees for all your investment, or you can have the separate nominees for the different investments that you have done in the same bond. Okay, now transfer rule. Transfer is allowed to nominee or legal heir on death of the investor. So as it has been said very clearly that the bonds are not tradable, they are not transferable. Only at the death of the investor, only on the death of the investor, the bonds can be transferred to the nominee or the legal heir. Okay, in case the investment is of 1000 rupees, in case the minimum investment is 1000 rupees, then how many nominees can be there? Can you think about it? That if the minimum, like let's say I or XYZ person has done the investment of 1000 rupees only. Now, how many nominees this person can have? How many nominees this person can have? Any idea, anyone? This investor can only have one nominee. This investor can only have one nominee because this 1000 rupees, it cannot be broken down. Okay, so this is the idea. The minimum investment is of 1000 rupees, and in case the person has only invested 1000 rupees, in that case only one nominee can be there. Okay, in case of investment, that is the minimum amount, that is the minimum investment of 1000 rupees, the person may be permitted to nominate only one nominee. That is the basic idea. Now, in case there is higher investment that has been done, let's say the investment is of 10,000 rupees, or let's say the investment is of 20,000 rupees, then the amount wise allocation. So if the investment is of higher amount, then the amount wise allocation is possible. In case the investor has specified more than one nominee, the receiving offices may obtain from him or her the amount wise allocation, that which nominee. There are 1, 2 and 3. There are 3 nominees. So the first nominee will be getting 5,000. That is 5 units of 1000. Or 5 lots of 1000 basically. The second nominee will be getting 3000 and the third nominee will be getting 2000 if the investment is of 10,000. So that means amount wise allocation between the nominees have to be determined by the investor. So if investor is writing down 3 nominees, investor is notifying 3 nominees, so the amount wise allocation between the nominees should also be laid down by the investor. Okay, so in case the investor has specified more than one nominee, the receiving offices may obtain from him or her the amount wise allocation for transfer of investment amount among the nominees. Amount wise allocation facility may be made available for all new investments on or before September 30, 2026, and may be provided for the existing investments, the previous investments that have already happened on or before 31st December 2026. So I hope this is very much clear that the amount wise allocation is possible. Multiple nominees are possible, and amount wise allocation is possible for the new investment from September 30, like on or before September 30, 2026. This facility has to be provided to the investors, or by this date the facility has to be provided to the investors, but for the older investors, by this date the facility should be provided. Okay, yes, very good. Recognition of claim in case of death of the investor. So bond is transferred to nominee. In case of death of the investor, the bond is transferred to the nominee. There can be one nominee or there can be multiple nominees. There can be multiple nominees. Okay, if the nominee does not already have a BLA, a new BLA must first be opened. Let's say XYZ person and the daughter of XYZ person, they both have invested in the floating rate saving bond. So XYZ person has the BLA. The daughter also has a separate BLA because they both have invested separately in the floating rate saving bond. So XYZ person has died, and now the investment is being sent to the nominee, that is the daughter only. So she already has a BLA, so new BLA will not be created. But if the daughter did not have the BLA, then the new BLA had to be created. Okay. Recognition of claim on death. If there is no nominee, then the claim settled in favor of legal heirs of the investor. Okay. Next, coming to the fourth point, this is very, very important. Okay. Interest, taxation, and redemption. Okay. Lock-in period will come next. So now coming to the interest, redemption, and taxation. So interest nature, the floating interest rate, that means the interest rate changes periodically. There is periodically there are changes that are coming in the interest rate. Okay. There are periodic changes in the interest rate. Now the interest benchmark, there is some reference rate, like the interest rate for the personal loans, for the interest rate for the personal loans, for the housing loans and such, the interest rate that is charged by the banks. I hope you know the interest rate that the banks are charging for the personal loans, for the housing loans, for the automobile loans. The interest rate that the banks are charging, it has a benchmark rate. Okay, for the floating rate loans. For the floating rate loans, it has a benchmark rate. This benchmark rate is usually the repo rate. So repo rate is the benchmark rate, that is the reference rate according to which the banks decide their interest that they charge for the floating rate personal loans, housing loans, automobile loans. So usually what happens, that the interest rate has some benchmark rate. The interest rate that is charged by the banks, or the interest rate that is charged by the authorities, there is some benchmark rate. Okay. Similarly, here also the floating rate saving bond has a benchmark rate, that is the reference rate. So the coupon, that is the interest for the floating rate saving bond, is linked to the national savings certificate. This is another investment instrument of the government. Okay, this is another investment instrument that is backed by the government of India. National savings certificates, it is usually provided through the post offices. You can go to the post office and you can invest in the national savings certificate. Usually the lock-in period for the national savings certificate is 5 years and such. You do not have to have much knowledge about the national savings certificate, not required here. Just remember that the coupon, that is the interest of the floating rate saving bond, is linked to the national savings certificate rate with an added spread of 35 basis point. What does this point signifies? So basically the point is signifying that the interest rate that you will be getting on the floating rate saving bond, it depends upon the interest rate on the national savings certificate. So national savings certificate has the interest rate of, let's say, 7.75%. Plus you will be getting 35 basis point additional, that is 0.35% additional. So 35 basis points means 0.35% additional you will be getting. So what will be the interest for the floating rate saving bond? Anyone can tell me what will be the interest for the floating rate saving bond? It will be 8.10%. So this is the idea, that the interest rate for the floating rate saving bond, it depends upon the national savings certificate rate plus the 0.35%, that is the spread. Okay. If the national savings certificate rate is changing to, let's say, 8.10%, so plus the spread of 0.35%, what will be the interest rate for the floating rate saving bond now? The interest rate will be 8.45%. So this is the idea. So basically the coupon is linked. The coupon, that means the interest on the floating rate saving bond, it is linked to the national savings certificate rate. So national savings certificate rate plus the added spread of 35 basis point, that is 0.35%. Okay. Now interest computation. Now when the interest will be computed, on what basis the interest you will be getting? On the per annum basis, on half yearly basis you will be getting the interest. So let's say you are getting the interest of 8.40%. Okay. This is decided. This is the interest that has been computed. Now this is the interest on the per annum basis, but you will be getting the interest on the half yearly basis. That means this is the interest on per annum. Now divided in two pairs, 4.20% you will be getting on the first half of the year, 4.20% you will be getting on the second half. By when? So interest is first computed. See, interest is first computed. Let's say you bought the FRSB in April. You bought the FRSB in April. So interest will be computed from April till June. April till June. So April, May, June. So for 3 months, the interest will be computed. Okay, and the interest will be paid. After that, the half yearly timeline will continue. Half yearly timeline will start. You will be getting the interest on 1st of January and 1st of July every year. So for 7 years, because the lock-in period is of 7 years, the bond will mature after 7 years. So for 7 years, you will be getting the interest on the half yearly basis. So per annum interest is 8.40%. So you will be getting 4.20% of the interest on 1st of January, and the rest of the interest you will be getting 4.20% you will be getting on 1st of July. Okay, 1st of January and 1st of July you will be getting your interest payments. Now, because the interest changes periodically, so maybe on 1st of January you are getting 4.20%, but for the second half the interest has been changed because there is change in the National Savings Certificate rate. Okay, so I hope this is getting clear that interest is first computed from the exact date of issue of the bond to you to the 30th of June or 31st of December, whichever is earlier. Okay, so you have bought the bond in April. So April till June, you will get the interest. Then the cycle of half yearly will start. Okay, from June to December, from January to June and such. Okay, so this is the idea that interest is first computed from the exact date of issue to the next 30th June or 31st December, whichever is earlier. Thereafter, after the initial discrepancy has been cleared out, for every half year period ending 31st December or 30th June, you will be getting the interest on 1st of January and 1st of July. Any confusion here, first of all? Any confusion? So interest rate will be reset every 6 months, and you will be getting the interest on 1st of January and 1st of July. Okay. Interest is paid at half yearly intervals after the relevant interest period ends. The periodic interest payments will be made on 1st of July and 1st of January respectively. Okay. So that is the idea. No confusion? Okay, thank you. Let's move on. Tax on interest. So taxable, the floating rate saving bond bracket taxable. So in the heading itself, taxable is written. That means the interest that you are earning on the floating rate saving bond, it is taxable. Interest is fully taxable. Fully taxable means that the whole amount of interest, let's say you are getting the interest of 8.40%, that is approximately 80 rupees. You are getting as interest. So this interest, it's not half of the interest or not quarter of the interest is taxable. The whole interest, on the whole interest, the tax will be applied. If the tax is 30%, or let's say if the tax is 10%, so this tax will be applied on the whole value of the interest. So interest is fully taxable. Tax shall be deducted at source when the interest is paid. So before paying the interest, deduct the tax. So let's say your interest is 80 rupees. Your interest is 80 rupees. 10% is tax deductible at source. So 10% is the tax. How much interest you will be getting? Any idea? Deduct the 10% of tax, that is 8 rupees. So you will be getting the interest of 72 rupees. Got it? So tax deductible at source means at source only, at the bank only, from the receiving office only, the tax will be deducted. From there only the tax will be deducted, and you will be getting the interest after the tax has been deducted. Okay. So this is the idea that the interest is fully taxable. The whole amount of the interest will be taxed. The tax shall be deducted at source when the interest is paid. Tax shall be deducted at source only before the interest is paid to you. Now, premature encashment eligibility, this is very, very important. Individuals aged 60 years and above, they will be getting certain relaxations in the lock-in period. So lock-in period or the bond matures after 7 years. Okay, the expiry of the bond is 7 years, but the individuals aged 60 years and above, they have some relaxation. So early redemption is available only to senior citizens subject to lock-in conditions. Lock-in for age 60 to 70, the lock-in period for investors in the age bracket of 60 to 70 shall be 6 years from the date of issue. So that means the expiry for them is not 7 years, like they have the lock-in period of 6 years. After that, they can take out the money. For the people aged between 70 to 80, lock-in period for investors in the age bracket of 70 to 80 shall be 5 years. This is the lock-in period after which they can take back their investment. They can sell the floating rate saving bond, or they can return the floating rate saving bond. Lock-in age 80 and above. So lock-in period for the investors that are aged 80 and above shall be 4 years from the date of issue. This is the idea. Okay, so they have the lock-in period of 4 years. Lock-in period of 4 years. After that, they can return the floating rate saving bond. So premature redemption date only on 1st January or 1st July. So let's say you have requested that you want to sell your floating rate saving bond, and you are aged 85, let's say. So you want to sell the floating rate saving bond. The 4-year lock-in period has already passed. So now you can return the floating rate saving bond. But you have requested in April. Will your request be taken in April only? No. The floating rate saving bond can only be returned on 1st of January or 1st of July. So on 1st of July, your floating rate saving bond will be taken back and the money will be returned to the investor. Okay, even after eligibility, even after the lock-in period has finished, actual redemption, that is actual money that is returned to the investor, is aligned with the half-yearly interest payment dates. And remember that there is penalty on premature encashment. If you are taking out the money prematurely, that is, you are not sitting with the floating rate saving bond for 7 years. You have fulfilled the lock-in period of 4 years, or you have fulfilled the lock-in period of 5 years or 6 years, whichever is the eligibility criteria. So you have fulfilled the lock-in period and now you want to sell. Sorry, you want to return the floating rate saving bond, you can, but there is the penalty of 50% of the last 6 months interest. This is recovered in premature redemption cases. Okay, so for the last 6 months interest, this was 4.20%. So 50% of that will be deducted. Okay, any confusion? Now coming to the claims reporting and compliance. Now just the additional points are there. We will go through it in a fast manner. Okay, in case claim for payment of interest is received after expiry of 6 years from the date on which the amount became payable. So basically, let's say the unpaid interest or principal. In case the claim for payment of interest, you are claiming the interest after expiry of 6 years. 6 years have passed from the date of issue of the interest. So the receiving office shall verify and forward such claims to the central account of section of the Reserve Bank of India with reasons that why the claim has not been made or why the delayed claim has been made, that is after the expiry of 6 years. The RO may consolidate such claims and send it through the Pravah portal of the Reserve Bank of India. The RBI reserves the right. See, now what happens that the basically, let's say after 6 years, you remember that, okay, you have a floating rate saving bond and you have garnered some interest. So 6 years have passed, or let's say more than 6 years have passed. Now you are going to the bank to take the interest. Bank verifies that, okay, really your claim is there, and the bank just pays you the interest without sending it to the central account office. Bank, without taking permission from the RBI, just pays you the interest, pays the interest to the investor. In this case, the RBI is saying that if the bank has not taken permission from the RBI, the RBI can reject the bank's claim to get the interest. Okay, so basically, if the bank is getting the claim after 6 years for the interest, okay, from the investor, if the bank, without taking permission from the RBI, if the bank pays directly to the investor, then the RBI holds the right to reject the bank's claim from the RBI. Then the bank might not get money from the RBI. So this is what has been said, that the RBI reserves the right to reject such claims where the RO, where the receiving office has paid the interest to the claimant, to the investor, without obtaining RBI's prior approval. It's not like that the RBI do not want to pay to the investor. RBI will pay to the investor. But RBI is saying that first send the request to the central account section of the RBI. We will check ourselves, then we will release the money, then you can release the money to the investor. Okay. So in case the claim for interest payment is received after expiry of 6 years, first such claims have to be sent to the central account section of the Reserve Bank of India, and the claims can be sent through the Prava portal. RBI will verify, then RBI will release the money, the RO can release the money further. RBI reserves the right to reject such claims where the RO has already paid the interest without obtaining RBI's prior approval. Okay. So this is in case the expiry of 6 years has passed. Okay. Remittance by receiving office. So subscription amount, that is the investment amount collected, has to be remitted to the central account section. This I have told you, that the subscription amount, the investment amount collected by the receiving office has to be sent to the central account section. So if you are purchasing the floating rate saving bond, you are giving the investment money to the bank has to send it to the CAS within 2 working days. Okay. Link cell. Now what is a link cell? Link cell of an RO means it's designated. So link cell of the receiving office is the designated nodal office or branch that is responsible for coordinating with the other branches, with the central account section, and with the public debt office of the Reserve Bank of India for carrying out instructions in these guidelines. So basically link cell of the RO is responsible for the connection with the RBI, with the different departments of RBI, with the public debt office, with the central account section. Okay. Now high value reporting. So details of investors with aggregate investment of 10 lakh or more in the FRSB in the previous financial year must be reported to the public debt office, Mumbai, by April 15th of the current financial year. So in the previous financial year, if some investor has invested 10 lakh rupees or more than that, then the information about that detail of investor has to be sent to the public debt office, Mumbai, by April 15th of the current financial year. Reporting by receiving office. So basically ROs, they pay the interest, they pay the principal repayments. So ROs are collecting the money from the investors, they are paying to the investors. Okay. Now the ROs, they will claim the reimbursement from the central account section through their link cell, because the link cell is connecting with the central account section, with the public debt office and such. So the consolidated statements of the BLA, how much of the bonds have been purchased, how much of the bonds have been sold, what is the interest that is being paid and such, from branches. So consolidated statement from branches are sent to the Controller of Accounts, Department of Economic Affairs, Ministry of Finance of the Government of India, so that the Government of India can pay to the Reserve Bank of India and the RBI can pay to the ROs. This is the idea. Now next is service charges. So these are some of the last points that we will be discussing. Okay. So remuneration to receiving offices, so service charge. Now if the receiving offices are providing their services, will they provide it for free? What do you think? Will they provide it for free? No. The service charges receiving offices are paid 25 rupees for opening new bond ledger accounts. Annual maintenance charge rupees 20 is paid to the receiving office. This is the service charge, this is the annual maintenance charge that is taken by the RO. Okay. Rupees 20 is paid for servicing existing accounts. So basically for opening the new accounts, rupees 25 is the service charge that the RO takes, and for maintaining the existing accounts, rupees 20 is the annual maintenance charge that the RO takes. Okay. Brokerage of 50 paisa per 100 rupees of the subscription amount mobilized by ROs. So basically 50 paisa per 100 rupees of the investment amount that has been collected by the ROs. That is the brokerage fee that the ROs take. So brokerage is at the rate of 0.5%. So on the 100 rupees, the brokerage is taken at 50 paisa. Okay. Now at least 50% of the brokerage shall be shared by the ROs with their brokers and sub-brokers that are registered with the ROs. Okay. Because RO, the receiving office, they also have brokers, sub-brokers that are spreading, like the agents that are spreading the information amongst the public regarding the floating rate saving bond. No brokerage is payable in case the broker is one of the investors or applicants. Okay. This is the idea. Now, brokerage payment pattern. So 90% of the brokerage that has to be given to the ROs based on the funds that have been collected and reported to the CAS, that has been sent to the CAS, that is the Central Account Office, Central Account Section. Okay, so 90% of the brokerage that is due to ROs, that is due to receiving office, based on the funds that have been sent or reported to the Central Account Section as at the end of the business of the month, will be paid on third working day of the succeeding month. So whatever is the money that has been collected by the RO from the investors for the investment in the floating rate saving bond, that has been reported, that has been sent to the Central Account Section. So 90% of the brokerage on that, 90% of the brokerage on that has to be 90% of the brokerage on the received amount in a month. So 90% of the brokerage will be paid on third working day of the succeeding month. Okay, the remaining 10% of the brokerage amount along with handling commission is to be claimed by the ROs through a form, that is a brokerage and handling commission claim. So 90% of the brokerage will directly be paid in the next month, third day, but the remaining 10% will only be paid. The remaining 10% of the brokerage will be paid when the ROs fill a claim form. Handling charges 1/16th of 1%. 1/16th of 1% of the subscription amount of the investment amount that is collected. So the brokerage, the receiving offices, they are getting the brokerage for the subscription amount, investment amount that is mobilized, as well as they are also taking the handling commission for the subscription amount for the investment amount that is mobilized. This is the additional charge for handling the subscription amount, that is 1/16th of 1%. Now turnover commission 7 paise per 100 rupees on interest that is paid, principal amount that is repaid to the investors. So 7 paise per 100 rupees, that is 0.7, not 0.7, 0.07, sorry. So 7 paise per 100 rupees, that is on interest paid, principal amount, this is the turnover commission. Coming to the last few points, so investor services and grievance redressal mechanism. So investor services, basically online facility, is provided to the investors by the RO to view their BLA holdings, to change the nominee, submit requests for premature redemption if you have completed your lock-in period for the senior citizen, download the certificate of holding, interest, redemption payment statement, TDS tax deductible at source certificate. So ROs shall ensure that these functionalities are made available to the investors by December 31st, 2026. Okay, ROs shall put in place a system to attend all the service requests received from the investors within a period of 5 working days from the receipt of the request. Okay, grievance redressal mechanism. So ROs shall display at all branches on their website the name and the contact details of the nodal officer responsible for the grievance redressal complaint, for the complaint handling relating to the bonds, and escalation matrix, that if the nodal officer is not able to handle the complaint or is not replying, then the branch manager can be reached out or the regional officer can be reached out, and such. In case the investor is not happy with the reply of the receiving office, or in case the investor is not getting the reply within 1 month, within 30 days, so the ROs, they shall display at all branches and on their website the information to approach the RBI also if no reply is received within a period of 30 days from the receiving office, or in case the investor is not satisfied with the response of the receiving office. Okay, RO shall ensure that the officials from their link cells attend the half-yearly customer service meetings conducted by the Public Debt Office in the Nagpur to discuss the issues related to the investor service. Okay, this is the last point. Any confusion till now? So last point is that description of records. So these are the records that have to be maintained by the receiving office for a time period. Okay, so most of the records have to be maintained for the 3 years time period. But in case of the counter receipts are basically, you can understand that today I have given 30,000 rupees. Investor gave 30,000 rupees to the bank. Now bank is giving a receipt to the investor that okay, 30,000 rupees has been received. Now within 3 days the certificate of holding will be released to the investor, but till then the investor has the counter receipt that the investor has given the money to the bank. Okay, so the counter receipts should be preserved by the bank for 3 months. The application for the bonds, registers of the BLAs, register of nominations, form of nomination or cancellation, the other kind of records have to be maintained for 3 years, but the counter receipts for only 3 months, because they are just the receipt that the bank is giving to the investor for taking the money. Okay, statement submitted to CAS. Now statements that are submitted to the CAS, that should be kept for 5 years. Okay, that is the idea. Any confusion, anyone? Rest everything we have done. So let me just show you a clean file. Okay, so let's revise the most important points. Eligible investors, resident individual and Hindu undivided family. The NRIs, they are not eligible for investment in the floating rate saving bond. The non-resident Indians, they are not eligible for floating rate saving bond. Okay, minimum investment is of 1,000 rupees. Investment multiples should also be in 1,000 rupees. Maximum investment limit, there is no maximum investment limit. Lock-in period is of 7 years. Issuing agency is receiving office. Application channel can be anything. Okay, mode of payment is cash up to 20,000. Payment can be in cash up to 20,000 only. Next is branch access rule, that is the online submission of application facility as well as the branch application facility has to be provided by September 30, 2026. Okay. Now withdrawal of subscription can happen if the subscription amount is not sent to the RBI's central account office. BLA, we have discussed the unique 6-digit code of the BLA is there, and before the 6-digit code there is the bank and the branch. Form of bond, it is electronic form that is kept in the BLA. Certificate of holding has to be delivered within 3 working days to the investor. Not tradable, the FRSB, the bonds are not tradable in the secondary market. They are not tradable. They are not allowed in the secondary market. Loan eligibility, the bonds cannot be kept as the collateral. Nomination facility is provided. Only a resident or the non-resident Indian can be the nominee, but the overseas citizen of India cannot be the nominee. Okay. Next is the transfer rule. In this case, amount-wise allocation is allowed for the multiple nominees, and for new investments the amount wise allocation should be by September 30, 2026. Okay, for existing investors by 31st December 2026. Now legal heirs basically means the legal heirs of the investor that has died. Okay, the heir, the daughter, son and such. Now interest benchmark. What is the interest benchmark? Now I will be asking you questions. What is the interest benchmark? What is the interest benchmark? That is National Savings Certificate, and the spread is of 0.35%. Okay. Next, on half yearly basis, you will be getting the interest. Now, on which dates? On 1st of January and 1st of July. Okay. You will be getting the interest. Lock-in period for the citizens, for the senior citizens aged 60 to 70, the lock-in period for the investors is how many years? 6 years. For 70 to 80, 5 years. 80 to and above, 4 years. Okay, this is the idea. Now these are the important points. Detail of investors with aggregate investment of 10 lakh rupees or more has to be submitted to the public debt office. Okay, the ROs making interest payments, principal repayments, they shall claim reimbursement from the central account section through their link cell, giving the BLA wise details. The consolidated statements of the BLA from the branches are sent to the controller of accounts and to the RBI, with a copy to the RBI also, and these have to be sent in the physical copy form or in the email, and in email, in the physical copy also, in the email also. Now these are some of the charges. Service charge is rupees 25 for opening the new bond ledger account. Annual maintenance charge is 20. Brokerage is 50 paise per 100 rupees for the investment amount taken. That is 50%. At least 50% should be 50% of the brokerage shall be shared with the brokers and such. Okay. Brokerage payment pending 90% by the next month, 3rd working day. Okay, 10% when you deposit the claim, when you make the claim. Handling charges is 1/16 of 1% of the investment subscription amount, investment amount. Turnover commission 7 paise per 100 rupees for the interest paid or for the principal amount that is repaid. Investor services, they have to be provided by December 31st, 2026, and within 5 working days, the request has to be catered to. Okay, grievance redressal mechanism, RO should display at their branches and on their website about the nodal officer and how to approach the RBI if the investors are not satisfied. RO shall ensure that their officials from the link cell, they are attending the meetings conducted by the public debt office in Nagpur. Okay, these are the idea. Now, these are the definition. Bond ledger account, we have discussed. The CAS is the central account section at Nagpur. Certificate of holding is basically the certificate proof of subscription. Eligible investors, we have discussed, they are the resident individuals or the and the Hindu undivided family. PDO is the public debt office, means public debt office of the RBI. Receiving office, we have discussed. Link cell of the RO, we have discussed. All of this is done. Now the PDFs, this particular PDF will be provided to you. I will be providing you the clean PDF so that you are able to read the facts and you are able to focus on the facts. I hope that you like today's session. This is a lot of efforts has gone in preparing this whole table. The team has worked a lot. I have verified the data points, so it took a lot of time, but I hope you are able to see all the important data points at one place. So usually the data, because of the lengthy direction, it is very difficult to go through the data points in a clear manner. Okay, so that's why I've prepared this whole PDF for you. The team has prepared the PDF. I have verified the data. Okay, any confusion? Chalo, this is it for today. I hope you enjoyed the session, and we have done the FRSB operational guidelines, the update that has happened, and I hope you enjoyed the session. The MCQs from this session, I will be sharing the MCQs in the shorts that will be released tomorrow 8 p.m. Till then, revise through the PDF, and in the shorts that will be released tomorrow 8 p.m. the MCQs will be provided from this particular notification. Okay, till then, in the comment section, do tell me that what is the minimum investment, in the bond, as well as do tell me the lock-in period for the 80 years and above senior citizen, as well as do tell me the brokerage fee that is taken by the ROs. Okay, so these are the 3 questions that you have to answer in the comment section below. I hope you will be able to answer. Okay, where you will be getting the PDF? You will be getting the PDF in the Telegram channel of EduTap, for which the link is provided in the description box below. So the PDF of the session you will be getting in the Telegram channel of EduTap. The link for the Telegram channel is provided in the description box below. Okay, be present in the session. Now coming to the next one, let's start with the topic now. So digital payments e-mandate framework 2026, the master action has been released by the Reserve Bank of India. Okay, and the RBI has said that in exercise of the powers that have been provided through the Payment and Settlement System Act 2007, the RBI being satisfied that it is necessary, it is important in the public interest, hereby consolidate. So the RBI has consolidated all the different e-mandate rules and regulations that were released, as well as the RBI has also released some minor changes also. Okay, so basically the RBI has consolidated all the different circulars that were related to the e-mandates that were issued. So all the different circulars have been compiled in this one direction, in this one master action of the e-mandate framework 2026, as well as there are certain minor changes that have been brought, that also we are going to discuss. Okay, so first of all, what is the applicability of this digital payment e-mandate framework? So the provisions of these direction shall be applicable to all payment system providers. Payment system providers are the ones that are providing the payment system. Like the UPI is being provided by, any idea? The UPI is being provided by NPCI, right? If we are talking about the prepaid payment instrument, that is the wallets, the digital wallets, they are being provided by the different entities like the Paytm. Okay, there is also the digital wallet that is provided by the Amazon Pay, let's say. Okay, so there are the digital wallets that are provided by the non-bank entities. So these are also the payment system providers, because they are providing a payment system so that the payment can happen. As well as there are the cards that are the payment system provider for the cards are the card networks. For the debit cards, for the credit cards, the card networks are the payment system providers that are basically providing the basic infrastructure so that the payments can happen, the payments can be done. Okay. Now the payment system participants, who are the participants in the UPI ecosystem, who are the participants? The banks, they are the payment system participants. Okay, they are the ones that are completing the payments. There is also the Google Pay, Phone Pay. They are also using the UPI interface through which we are able to make the payments. Okay, so these are the payment system participants, as well as there are the payment gateways, there are the payment aggregators that provide. So payment gateways, payment aggregators basically they are connecting the merchants with the customers, and the payment aggregators, they provide different like the payment can happen through the UPI, the payment can happen through the wallets, the digital wallets, as well as the payment can happen through the card networks, through the cards, debit card, credit card and such. So payment aggregators, they provide the interface so that the customers can make payment to the merchants. Okay, so payment aggregators, they are also the payment system participants. This is the idea. So I hope this is first of all clear that which entities are the payment system providers and which entities are the payment system participants. Payment system providers, they are providing the payment system, like the NPCI is providing UPI, different non-bank entities, different entities, they are providing the digital wallets. There is also the card networks that are like they are letting the card work. Okay, so they are providing the infrastructure for the card system to work. Payment system participants are the banks, the Google Play, Phone Pay, the different payment applications, and payment system participants are also the payment aggregators, payment gateways. So this provision, these provisions are going to be, or these directions are going to be applicable to all the payment system providers, payment system participants in respect of processing of recurring transactions, because e-mandate, electronic mandate, is for the recurring transactions, domestic or cross-border, using cards, PPI, that is prepaid payment instrument, that is usually the digital wallets and such, and UPI. These directions shall be effective immediately. Okay. Now, coming to the registration and revocation of the e-mandate, we will come to the limits. But first, let's discuss the registration and revocation in brief. So, customers must complete a one-time registration process. I hope that, or many of you might have done the e-mandate for the mutual fund, let's say. Okay, so let's say you are doing the e-mandate. So when you are initiating the e-mandate, you have to do a one-time registration process. The mandate, the e-mandate, let's say you want to send the money every month to the ICICI Prudential small cap or large cap fund. Okay, so you want to send the money every month, rupees 2000, or every week, rupees 2000, you want to send to the ICICI Prudential for your investment in the mutual fund, in the large cap or in the small cap, or let's say in the infra. Okay, or growth, direct growth plan, whichever plan you are adopting. So you want to send the you want to send the investment amount every week. Now every week, will you, because you tend to forget, I tend to forget. Okay, so whenever I have to invest somewhere and I want to invest for a longer period of time on the weekly basis or monthly basis, so e-mandate is the thing that we use, right? E-mandate, electronic mandate, is the thing that we use. So in that, we have to do a one-time registration process. The mandate shall be registered only after successful validation. Now the e-mandate, the electronic mandate, shall be registered and will be the registration process will be completed only after successful validation of the additional factor authentication. Additional factor authentication can be your biometric or can be the OTP, that is in addition to the normal process that is followed. So when you are entering the mutual fund when you are entering the stockbroker app or the stock trading app, you might have to put a PIN to enter the stock trading app, or you might have to give a biometric to enter the stock trading app. Okay, once you have entered the app, then you, for the mutual fund, you are initiating the e-mandate. For the e-mandate, you are doing the one-time registration process, for which you have to give the additional factor authentication, that can be the OTP. Okay, so this is the idea, that with the normal process, you are entering the application with the normal process, and after you have entered the application, once you are starting the registration process, then the additional factor authentication has to be validated is mandated. Okay, so additional factor authentication can be a biometric or can be the OTP and such. Each e-mandate registered by the issuer must have a defined validity period. So there should be a defined validity period for the e-mandate. It can be like 1 year or 2 years, 5 years, which the customer can modify. Now the validity period for the e-mandate can be modified by the customer, as well as the customer can also withdraw the e-mandate. The facility must be clearly communicated at the time of registration that the customer can withdraw the e-mandate as well as can modify the e-mandate also. If you want to, like before, let's say I was investing 2000 per month. Now I only want to invest 1000 per month. So I can modify the e-mandate also. Okay. The e-mandates can be for fixed or variable amounts, subject to the overall cap fixed by the RBI. So limits we are going to discuss, but the e-mandates can be for the fixed amount or the variable amount. You want to have a e-mandate for the monthly payments that you want to give to the Netflix. For this, you are having a fixed amount of $4.99 that you will be paying to the Netflix on the monthly basis on 1st of every month. Okay, but when it comes to the electricity bills, now your electricity bills tends to be in between, let's say 1500 to 2500 on the monthly basis. Sometimes it is 1700, sometimes it is 1800, sometimes it is 2200. So your electricity bill tends to be within this amount, 1500 or 2500. So you have given the e-mandate for the variable amount. Okay, for the variable mandates, for the variable e-mandates, customers can also set maximum value of any recurring transaction. That means for electricity bill, I have decided that the maximum that can be deducted is 3000. So I have given the e-mandate for the variable amount, and maximum amount that I have decided that can be deducted from my account on the monthly basis is 3000. More than this, if more than this is the bill, then the amount will not be deducted, and first the permission will have to be taken from me. Okay, so that is the idea. For variable mandates, customers can set their own maximum value of any recurring transaction, because I know normally this is the bill that I get. If the amount is crossing 3000, that means there can be some problem. Okay, so this is the idea. I can set for the variable mandates, I can set the maximum value of any recurring transaction. Customers can choose or change how they receive the pre-transaction alerts. So before the transaction happens, there are alerts that are sent. You can choose that you want to receive the alerts in the SMS form or mail form. Okay, so customers can choose or change how they receive the pre-transaction alerts from the issuer. And when do they receive the pre-transaction alerts? Do they receive it 48 hours before the transaction, or 24 hours before the transaction, or 12 hours before the transaction? So pre-transaction alerts are received 24 hours before the transaction happens. Okay, any modification in or withdrawal of an existing e-mandate shall require additional factor authentication validation. So basically I said that I want to change my monthly investment from 2000 per month to 1000 per month. So for this I will need to provide additional factor authentication to change any to modify or to withdraw the e-mandate. I will have to provide the additional factor authentication. Okay, so this is the idea. Now, processing of first transaction and subsequent recurring transaction. So the first transaction, when the first transaction is happening, additional factor authentication means this is the authentication. This is authenticating that you are the person who is initiating the transaction and from your account. So additional factor authentication is usually in the form of OTP, that is authenticating that you are actually the owner of your account. Okay, or the additional factor authentication can be through the biometric also. It is for authorizing and authenticating that, okay, whoever is applying for the e-mandate is actually the person who has the account. Okay, so this is additional factor authentication, additional authentication through the OTP or biometric. Processing of first transaction and subsequent recurring transaction. The first transaction under an e-mandate shall require additional factor authentication validation. That means when you are doing the first transaction, you have registered. When you were doing the registration, then also you needed to provide an additional factor authentication, as well as when you are doing your first transaction, then also you need to provide the additional factor authentication. After that, for the subsequent recurring transaction, there will be no additional factor authentication that will be required. Automatically the payment will happen. So basically for Netflix or for Jio Hotstar, let's say you are putting a e-mandate. So when you are registering the e-mandate, then you will have to provide the AFA, additional factor authentication. And when you are doing the first payment, then also you have to do the you have to provide the additional factor authentication. But the point here is that if the first transaction happens with the registration, then only one AFA will be required. That means during registration, you have to provide a AFA, and during the first transaction, you have to provide the additional factor authentication. But what if the registration and the transaction, like while the registration that you are doing, you're also initiating the first transaction? That means there will be only one additional factor authentication that will be required then. So if the first transaction is processed along with the registration of the e-mandate, then additional factor authentication may be combined and only one AFA will be required. That is the idea. Next is payment under e-mandate shall not be subject to the other limits or controls set by the customer. Think about it. Let's say your insurance premium goes monthly. You have taken the health insurance or you have taken a life insurance, and your insurance premium is going on the monthly basis on 5th of every month. 5th of every month. And your insurance payment goes from your card, from your debit card, through the debit card, and insurance premium is of rupees 10,000 per month. Okay, so if you have a rupees 10,000 insurance premium and you have initiated a e-mandate, so that automatically the amount is deducted from your account and it goes for the insurance premium. But what happens that in the debit card you have also put a limit of 2,000 for the online transaction, because we tend to put limits on our card now, so that there is no fraud that is happening, and we are able to like initiate the transactions only when we want. So we have put, let's say I have put rupees 2,000 limit on the online transaction that can happen on the daily basis from my debit card. Now I have the limit of 2,000, but I have given the e-mandate of 10,000. So how the payment will happen? The e-mandate will be cancelled? No. If you have 10,000 insurance premium e-mandate, the mandate you have given, but you forgot that you have set the general daily online transaction limit of 2,000 on your card, the insurance payment would fail. Generally this will happen, but the RBI has exempted the e-mandates from the other controls that you are setting on your card or UPI or any other system through which the e-mandate is happening. So in the case of e-mandate, it will bypass any controls, any other limits that you have set for your card or UPI. So if you have initiated the e-mandate, if you have registered, if you have given the additional factor authentication, that means you are permitted this e-mandate to happen. You are permitting the 10,000 rupees to be deducted from your account every month through your card process. Okay. Even if you have set other limits, that will not be seen. So payments under e-mandate shall not be subject to any other limit or control set by the customer. Now what are the transaction limits? So all recurring transactions may be authorized without additional factor authentication up to 15,000. That means for Netflix, for your any other, like for electricity bills, for your Netflix and such, for your Netflix, for your electricity bills, for any other payments, for recurring transactions, for monthly, weekly transactions, without additional, like for after the registration of the e-mandate, after the first transaction, there is no additional factor authentication that will be required in the subsequent months. Okay, so all recurring transactions may be authorized without additional factor authentication up to 15,000 per transaction. Transactions above this amount shall be subject to additional factor authentication. But for the payment of insurance premiums, subscription of mutual funds, and credit card bill payments, they may be made without additional factor authentication up to 1 lakh rupees per transaction if you have already given the e-mandate. So I hope these are the important points that you will remember from this particular article. The other things are for the understanding purposes, but these are the limits. For the general e-mandate, for the recurring transactions, the limit is 15,000 without the additional factor authentication. Okay, but above 15,000 you will have to give the additional factor authentication. But for the insurance premiums, for the subscription to the mutual funds and credit card bill payments, for the if you have given the e-mandate without the additional factor authentication, the money can be deducted up to 1 lakh rupees, or the e-mandate can be up to 1 lakh rupees. Okay, now pre-transaction as I've told you that there will be pre-transaction notification that will be sent to you before the transaction. At least 24 hours prior, there will be the notification. So an issuer, that is the bank, usually they have to send a pre-transaction notification before the transaction happens. They have to send the pre-transaction notification to the customer at least 24 hours prior to the actual charge or debit. The pre-transaction notifications shall at the minimum inform the merchant's name, the transaction amount that will be deducted, the date and time or time of the debit, reference number of the e-mandate, and reason for the debit, that is the e-mandate that is registered by the customer. The issuer shall provide a customer with the facility to opt out of any particular transaction or the e-mandate. Any such opt-out shall be validated through the additional factor authentication, because the withdrawal of e-mandate or the modification in the e-mandate can only be possible with the additional factor authentication. Pre-transaction notification is not required for e-mandates. Remember this. This is also important. Pre-transaction notification is not required for e-mandates that are related to the balances of FASTag and National Common Mobility Card. So for FASTag and National Common Mobility Card, there is no requirement for the pre-transaction notification. Okay. So these are the important points. Pre-transaction notification has to be sent by the issuer at least 24 hours prior to the actual charge or debit. The pre-transaction notification should inform the customers about the details, and there should be the facility to opt out of the transaction. As well as the pre-transaction notification is not required for the e-mandates for the balances in the FASTag and NCMC. Next, an issuer shall send a post-transaction. After the transaction has finished, the post-transaction notification has to be sent to the customer. This notification shall at the minimum inform the customer about the merchant's name, transaction amount, date and time of debit, reference number of the transaction, e-mandate, and reason for debit, that is e-mandate only. Details on, now this has been added recently, details on grievance redressal. So after the transaction has happened, the details have to be mentioned in the message that you will be getting or in the email that you will be getting after the post-transaction notification, after the transaction has happened. In that, the details on grievance redressal will also be provided, so that if you have any grievance, if there is any fraud that has happened, or if there is any grievance that you have, you mandated 499 rupees, but 4999, that is nearly 5,000 has been deducted from your account. So any grievance that you have, you can raise your grievance through this platform, okay, or the details that have been given. Now coming to the additional information, dispute resolution and grievance redressal. An appropriate dispute redressal system shall be put in place by the issuer, that is usually the bank, to facilitate the customer to lodge their grievances. RBI instructions on limiting liability of customers. Limiting liability of customers means if there is any fraud that is happening, let's say you gave the mandate of 499, but 4999 has been deducted from your account, okay, and it has gone to the merchant. So you have to raise the request because a fraud has happened, or mistakenly this has been deducted, so you can raise the request. And RBI has instructed on limiting the liability of the customers for unauthorized transaction. Let's say you cancelled the e-mandate, you cancelled it, you gave the additional factor authentication also, but still the money is getting deducted from your account. So this is unauthorized transaction. Again, a kind of fraud is happening. So RBI has instructed on limiting the liability of customers for unauthorized transactions. This shall be applicable to recurring transactions under the e-mandates as well. Okay. This is the idea. Now, other provisions, no charges shall be levied to the customer for availing the e-mandate facility for recurring transactions, because when you do the e-mandate now, that means now you are free of mind. Every month the electricity bill will be paid automatically. Every month the insurance premiums will be paid automatically from your account. You just have to set the e-mandate once. Every month the mutual funds investment will happen automatically. So you are free of mind. You are getting this facility, okay, but there is no charge that is levied for this kind of facility for the recurring transactions. In case of cards, existing e-mandate can be mapped to reissued cards. Let's say your card has expired, your debit card or credit card has expired, or there is some damage that has happened, or let's say your card has been updated by the bank and such. So in this case, whenever the card is being changed because it has expired, it has been updated, so you are getting a new card. So it is said that the reissued card, the new card that you are getting, or the reissued card against the previous card that you are getting, that should also have the e-mandates already mapped, so that you again do not have to initiate all the e-mandate processes. Let's say I have set 5 e-mandate processes for my mutual fund, insurance premium, for my subscription, for my, let's say, subscription to Netflix, for my subscription to Jio Hotstar and such. So I have e-mandate of 5 or 6 e-mandates. Now I do not want to initiate it again. It is a time taking process, okay? So, or it can take a lot of my time. So in case of cards, existing e-mandates can be mapped to the reissued cards. Now an acquirer shall ensure compliance with these directions by merchants onboarded by them. That means, see, the RBI does not regulate every small merchant. RBI does not regulate the local gym, the startup apps and such, or the even the Netflix and such. RBI is not regulating each and every merchant. RBI is not going to regulate the Meesho, Myntra, multiple apps that we use, okay? Instead, it holds the acquirer, that is the payment aggregators, because the payment aggregators, the payment gateways are the ones that are connecting the merchant with the customer and that are taking the money from the customer to the merchant. Payment aggregators, payment gateways, they are the payment system participants that are regulated by the Reserve Bank of India, for which the RBI has released these guidelines also. So RBI is saying that I'm not going to regulate every small merchant, every local gym, every startup app. I'm not going to regulate, right? Instead, RBI holds the acquirer, that is the Razorpay, Pine Labs, major banks. They are the payment system participants. So they are responsible. They are accountable. If a merchant tries to bypass the pre-transaction notification or doesn't allow a customer to cancel a mandate, the RBI will hold the acquirer, that is the payment aggregators, payment gateways, or the banks, responsible for that merchant's non-compliance. Because the people, first of all, the public is allowed to cancel their e-mandates whenever they want. Just they have to do the additional factor authentication, as well as pre-transaction notification is mandatory 24 hours before the transaction happens. So no merchant should be able to bypass these kind of rules and regulations. If they bypass this, acquirer, that is the payment gateway or payment aggregator or the bank, will be responsible. So that is the idea. An acquirer, that is the payment system participant, usually shall ensure compliance with these directions by merchants onboarded by them, that are connected with them. Now, first article is finished. Any confusion, anyone? Now, coming to the next article, a circular has been released by the SEBI in April. One-time relaxation with respect to validity of SEBI observations. First of all, what are the observation letter that we have to discuss, okay? See, observation letter is the formal communication that is issued by the SEBI after it has completed its review of the company's draft red herring prospectus. Let's say I want to initiate the IPO. I have a company XYZ and I want to raise the money from the public now, okay? So I am doing the initial public offering. That is, for the first time I'm going to sell the shares of my company, sell the part of the ownership of my company to the public. So I hope everyone knows about the IPO, initial public offering. For the first time I am selling my shares to the general public. This is the initial public offering. Now before a company does the initial public offering, the company has to release the draft red herring prospectus. Draft red herring prospectus is basically the draft offer document that communicates and informs the public that why the money is being raised, what is the financial condition of the company, okay, what are the financials of the company, the cost, revenue, the cost structure, the revenue structure and such, the management of the company and such. So basically the information about the company, the financial information about the company, why the money is being raised, how much the money is being raised, what are the lots and such. So the management of the company. So all of this basic information about the company is provided through the draft red herring prospectus, through the draft offer document, so that the public can make a good judgment to invest or to not invest, okay? So this is the idea, that the draft red herring prospectus, it is basically the draft offer document that the company releases to the public. It is an offer document which shows the financial condition, the management condition of the company, and why the money is being raised. So now what is this observation letter? Observation letter is the formal communication that is issued by the SEBI after it has completed its review of the company's draft offer document. That is the draft red herring prospectus. Observation letter is basically a green light that indicates the company has met SEBI's disclosure requirement. SEBI is not saying that this company is good, you should invest in it, or the SEBI is not saying that this company is not good, you should not invest. SEBI is just saying that the transparency norms have been followed by the company. The company has shown its financial conditions. Now, on the basis of the financials and on the basis of the management conditions, the public can invest or not invest. So observation letter is basically a green light that indicates that the company has made the disclosure and has followed the disclosure requirements set by the SEBI, showing the financial condition of the company, and is legally permitted to proceed with the public issue. Okay, so this is the observation letter, that is the formal communication issued by the SEBI that okay, the company can proceed with the public issue. Now within 12 months, usually within 12 months, the public issue has to happen after the observation letter is released. So a public issue may be opened within 12 months. Within 12 months. So within 12 months, sorry. So a public issue, that is the IPO, let's say the initial public offering and such, may be opened within 12 months from the date of issuance of the observation letter by SEBI, or in some special cases within 8 months. Within 8 months, this is the date. Within 8 months, the public issue should happen from the date of issuance of the observation letter. I hope this is very much clear that the company is releasing the draft red herring prospectus. This is reviewed by the SEBI, and after the review, the SEBI releases the observation letter once the SEBI sees that all the information has been provided by the company as required, as per the disclosure requirement. So the observation letter is released within 12 months. Usually within 12 months, the public issue should happen of the date of issuance of the observation letter. In some cases within 18 months, the public issue should happen from the date of the issuance of observation letter. Now what happened that the industry body, many of the stakeholders, they raised the issue that they are facing the difficulties of getting the money. Now at this point of time, let's say if a IPO is released, many because of the war-like situation or because of the West Asia conflict, many of the investors, foreign investors, they are taking out their foreign portfolio investment. They are taking out their investment from the financial market of our country, as well as the new investors, the new foreign investors, they are not investing in such amounts as they used to invest, okay, before the conflict or in normal situations. So the many of the companies, they do not want to release the IPO at this point of time when they know that the flow of money is less in the market, as well as many of the domestic investors are also apprehensive to invest in the market in the new companies. So many of the companies do not want to release their IPO at this point of time. They are facing difficulties. So difficulties is faced by the issuers in mobilizing the resources. They are afraid that they will not be able to collect the resources if they release the IPO at this point of time. Accessing the capital market in the backdrop of ongoing geopolitical tensions in the Middle East, the West Asia conflict that is going on, this has led to several issuers to defer, to not release the IPO within the timeline, okay. They want to withdraw their issuance plans. Now if they withdraw their issuance plan, that means again the whole process will happen. Again they will have to release the draft red herring prospectus. Again the SEBI will have to review it and provide the observation letter and such. So SEBI is saying that it will take a lot of time to go through the whole process again, and it will lead to the duplication of the regulatory processes and the lapses. So considering the representation of the industry body, the prevailing uncertain market conditions due to ongoing geopolitical tensions and subdued investor participation in the financial market at this point of time, SEBI has decided to grant one-time relaxation to extend the validity of the SEBI observation letter. So basically all the SEBI has decided to grant one-time relaxation, and the observation letters that were expiring between April 1, 2026 and September 30, 2026. So whichever observation letters they were expiring in this timeline of the 6 months, it has been said that these observation letters, they will be applicable till September 30, 2026. Let's say my observation letter for my company for which I was releasing the IPO, it was expiring on 10th of April 2026, and I have a friend who is releasing the IPO of his own company. His his observation letter was expiring on 16th of May 2026. So now how much extra time we have got? We have got till September 30, 2026. We have got till September 30, 2026 to release the IPO. We do not have to release it before 10th or before 16th April or May. Okay. So this is the idea. This is the one-time relaxation. Any confusion? Any confusion, anyone? So basically one-time relaxation to extend the validity. Validity is usually 12 months or in special cases 18 months. So for the observation letter, after the observation letter, from the date of issuance of the observation letter, within 12 months, the IPO should be released. The IPO should be released. But now it has been said that the observation letters that were expiring between April 1 to September 30th, 2026, they will be valid till September 30, 2026. So that is the idea. So if your observation letter was expiring in May, in April, May, June, July, August, so you have got extra time, some extra time. Okay. That is the idea. Now, subject to the undertaking from the lead manager to the issue confirming the compliance that is happening with the rules and regulations. Now, this is it. This is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding transaction limits. Recurring transactions up to 15,000 can be processed without addition factor authentication. Insurance premiums can be processed without addition factor authentication up to 1 lakh rupees. Pre-transaction notification must be sent at least 12 hours prior to the debit. So which of the following, which of the above statements are correct, that you have to inform. Okay. Now coming to the next question, pre-transaction notification is not required for e-mandates registered for auto replenishment of balances in which of the following categories. Okay. Such kind of questions can come in the phase 1. Usually it is more, both articles are more important from phase 1. Okay. Now, I will also bring questions from these articles in your shorts for the Recall, Revise and Rise series, that the shorts are released at 8 p.m. on Monday, Wednesday and Friday. So the next short that will be released, yes, for Friday, there you will see the questions from these articles. Okay. And do remember that tomorrow you have a very, very important session on 24th April. I cannot emphasize it enough that how important this session is going to be, because all the important finance current affairs of your March will be in this session. Okay, so you will be able to revise if you have already covered. If you have not covered the finance current affairs from March, you will be able to know that what are the important areas that you have to focus on. We will discuss below. So now let's get started with the first article that we are going to discuss. The RBI has announced results of the 4th edition of the Global Hackathon Harbinger. Now, what is the Global Hackathon first of all? See, the participants, they are invited to develop. So under the Global Hackathon, it is like a competition. Okay, it is like a competition where the participants are invited to develop solutions using technology and innovative approaches under the theme of the Harbinger and the problem statements. So Reserve Bank of India had launched the 4th edition of its Global Hackathon Harbinger, Innovation for Transformation, with the theme Secure Banking Powered by Identity, Integrity and Inclusivity. Remember, identity, integrity and inclusivity. Okay. So RBI had launched the 4th edition of the Global Hackathon Harbinger in October 2025. And the theme of this Global Hackathon was Secure Banking Powered by Identity, Integrity and Inclusivity. So the Global Hackathon is basically a competition where the participants are invited to develop solutions using the technology and innovative approaches under the theme of the Global Hackathon and the problem statements that are provided under the Global Hackathon. So these are the 3 problem statements that are provided under the Global Hackathon Harbinger. Okay, that is launched by the Reserve Bank of India. So the first problem statement is tokenized KYC. Now think about it. When you are doing your KYC, know your customer, you are giving your name, you are giving your Aadhaar number, you are giving your address also. You might be giving your PAN number and such. So you are giving multiple details regarding you. That is going to connect you with your account, or that is going to connect with you with your DMAT account and such, with your savings account and such. So you are giving your personal information that is being recorded at different places in different areas. Now think about it, that when you are giving your card information, it has been said that instead of card number, the card number or the CVV, they should be tokenized. They should be tokenized so that the merchants, they are not storing your card number, they are not storing your CVV, they are storing some random tokens. Okay, so to safeguard your card information. Now, when it comes to your identity, you're just giving up the information. So it has been said that we need to find some tokenized KYC so that these details can be converted into tokens, and rather than saving these details, the tokens will be saved that are connected with your details. So if some fraud happens, if some data hacking happens, so these tokens will be released, and these tokens make no sense if they are being hidden. Okay, the tokens are basically hiding your actual information. So fraudsters, they will not be able to gather the information directly, they will only be able to reach to the token. Got it? Is this clear? First of all, like for your card information, you are sharing your card number, you are sharing the CVV for the transaction to happen, and the merchants can store your card number and the CVV. So now it has been said that there should be tokenization of the card information, and there is also the availability. Whenever you are doing Amazon payment, whenever you are doing any payment, there is a pop-up box that comes up that do you want to tokenize your card. So you can tokenize your card. Instead of card number and CVV, your token will be going to the merchant, and this will be stored rather than your card details. Similarly, when it comes to the KYC, you are giving your multiple details, details, your name, your current address, and such. So under the KYC, you are giving your details. So these details will be converted into tokens, and these tokens will be stored so that if any data hacking that happens, the tokens can only be reached towards, not the actual data. That is the idea. Now, so tokenized KYC, that is the first problem statement, that we have to develop the tokenization of the KYC. The second problem statement is offline CBDC. This is a big concern because central bank digital currency is said to be the digital form of the physical currency. So physical currency, we do not need any internet, any mobile phone to use the physical currency. We do not need any network to use the physical currency. But when it comes to the digital currency, there is also the legal tender. We will need the internet or we need the network. So it has been said that we need to develop the offline central bank digital currency so that it becomes nearer and closer to the physical currency and can actually replace the physical currency. Okay, so this is the idea, that's offline CBDC. This is another problem statement for which the participants can develop the solutions. Enhancing the trust, this is also important because when it comes to the digital domain, the trust, the cyber security, the safety is very important. Okay, now, the hackathon received 496 proposals across the three problem statements. It comprised of 34 proposals that came from 15 different countries. Okay, the hackathon was conducted in three phases with shortlisting of 49 out of 496 proposals. 49 entries were shortlisted in the first phase, which was further narrowed down to only 21 for the solution development phase. In the solution development phase, 21 proposals went. Okay, so in the solution development phase, 21 proposals went. The solution development phase was for 8 weeks, during which the shortlisted 21 teams or the shortlisted 21 proposals, they worked on building a prototype or a proof of concept under the guidance of external mentors. So all the 21 shortlisted teams are being given a stipend of 5 lakh rupees to meet the solution development expenses. I don't think there is anything to understand much here. 496 proposals were received, out of which in the shortlisting phase 49 were shortlisted, which further narrowed down to 21 only, and then the solution development phase started, which went for 8 weeks, under which the solution was developed by the 21 teams, and they received 5 lakhs of the stipend to spend on the solution development. Okay, yes, next is the third phase of final evaluation. The third phase of final evaluation and selection of winners was held during April 2026. So the third phase was the final evaluation and selection of winners. This happened in April 2026, and the 21 finalists presented their solutions to the jury, and the winner was selected on the basis of the innovation, solution comprehensiveness, product readiness, scalability, and security. So these were the 5 main parameters on which the winner was selected. Yes, 5 lakh per team. Stipend of 5 lakh per team to meet the solution development expenses. Okay. Now, winners were declared during the finale held on April 18, 2026 at Bangalore. Okay, so winners were declared during the finale, and now we will discuss that what are the different solutions that have been developed. So starting with tokenized KYC. Tokenized KYC, as I've told you, that here we want to have tokens. That is our data, our information should be converted into tokens, and these tokens should be shared with the multiple different entity. So in regards to the tokenized KYC, the winner was Earth ID Technology Limited of United Kingdom. So you can understand that it was the entity of some other country that won in the case of the problem statement of tokenized KYC, and the solution that was developed was Sangreh, that is basically collection. Sangreh of things means collection. Sangreh is a reusable, privacy-preserving tokenized KYC layer that converts verified KYC data. So basically, under the Sangreh, the verified KYC data is converted into digital tokens. And these digital tokens are stored in a user-controlled wallet. It is based on source-verified tokens. So basically, first, the KYC data is retrieved from trusted sources, and then this verified KYC data is converted into the digital tokens, so that the digital tokens are being stored in a user controlled wallet. It is based on source verified tokens, user consent, and minimal data disclosure, aiming to strengthen the trust and operational efficiency, converting the verified KYC into the digital tokens to store the digital tokens. Next runner-up was Baldor Technologies Private Limited, Kavach, that is basically your shield and protection. This is decentralized digital identity solution that enables user to complete their KYC, New York customer process using authorized sources such as DigiLocker, Central KYC Registry and such. So this is the idea that Kavach, it provides the users to complete their KYC using the authorized sources with themselves. That is, you have the DigiLocker and the Central KYC Registry. So through that you can do the KYC completion. Verified user's identity is converted into cryptographically secure verifiable credentials that is stored on the user's device only, and seamlessly it is reusable across banks, NBFCs, payment platforms with no personally identifiable information stored on chain. Only the cryptographically secure verifiable credentials will be stored that are in the cryptographically manner. So this is the idea that your actual information will not be stored. The cryptographically secure verifiable credentials will be stored with the different entities. Now coming to the next one, that is offline CBDC, that is offline e-rupee. Central bank digital currency, it is the digital currency that is the legal tender that can provide the substitute to the physical currency. Okay, the winner was team SEBI, that is students from Pune Institute of Computer Technology. SEBI uses a software defined secure element, basically the proximity based transfers. Like, so the team SEBI has used the proximity based transfers through the Bluetooth, low energy, near field communication and quick response based protocols. So basically through the proximity based transfers, the offline CBDC transfers were possible through the near field communication, devices, through the Bluetooth low energy. The offline transactions were possible. The solution employs advanced cryptographic techniques to ensure robust security and delivers secure, resilient peer-to-peer, person-to-person offline e-rupee transactions that prevent double spending. So basically for the offline CBDC, the SEBI has developed proximity-based transfers through the near-field communication. You must have seen that you are tapping your card and just through the tap of your card, the POS machine is able to deduct the money. That is the near-field communication that is being used. Okay, so or the chips are being used. So proximity based transfers can happen through Bluetooth, low energy, near field communication devices and the quick response based protocols. The solution employs advanced cryptographic techniques to ensure robust security and delivers secure, resilient peer-to-peer offline e-rupee transactions. Now the runner-up was Bank of Baroda Research and Innovation Center. So Bharat Ready Inclusive Central Bank Digital Currency. This was the solution that was developed. This is a unified 3-tier system that is designed to make digital currency accessible, the e-rupee accessible to everyone in India. If you have, let's say, high-end smartphones, or you have the Android phones, Apple phones, or let's say you have feature phone users, you are the feature phone users, that are the button phones, or even those who, without personal devices. So Bharat Ready Inclusive CBDC, this is for all the people. This is the digital, that is providing the digital currency accessible to everyone in India. Okay, so Bharat Ready Inclusive CBDC, this is for everyone. This is letting the people use the digital currency that is accessible to everyone in India. Let it be you having smartphone or feature phone, or not having the personal devices also. So it uses the Bharat Ready Inclusive CBDC. It uses ATM and the POS machines to enable the terminal assisted, the machine assisted CBDC transfers for users without personal devices. So if you do not have the personal devices, you can use the terminal assisted CBDC transfers. That is the idea. Any confusion, anyone? So in the offline CBDC, the winner is Team Aspers, that is basically providing the solution of proximity based transfers for the peer-to-peer offline e-rupee transactions. And the runner-up was the Baroda Research and Innovation Center that has developed Bharat Ready Inclusive CBDC, that is letting the digital currency accessible to everyone in India. Okay, and also focusing on the terminal assisted CBDC transfers for users without personal devices. The last one is enhancing trust. In this case, no first prize, no winner was awarded under this problem statement, but there was the runner up, that was the team Fraud Lens group of individuals. Okay, so this was the team that is Fraud Lens. So they have developed Fraud Lens. It is an AI driven fraud detection and compliance platform that evaluates transactions in real time and assigning a risk probability and risk classification. So basically on the real time basis, the risk probability and risk classification is assigned to the different transactions. So this enables financial institutions to take prompt action, such as blocking the suspicious transactions, authorizing the genuine transactions, or triggering the additional authentication. Okay, so this is the idea. Now, last is Best All Women Team, a team comprising of only women members across all the three problem statements. They could develop the solution. So, the winner was Bank of Baroda, Baroda Research and Innovation Center, Team Nidan. They have developed the solution Nidan. This is an AI based grievance redressal platform to handle the complaints, to handle the grievances, designed for Divyang customers, senior citizens, and users with low digital literacy. It enables Nidan, it enables seamless complaint registration and resolution through multilingual voice chat and Indian sign language, making it more accessible and more inclusive and accessible. So these are the different solutions that have been developed for the tokenized KYC. There is Sangray and Kavach. For the offline CBDC, there is the Aspers and Bharat Ready Inclusive CBDC. For enhancing trust, there is Fraudlens, and the Best All Women Team has developed Nidan. This is the idea. Any confusion? Let me show you the website directly, so that you can also see that what is the development that has happened. Okay, just a second. Okay, uh, okay, you are able to see the screen right now. So this is the idea. This is the result that we have discussed. All the important points have been discussed. And remember that the Harbinger, it was launched in October 2025. Okay, it was launched in October 2025. So here you can see that winner across each problem statement. So these are the winners. This is the amount that is given to the winners. Winner across each problem statement, they receive 40 lakh rupees. Runner up across each problem statement, they get 20 lakh rupees. Special prize to the best all women team, they get 20 lakh rupees. Okay, stipend for each team was 5 lakh rupees. So this is the amount that is provided to the winners. Sorry. Now, coming to this So I hope everything is clear, as well as you have also understood that what are the prizes that the winners are getting. The winners are getting the prize of 40 lakh rupees, and the runner-ups are getting the prize of 20 lakh rupees. The all women team is getting the prize of 20 lakh rupees, and the stipend that was provided to each team was 5 lakh rupees to develop the solution. Now let's move forward with the next article, that is guidelines to facilitate faster cross-border inward payments. Okay, so guidelines to facilitate faster the cross-border inward payments. Now Reserve Bank's payment vision. See, these are the guidelines for the cross-border inward payments so that we can receive the payments in a smoother, faster manner, and the remittances that are coming from abroad, let's say from United Kingdom, from USA, from multiple different countries, from Dubai, we are receiving the remittances. When they are sent, like from different countries, the remittances are being received. Let's say you have a son, or you have your daughter, or you have your sibling that is living in US, that is living in UK, who wants to send money to the parents that are living in India. Now, usually when the money is sent, it takes 1 to 3 days for the money to be remitted, to be sent to the account of the Indian entity or Indian person. Okay, so basically it takes a lot of time for the money to be received by the people in India. So to make the process more smoother, so that we can receive the payments in the smoother manner, as well as for the other kind of payments also, for the transaction also to happen smoothly, it has been said that there is the solution that is being developed, or the RBI has released some guidelines. The Reserve Bank's Payment Vision 2025 aims to bring efficiency in the cross-border payments, aligning with the G20 roadmap for cross-border payments that should become cheaper, faster, more transparent, and more accessible cross-border payments. So basically, Reserve Bank's payment vision, right now the payment vision 2028 is there, but the previous payment vision 2025 that was released for the timeline of 2022 to 2025. So payment vision 2025, it aims to bring efficiency in the cross-border payments, aligning with the G20 roadmap for the cross-border payments to become cheaper, faster, more transparent, and more accessible. So Reserve Bank of India has today placed on its website the payment vision 2025. Okay, the payment vision 2025 has the core theme. The payment vision 20, you have to remember this, because the payment vision 2025 was discussed when we discussed the payment vision 2028, as well as this payment vision 2025 is again in news, is again in the articles. Okay, so Reserve Bank of India has today placed so in 2022, as I've told you that in 2022 the payment vision 2025 was released for the time period of 2022 to 2025, and the theme, the core theme of the payment vision 2025 is e-payments for everyone, everywhere, every time. So 4 E's: e-payments for everyone, everywhere, every time. The aim was to provide every user with safe, secure, fast, convenient, accessible, and affordable e-payment options. And there were 5 goalposts that were targeted. The 5 anchor goalposts were integrity, inclusion, innovation, institutionalization, and internationalization. Okay, so these were the 5 goalposts. So under the payment vision 2025, under the Payment Vision 2025, the aim was to bring efficiency in the cross-border payments, aligning with the G20 roadmap for the cross-border payments to become cheaper, faster, more transparent, and more accessible. Okay, that is the idea. Any confusion in this one, first of all? Now the Payment Vision 2028 has been released, and this is the Payment Vision 2028 for the period of 2026 to 2028. And I have taken a detailed session on this. I hope you remember it. I hope you remember the themes and the other things. Now, moving forward, the speed of the cross-border payments is affected by several factors. One of the challenges that we are facing in India is with the speed of payments is experienced at the beneficiary leg. So what happens? Let's say you have the bank account in Bank of Baroda, or let's say you have the bank account in XYZ. Now the XYZ bank is receiving the money, or the XYZ bank is getting the information that the money has been remitted or the money has been received. But the bank is taking time to send the money that has been received by the bank to the bank account of the customer. So that means the beneficiary bank is taking time to send the money to the bank account of the customer. And that's why there is a problem is coming, or the time is being taken more. Okay, so the time taken from receipt of the payment at the beneficiary bank till the credit of the payment to the beneficiary account is longer. There is a lot of time that is being taken by the beneficiary bank to send the money to the beneficiary account. So even though the beneficiary bank is receiving the money, let's say it is taking 1 to 2 days to send the money to the beneficiary account. So the customer is able to receive the money after 1 or 2 days. So this is one of the problems that is being faced. So after reviewing the extent that is the existing process. So after reviewing the existing process by the Reserve Bank of India for the inward cross-border payments, indicated the need for streamlining the process. There is the need to streamline the process so that the bank branches, the beneficiary banks, as soon as they receive the payments, as soon as they receive the money, they send this money to the bank account of the customers, or there should be a process that should be defined that within what timeline they have to send the money to the bank account of the customer. So there is the need for streamlining the process at the beneficiary bank for ensuring the timely intimation of the payment information and credit to the beneficiary account. So the beneficiary bank, if they are receiving the money, they have to inform to the customer, as well as they have to credit the money to the beneficiary account also. This is the idea. Okay, sometimes let's say your son is living or your sibling is living abroad. They have said that they have sent the money, but you have not received it and you have not got any message from the bank also. So you will be worried, your sibling will be worried that where the money went, or did the process happen completely, or maybe like we do the transaction again because we think that from our end there is some problem. So it has been said that as soon as the beneficiary bank is receiving the money, they have to intimate to the customer, they have to send the message to the customer that okay, the money has been received, that will be processed within 24 hours or something, that at least the customer is aware that the money is coming. Okay, so this is the idea, and within a timely manner the bank account has to be credited for the customer, the money has to be sent to the customer. That is the idea. So there should be a streamlined process at the beneficiary bank for ensuring that timely message is sent regarding the payment information and credit to the beneficiary account. So now what is the process that is going to be followed? Now let's say from UK the money is coming from the Bank of UK or from some Standard Chartered bank, that is the bank in the UK. Okay, the money is coming to the Indian bank, State Bank of India. Now how the message is being sent, that okay, the money is being sent from the bank, from the Standard Chartered Bank of UK to State Bank of India. How the money how the message communication happens, how the communication happens. What is the, like yesterday in the monthly revision session we discussed about this communication tool or the society that is involved in this. Yesterday only we have discussed this. Swift. For each transaction, if they send mail, it will take a lot of time. Now, there is Swift. Now you remember that the Standard Chartered Bank of UK, if it is sending money to the State Bank of India, in India, the money is being sent. So basically, the Swift, through the Swift, the telecommunication, the communication will happen. The message will be sent that okay, the money, we have received the money to send, we are going to send the money to you. Okay. Swift. What is the full form of Swift? That you have to tell me. Now, bank shall inform their customer of the receipt of cross-border inward transactions immediately on the receipt of inward message. That means as soon as the Bank of India, the bank in India, if they are receiving the Swift message, if they are receiving the communication that this amount, $1,000, that is in Indian rupees, let's say 90,000 rupees, is being sent for the customer. So as soon as the bank is receiving this kind of Swift message, the bank has to inform to the customer. The bank has to inform to the customer. So bank shall inform their customer of the receipt of cross-border inward transactions immediately on the receipt of inward message under the Swift. Messages received after close of operating hours of the banks shall be informed to customers. So let's say they have received the Swift message, they have received the message of the regarding the transaction, they have received the message after close of operating hours of banks. This shall be informed to customer immediately at the start of the next business day. That is the idea. Okay. Very good. Now, it is observed that several banks, they rely upon end of the day statements of the nostro account. Anyone has any idea about the nostro account? We know that if the United Kingdom Standard Chartered Bank, if it wants to send the money to India, to let's say the customer of State Bank of India, so there is a message that is being sent. First of all, the SWIFT, the communication happens that okay, the money will be sent to the account of the State Bank of India. So message is sent through the SWIFT, the bank receives the information, okay. But how the nostro account works? Any idea? See what happens. First of all, let's take the example that you have account in let's say the Indian bank is Bank of Baroda, and we have a US bank that is Citibank, or we have a US bank that is JP Morgan. Let's take the example of JP Morgan bank. Now from the JP Morgan bank, there is a customer. Let's say you have a sibling who has an account in the US JP Morgan bank, and from the JP Morgan, the money has to be transferred. Okay, or let's say from the JP Morgan, the money has to be transferred to the Indian bank, that is Bank of Baroda. Now, Bank of Baroda has an account in the JP Morgan, or basically the Indian banks, they need to have an account in the foreign bank if they want to receive the transactions in the foreign currency. So that is the idea of the nostro account. Nostro account is basically bank account. Nostro account is the bank account. So Indian bank, that is Bank of Baroda, it is having a bank account in a foreign currency. So this is the bank account in the foreign currency, let's say in dollars, with the overseas bank, So here we have taken the example of the US bank, that is the JP Morgan. Okay, so the Indian bank, when they are holding a bank account with the overseas bank, and this bank account is in the foreign currency, because that's why we are holding a overseas bank account, so that the foreign currency can be received. Okay, so this is the idea of the nostro account. Nostro account is a bank account that is held by the domestic bank in a foreign currency at overseas bank, used to facilitate international trade, transactions, remittances and such. Any confusion here? Any confusion? No, that is different. That is vostro. That is vostro, not nostro. That is vostro account. Okay, like the bank account that we have in the other countries, that is nostro account. The bank account that we have in other countries to receive the foreign currency, or to transact in the foreign currency, that is nostro account. Okay, chalo. So it is observed that several banks, they have the nostro account, and let's say from the US, the remittances are coming. So remittances will actually come in the, let's say you are customer of Bank of Baroda, so remittance will come from US bank to the bank account of the Indian bank. Okay, then the Indian bank will receive these dollars and will convert these dollars into rupees, and rupees will be given to the customer. So basically what happens, that the US JP Morgan bank, the Indian Bank of Baroda, so let's say you have an account in Bank of Baroda, okay, or you have an account in Union Bank of India, or you have account in the different banks. Now they have a nostro account, they have a bank account with the JP Morgan in the foreign currency, in the dollars. So whatever remittances, that are being received, okay, the remittances, the US from the JP Morgan, the remittances will go to the bank account of Bank of Baroda in the dollars, because the remittances are being sent in dollars, because the siblings that are living in US, they are earning in dollars, so they are sending the money in dollars. So Bank of Baroda, in its nostro account that is held with the US bank, they are receiving the dollars, and then these dollars they are converting into rupees, and these rupees is given to the bank account of their customer, okay, that is living in India. Got it? Any confusion in this? So it is observed that several banks, they rely upon end of the day statements of the nostro account for confirming and reconciling receipts in the nostro accounts, resulting in delay in crediting the funds to the beneficiary's account. So what happens that many of the banks, several banks, they are checking their nostro accounts at the end of the day, and they are confirming the payments, they are confirming the transactions, they are confirming the remittances only at the end of the day. So you can understand that even if you have sent money at 10 a.m., this could, even if your US based sibling is sending you $1,000 at 10 a.m. in the morning, the bank is not seeing it. The bank is not checking its nostro account with the US bank. The bank is not checking it. And that's why you will receive the money. You as a Indian, let's say Indian sibling, or your parents will receive the money tomorrow, the next day, or it might take 1 or 2 days. So the RBI is saying that why the banks are taking so much of the time. If the bank has received the money, they should be seeing and checking the nostro account on the regular basis. The end of the day does not make sense because it takes a lot of time to send the money to the customers then, and the transaction is postponed to tomorrow. So it is observed that many of the banks, they rely on the end of the day statements of the nostro account for confirming and reconciling the receipts in the nostro account, how much they have received from what accounts they have received, and resulting in delay in crediting the funds to the beneficiary account. To make this process faster, banks are advised to undertake the reconciliation and confirmation of the credit in the nostro account frequently. Either on the real-time basis, they have to continuously check that how much money they have received, and they have to further the process, or at least at periodic intervals of 30 minutes. After every 30 minutes, they have to check. The reconciliation interval should normally not exceed 1 hour. That means before, if your US based son, daughter, or sibling was sending you $1,000 or $500 at 10 a.m., the bank used to see it at the end of the day in their nostro account, and then tomorrow they will start processing this payment and start checking and such. So it used to take at least 1 to 2 days. But now it has been said by the RBI that as soon as the money is received in the nostro account, either on the real time basis you have to check it, or at least within 1 hour you have to check the nostro account. So if you send, if your US based son, sibling is sending the money at 10 a.m., at least by 11 a.m. the bank will be aware about it, and they can start the process immediately, and on the same day the process can finish. Got it? No. Have you heard about spatial vostro accounts? So there is nostro, that is the account that we are holding with the other countries, and then there is vostro account, that is the account that the other countries are holding with us. Okay. If we are holding a bank account with other countries, it is in foreign currency. If the other countries are holding a bank account with us, it is in rupees. Okay. Now, so I hope this process is clear. I hope this is clear. See, we have to check it on the hourly basis. We have to check it. It has been said that the reconciliation interval should normally not exceed 1 hour. That means the bank has to check it on the hourly basis at least. Bank shall endeavor to credit the inward banks shall endeavor to credit the inward payments received during the foreign exchange market hours within the same business day. That means if the bank has received the inward payments in its nostro account during the foreign exchange market hours within the same business day, the beneficiary account has to be credited. The money has to be sent to the beneficiary account. So from the US based bank, the Indian bank has received the money in the nostro account, okay, in the foreign currency, in the dollars. Now within the same day, if the money has been received within foreign exchange transaction hours, market hours, if the money has been received within foreign exchange market hours, so within same day the Indian bank has to transfer this money from the nostro account to the beneficiary account, to the customer's account. Basically that is the idea. So and credit the inward payments received after market hours if, let's say, if the inward payments, if the inward payments have been received after market hours on the next business day, the money has to be sent. So let's say if the US based bank is sending the money and this money is received after the foreign exchange market hours in the nostro account, the money is received after the market hours, then by the next day the bank has to transfer the money to the beneficiary account. That is the idea. Okay, so banks shall endeavor to send the inward payments received during the foreign exchange market hours within the same business day. So if the money has been received in the nostro account or the money has been received by the bank during the foreign exchange market hours, so within the same business day, the beneficiary's account should be credited, should be paid in. And if the credit of the inward payment is received after market hours, so if the banks are receiving the money after market hours, on the next business day, the money has to be sent to the beneficiary account, subject to compliance with the existing FEMA regulations and the regulatory requirements. Now, the next point is just one more point. Banks may based on their risk assessment and subject to compliance with the existing FEMA regulations, put in place straight-through process. Straight-through process is basically the automated process where the manual intervention is not required to credit the inward payments to the account of individual residents. This is particularly for the individual residents that are receiving lesser amounts, we can say, that are receiving because the individual residents, they have the limit on how much amount they can receive, right? They are receiving the limited amount. So banks may, based on the risk assessment from where the money is coming, from where the money is going, what is the risk profile of the person that is sending the money, what is the risk profile of the person that is receiving the money, on the basis of their risk assessment, they can put in place straight-through process that the risk of the person sending the money is very low, the risk of the person that is receiving the money is very low. So there can be a straight-through process without any manual intervention, without any manual process. Through the automated process, directly the money can be sent from the nostro account of the bank to the beneficiary account of the customer in India. Okay, this is the idea, that there can be a straight-through process. Through the automated process, the credit can happen to the inward payments to the account of the individual residents in India. FEMA is Foreign Exchange Management Act. Foreign Exchange Management Act. Okay, banks may, within a reasonable time frame, provide digital interface to their customers to facilitate foreign exchange transactions, so that the foreign exchange transactions can happen smoothly through the digital interface, including submission of documents. In some cases where the amount is large, the residents, they might have to submit some documents also or information, and so this can happen through the digital interface, as well as monitoring of transactions can also happen through the digital interface. Okay, so that is the idea. Any confusion? Now, the directions above shall be effective 6 months from the date of this circular, and the directive is issued under the Payments and Settlement System Act 2007. Any confusion? Anyone? Any confusion? So see, there are multiple draft directions that are released. Now, the problem with the draft directions are that they are not final. And if we study the draft directions, there might be major changes that can happen in that. Then you will have to study the final ones also. Then you can get confused. And usually from the draft directions in the 2023, in the 2024, in 2025, we have not seen any questions from the draft directions. So for now, the draft directions, we are not covering it. We are waiting for the final ones at least till the end of May. If the exam happens on 20th June, let's say, or 25th June, or 10th June also, till the, not end of the May, but let's say as soon as the notification is released, we will know the date, and 20 to 30 days before the date of the examination, let's say till 20th of May, we are going to wait for the final directions. If the final directions are not released, then we will only cover the draft directions. I hope this is clear. First of all, draft directions, from the draft directions, the questions have not come in the previous years. So that's why we are just keeping it aside for now, because the final directions are usually released within 1 month, or the final directions, we are waiting for the final directions, which are more important from the examination perspective. But if, let's say, till the examination also the final directions are not released, then we will cover the most important points of the draft directions. So let's just wait 1 more month for the final directions, because your examination, it can happen in June. So at least we can wait till the end of May.
Okay, any confusion here, anyone? Chalo. Now this is the first question. I hope you will be easily able to answer this question. As per the guidelines to facilitate faster cross-border inward payments and the Payment Vision 2025 of the Reserve Bank of India, which of the following statements is correct? That you have to inform. Which of the following statements is correct? Okay. Chalo. Next is, which of the following solutions enable offline CBDC transactions using proximity based technologies like Bluetooth and NFC? So in the solutions, I have highlighted the most important keywords that you have to remember. Okay. So in all the solutions, I have highlighted these most important keywords that you have to remember. Okay. Read it, but just focus on the main keywords here. So now this is the second question that you have to answer. Okay. Chalo. Now coming to the yesterday I gave you this homework question, and now I will try to discuss the homework question in the next session so that you have the clarity that what is the answer. So Udgam is a centralized portal to help individuals search for unclaimed deposits. That is correct. The Udgam is a centralized web portal for searching unclaimed deposits through the multiple banks. Okay, so you will not have to go to each and every bank's website and search through it. No, this Udgam portal is providing you a centralized web portal so that you can easily search your unclaimed deposits across multiple banks at one place. Udgam, the full form of Udgam is Unclaimed Deposits Gateway to Access Information. Okay, RBIT, that is Reserve Bank Innovation Information Technology Private Limited. So RBIT, IFTAs, that is Indian Financial Technology and Allied Services, and participating banks, they have collaborated on developing the portal. But now, if you go to the Udgam website, it is mentioned that the RBIT is the one that is maintaining and developing the Udgam. Okay, so RBIT is the most important institution that we considered that is maintaining the Udgam now. Okay, so RBIT, IFTAS and participating banks, they have collaborated on developing the portal in 2023. But now if you go to the Udgam portal's website, you will see that it is written that RBIT is maintaining the Udgam portal. So first and third statements were correct, and that's why the right answer here is C. And many of you have given the right answer. Well done. So now let's start with the session, the Insolvency and Bankruptcy Code Amendment Bill 2025. So on April 6th, 2026, that is in April only, the President of India gave assent approval to the Insolvency and Bankruptcy Code Amendment Bill 2025. And once the President gives the assent, the bill converts into the act. Okay, the bill becomes the act. So the Insolvency and Bankruptcy Code Amendment Bill, this was introduced in Lok Sabha on 12th August 2025. It was sent to the select committee so that there can be further analysis that can happen on this Insolvency and Bankruptcy Code Amendment Bill. And then the select committee provided its report on December 17, 2025. Then it was passed from the Lok Sabha, and then it was passed from the Rajya Sabha in April 2026. It was passed from the Rajya Sabha, and now the President of India has also given the assent, the approval to the Insolvency and Bankruptcy Code Amendment Bill 2025, and that's why it has become the Insolvency and Bankruptcy Code Amendment Act 2026. Okay, so this is the whole idea. First of all, that okay, it was introduced last year in the Lok Sabha, but it has been passed in this year in March from the Lok Sabha and in April from the Rajya Sabha and by the President. So this is the basic idea. Now, what is the Insolvency and Bankruptcy Code? What is insolvency? Anyone has any idea that what is insolvency? See, insolvency is the financial condition in which the person, the individual or the company, the corporate, they are unable to pay their debt. They are unable to pay their debt. Okay. So that is insolvency. The person or the corporate has become insolvent if they are in the financial condition, in the financial state where they are unable to pay back their debts. Okay. Bankruptcy. Now, bankruptcy is basically the legal process through which the insolvent people, the insolvent corporates, they are under some legal process. Okay, so basically the bankruptcy, it is the legal process, or it is the court supervised process for those that are unable to pay their debts to handle the
insolvency. So bankruptcy is the legal process to handle the insolvency. I hope this is very much clear that insolvency is basically the financial state where the person or the corporate, they are unable to pay their debt, okay, and they have become insolvent. They are unable to pay their debt. They do not have enough assets or enough financial flows right now to pay their debt. And bankruptcy is the legal court supervised process through which the insolvency is handled or the insolvent corporates are handled. That is the basic idea. Now, so the Insolvency and Bankruptcy Code 2016, it provides a time bound process to resolve the insolvency among the companies and individuals. For the companies, there is the Debt Recovery Tribunal. Sorry, for the companies, there is the NCLT. That is the adjudicating authority that looks after the whole process of the insolvency and bankruptcy process. And for the individuals, there is the Debt Recovery Tribunal. That is the adjudicating authority. That is the authority that looks after the whole process of the whole process under the IBC. This we are going to discuss more, okay? But remember that for the corporates, there is different process or there is different adjudicating authority. There is different authority that looks after the whole bankruptcy process or the insolvency process. And for the individuals, there is different adjudicating authority, okay? Now we will discuss more about this. Now the bill, that is the Insolvency and Bankruptcy Code Amendment Bill 2025, now it has become the act. It aims to address procedural delays, uncertainty in recovery outcome and ambiguity from the judicial judgments. So there are major amendments that have been brought through this particular bill, through this particular act, so that we are going to discuss. But the bill aims to address the procedural delays, so the timelines have been very clearly noted. As well as there is uncertainty in the recovery outcome, that is also catered to under this bill, and ambiguity from the judicial judgments. So these are the problems that are catered to under this amendment bill, okay? Now first let's see the explanation. So under the IBC, under the Insolvency and Bankruptcy Code, a corporate insolvency resolution process, it may be initiated by a financial creditor. Financial creditors are those creditors that have given the loans, that have given the advances, right? It can be a bank, it can be NBFCs that have given the loans, that have given the advances. Operational creditor are basically those people that have given, like, let's say suppliers. Now the suppliers, they supplied the goods and services. They had to get the money, but let's say the buyer is unable to pay the money. So operational creditor are basically the people or the entities that own the money that the buyer has to pay to the supplier. So they are the operational creditor. Because of the business, because of their business, they have become the creditor in a way, okay? So financial creditors are the actual creditors that have given the loans or advances to get the interest, but the operational creditors, just because of their business activities, just because they are the suppliers or they are the sellers, they have got into this problem to take the money from the buyer, which the buyer is unable to pay, okay? Or the debtor itself. So the corporate insolvency resolution process, the corporate insolvency resolution process, this can be initiated by the financial creditor, the bank, the NBFCs, the operational creditor, or the debtor itself. That the debtor feels that now they are not able to, the debtor is not able to pay the loans, the debt. So the debtor itself can go under the corporate insolvency resolution process, so that the insolvency can be resolved. To initiate the corporate insolvency resolution process, an application is filed with the National Common Law Company Law Tribunal. So as I've told you that NCLT is the adjudicating authority that looks after the process of the corporate insolvency, while the Debt Recovery Tribunal is the adjudicating authority that looks after the whole process of the individual insolvency, where the individual or the partnership has become insolvent, they are not able to pay back their debt, okay? So here we will focus more on the corporate insolvency because that is a bigger domain, okay? So to initiate the corporate insolvency resolution process, an application is filed with the National Company Law Tribunal. So either the financial creditor, the operational creditor, or the debtor itself can initiate the corporate insolvency resolution process by filing an application with the National Company Law Tribunal. That is the adjudicating authority that looks after the whole process of this insolvency resolution. Upon default, now when the application can be filed if the default of 1 crore rupees or more has happened. That means the corporate has defaulted 1 crore rupees or more than that. 1 crore rupees or more than that, then the application of insolvency resolution can be filed with the NCLT. Okay, resolution professionals, they are appointed to conduct. So there are resolution professionals. Now you can understand that there is a company, there is a corporate that took a loan. Now the company has taken multiple loans, some from the bank, some from the NBFCs. Now the company is not able to return the loan. So there are the creditors. Okay, the creditors want their money back. The company is not able to pay back. So there is the resolution. Now the creditors, the financial creditors, let's say they have taken this company to the corporate insolvency resolution process. The creditors, the financial creditors, they have taken the company under the Insolvency and Bankruptcy Code to the NCLT. So the application have been filed with the NCLT that this company is not able to pay back the debt, and the debt is of 10 crores. So it is more than 1 crore rupees. Okay. So the NCLT will approve this application, will accept this application, and then the resolution professionals, they are appointed to conduct the whole corporate insolvency resolution process. So this whole process to get the money from the company to pay to the debtors, to pay to the creditors, to get the money from the debtors to pay to the creditors, this whole process is conducted through the resolution professionals. They are the professionals that try to resolve the issue, and they are appointed to conduct the corporate insolvency resolution process. Once CIRP begins control of the company, it shifts from the debtor to the creditors. Generally, it happens that whenever the CIRP begins the control of the company, it shifts from the debtors to the creditors, basically to the resolution professional on behalf of the creditors. The committee of creditors. Now there is the committee of creditors because there are multiple creditors that have given the money to the corporate. So the committee of creditors, it comprises of all the financial creditors of the company, takes key business decisions. So this committee of creditors, it takes the business decisions and select a resolution plan. So resolution professional provides different plans that we can change the management of the corporate and the corporate will start functioning better, and in the coming 2 to 3 years we will be able to retrieve the money. Or another plan is to restructure, like to sell the subsidiary, to sell the basic assets, and to restructure the functioning of the corporate, and we will be able to gather the money within 1 to 3 years. Okay, so this is like the resolution professional provides different plans for resolution of the corporate so that the money can be retrieved from the corporate. Okay, the resolution plan outlines how the debt of the company would be restructured or settled, like how much more time can be given to the corporate so that it can pay back to the creditors. Okay, or how it can be restructured, the interest can be reduced, the time of retrieving the money can be increased, as well as the management of the company can be restructured, the management of the company can be changed and such, in order to revive the company. If a resolution plan is not approved within a specified time, or the creditors committee of creditors determines that the company cannot be revived, it is too much of an effort, the NCLT orders the liquidation. Okay, so that is the idea. Now, if the liquidation, under the liquidation, assets of the company are sold and the proceeds, the money that has been gathered by selling the asset, are distributed as per the specified order, and the company is wound up. Okay, so the corporate, basically it is not, we are not able to revive the corporate, we are not able to gather the money, the plan cannot be formed for this corporate because it is so much down under the water, and that's why we have to liquidate the corporate to get the money for the creditors, to get at least partial money for the creditors. Okay, so the company is wound up. NCLT appoints a liquidator to manage the process of liquidation, selling the assets and such. The resolution professionals and their agencies are regulated. The resolution professionals, their agencies, they are regulated by the Insolvency and Bankruptcy Board of India. That is the regulator of this Insolvency and Bankruptcy Code. Now, appeals, if you are not satisfied with the decision of the NCLT, if the corporate is not satisfied with the decision of the NCLT, appeals against NCLT lie before the National Company Law Appellate Tribunal. So there is also appellate tribunal that is present. This is the whole process that I have explained you, just so that you have the clarity, because now we are going to discuss that what are the key provisions, what are the key changes that have happened. So now you will have better clarity that, okay, which authorities, which resolution professionals, they provide the resolution. Committee of creditors is formed of the creditors that have given the money to the corporate. NCLT is the adjudicating authority that looks after the whole process. Okay, so now let's see the key provisions of the Insolvency and Bankruptcy Amendment Bill 2025 that has now become the act. Okay, what happened? NCLT appoints what? Okay, we will see this. You will get better clarity now. The key provisions now we are going to discuss. So, adjudicating authority, that is the NCLT, shall within 14 days of the receipt of the application. If the NCLT has received the application from the financial creditor, operational creditor, or through the debtor, that the company, there is the CIRP process that is required, corporate insolvency resolution process that is required. So NCLT within 14 days of receiving the application by an order admit the application if it is satisfied that the default has actually occurred and the default is of 1 crore or more than that, and the application is also complete and there is no disciplinary proceeding pending against the proposed resolution professional that is proposed for this particular corporate insolvency resolution process. So within 14 days of receiving the application has to be admitted and accepted by the NCLT for the corporate insolvency resolution process. Remember this very carefully. Withdrawals. Now the bill or the act allows the withdrawal of an insolvency application. Let's say the financial creditors or the operational creditors, they filed the application for the corporate insolvency resolution process for a corporate. Okay, now they feel like that out of the court they can handle the situation, and they have talked to the corporate again, and the corporate is ready to take certain actions that the financial creditors or the operational creditors want. So the act allows withdrawal of an insolvency application only after the committee of creditors they have been constituted, and the committee has been constituted and before the first invitation of the resolution plans. So basically the bill allows withdrawal of the insolvency application once the committee of creditors has been constituted and before the first invitation for the resolution plan. Okay, such withdrawal would require 90% approval of 90% of voting share of the committee of corporates. That's why committee of creditors, it is required committee of creditors 90% of the voting share in the committee of creditors, they should agree for this withdrawal of the insolvency application. I hope this is clear first of all. Okay. So the bill allows withdrawal of an insolvency application only after the committee of creditors has been constituted and before the first invitation of the resolution plan. Such withdrawal would require the approval of 90% of the voting share of the committee of creditors. That 90% of the committee of creditors, they should agree that have the voting share. Okay. The bill also allows withdrawal of voluntary liquidation. Let's say the debtor itself, the corporate, that is the debtor itself, went to the NCLT with the application for the voluntary liquidation. Now the bill allows withdrawal of voluntary liquidation by a special resolution of shareholders. The shareholders of the company, of the corporate, they should agree, and the creditors representing 2/3 in the value of debt, they should approve this kind of resolution that, okay, voluntary liquidation can be withdrawn. Okay. So this is the idea. The bill also allows the withdrawal of voluntary liquidation by a special resolution of the shareholders of the corporate, that is the debtor, and the creditors 2/3 in the value of debt. Such creditors, they should agree. So let's say this is the total debt. So majority of the creditors that has the value of debt, the majority of the value of debt, they should agree. Okay. They have approved the resolution for withdrawing the voluntary liquidation. That is the idea. Next is Committee of Creditors role in liquidation. So the bill empowers, the act empowers the Committee of Creditors to supervise the liquidation. The bill also provides that the resolution professional will not be appointed as the liquidator automatically. The Committee of Creditors, by a vote of not less than 66% of the voting share, resolve to replace the liquidator. So if the Committee of Creditors, they want to replace the liquidator, they can replace the liquidator with the voting share of 66%, not less than 66%. So at least 66% of the voting share, Committee of Creditors, they should agree for the replacement of the liquidator. Where the Committee of Creditors resolves to replace the liquidator, it shall apply to the adjudicating authority, that is NCLT, for the appointment of the proposed liquidator that is proposed by the Committee of Creditors. So what we have understood, that NCLT, once receiving the application for the CIRP, has to approve it, admit it within 14 days if all the conditions are satisfied. Okay. Withdrawals, the bill allows withdrawal of the insolvency application if the Committee of Creditors has been constituted and it has not received the resolution plan till now. Such withdrawal would require 90% of voting share creditors of committee to approve such withdrawal of insolvency application. In case of the withdrawal of voluntary liquidation, if the company before voluntarily wanted to liquidate, but the company now do not want to voluntarily liquidate, so withdrawal of voluntary liquidation by a special resolution of the shareholders of the corporate of the company, and two-third of the value in the Committee of Creditors, or the creditors, two-third of the value. In the case of withdrawal of voluntary liquidation by a special resolution, two-third in the value of debt, two-third in the value of debt. Such kind of creditors that have two-third in the value of debt, they must agree within 7 days. Now, COC's role in liquidation. The bill empowers the COC Committee of Creditors to supervise the liquidation. The bill also provides that the resolution professional, they do not have to automatically become the liquidator, and the COC, by a vote of not less than 66%, at least 66% of the voting share, Committee of Creditors, they can replace the liquidator with another insolvency professional. Okay, that is the idea. Any confusion, anyone? Now, moving forward with the timelines for liquidation, NCLT must pass the order for liquidation within 30 days from the date of receipt of the application. It also specifies that liquidation proceeding, the selling of the asset, must be completed in 180 days, within 180 days, extendable by up to 90 days. Okay, within 180 days, the liquidation proceeding should be finished, and this time period is extendable by maximum up to 90 days. Further, voluntary liquidation proceedings must be completed within 1 year, and if there is withdrawal of voluntary liquidation, then what will happen? The withdrawal of voluntary liquidation is allowed by a special resolution, and two-thirds of the creditors, they should accept this. Okay, then only the withdrawal of voluntary liquidation can happen. So voluntary liquidation proceedings, they must be completed within 1 year. If there is withdrawal of voluntary liquidation, that is also allowed with the special resolution of the shareholders of the company, and two-thirds of the creditors, they should also approve within 7 days. Now, introduction of CIRP, this is important. The bill or the act introduces an alternative process called creditor initiated insolvency resolution process. So this is creditor initiated insolvency resolution process. This must be concluded within 150 days. The time period is extendable by up to 45 days by a vote. Now this time period will be extended by 45 days by a vote of at least 66% of voting share of Committee of Creditors. Okay, Committee of Creditors, they may decide at any time to convert the creditor initiated insolvency resolution process into the simple corporate insolvency resolution process under the NCLT, and seek an order from NCLT for that conversion. So creditor initiated insolvency resolution process, this is initiated, or this can be initiated, and this can also be converted into CIRP. Okay.
Now, CIRP is different from the CIRP. So, the creditor-initiated insolvency resolution process, this is different from the corporate insolvency resolution process in the following manner. First of all, the CIRP, it may be initiated only by specified financial creditors that belong to such class of financial institutions as may be notified by the central government. So, CIRP, this particular insolvency process can be only initiated by specified financial creditors. Okay, it is to be initiated with at least 51% of the notified financial creditors agreeing to the initiation of this unique process, and during the CIRP, management of the company will remain with the debtor only, subject to oversight by the resolution process. So this is the creditor initiated insolvency resolution process. Okay, that is usually considered a faster process because this is creditor initiated, and usually it is not coming directly under the complete domain of the NCLT, and it is a unique process that is being followed. Okay, that is the idea. Any confusion? And whenever we are saying by value or voting share, so basically you can understand that there are creditors. Let's say this corporate has taken the loan of 100 crores. The creditors, from one creditor 50 crore, another creditor 5 crore, another creditor 20 crore, and another creditor 15 crore. So voting share will be equal to all the, in the committee of creditors, will the voting share be equal? Will the voting share be equal? What happened, Swami Arora? Is there any problem? I think voice is clear, not? Okay, so voting share will not be equal for sure. Now, 50 crores, if the creditor has given 50 crores, it will have a higher voting share. Then the first highest voting share will be for this creditor, then the second highest voting share, then the third highest voting share, fourth. Okay, so this is the idea that the voting share, it basically depends upon how much loan has been given, how much credit has been given by a creditor, So that is the idea. So 66% of voting share means that 66% of the value of debt, 66% of the value of debt, creditors, they should agree. That is the basic idea. Now, coming to the next point, that is cross-border insolvency. This is another very important point. The bill contains an enabling provision empowering the central government to prescribe rules for administering and conducting cross-border insolvency proceedings. So the bill contains the enabling provision so that the bill can be empowered, the act can be empowered, so empowering the central government to prescribe rules for administering and conducting the cross-border insolvency proceedings also. So this is a very unique idea that has been provided, and the central government now has the power to prescribe rules for administering and conducting the cross-border insolvency proceedings. Let's see that how it comes out, if the central government will make the rules or not. But for now, the amendment has enabled the provision empowering the central government to prescribe rules for administering and conducting cross-border insolvency proceedings under the Insolvency and Bankruptcy Code of 2016. Group insolvency, the bill empowers the central government to formulate rules for conducting group insolvency proceedings. The rules may provide for a common bench for such debtors, coordination between the proceedings and common insolvency professionals, and a committee of creditors of the debtors. Okay, a committee of, see, if there is a group insolvency that is happening, that means there are different debtors, maybe from the same group, for which a common proceeding is going to happen, and there for this particular corporate or for this particular subsidiary, let's say there is a committee of creditors, for this particular another committee of creditors, for this committee of creditors, for this committee of creditors, for this committee of creditors. Now because a single proceeding is happening for the whole group, so there will be a committee of creditors. Okay, this is the basic idea. So group insolvency, the bill empowers the central government to formulate rules for conducting group insolvency proceedings so that multiple proceedings can happen together. The rules may provide for a common bench for such debtors, coordination between the proceedings and common insolvency professionals, and a committee of creditors of the debtors. Okay. Now, assets of guarantor. Coming to the last point, that is assets of guarantors. So, bill enables a creditor who holds a security. Let's take the example first. So, let's say company A has taken the loan. Now, company A is the corporate that is on the verge of insolvency or that has become insolvent. Now, the promoter, the guarantor, had given personal property as collateral. So, company A, when the company A was taking the loan, the guarantor gave the personal property as collateral. Now, bank takes possession because the company A has defaulted. It has defaulted. So the bank takes the possession of the property of the guarantor. Now during the CIRP, because the corporate insolvency resolution plan has been initiated that this corporate is not able to pay back the loans of all the creditors or majority of the creditors, and so there is an insolvency process that is being run. So now during CIRP of company A, that property that was taken by the bank in possession, the property of the guarantor that was taken in possession, that property can be included in the resolution plan. The bank, it has agreed to include the property that it had taken under its control. The bank agrees to put this property under the resolution plan because the bank knows that if the bank itself sells the property, it will not be able to gather much amount. But under the resolution plan, under the corporate insolvency resolution process, maybe more money can be retrieved for this property, for this asset. Okay, but the committee of creditors, they must approve. So the act enables a creditor, it can be a bank, NBFC, who holds a security interest, that is the collateral, over the guarantor's asset. So basically, collateral that was given by the guarantor and has taken possession of that asset. So the bank or the NBFC has taken the possession of that asset under any law to transfer. Now this bank wants to transfer that asset as part of the corporate debtors CIRP. This can only be done with the approval of the committee of creditors where the guarantor is also undergoing insolvency or bankruptcy proceedings. Approval from the grant if C, where the guarantor, let's say this guarantor has also defaulted for the different loans that the guarantor itself has taken from the different creditors. So where the guarantor is also undergoing insolvency or bankruptcy proceedings, approval from the guarantor's creditors would also be required. So this is the idea. Basically, the guarantor's collateral, the guarantor provided a collateral that has been taken in possession by the bank. This can be included in the resolution plan so that more money can be gathered through the asset, or for the asset more money can be gathered. But for this, the approval has to be taken from the committee of creditors, and where the guarantor is also under the insolvency or bankruptcy proceedings, approval from the guarantor's creditors would also be required. This is the idea. Any confusion, anyone? Now the last point is that time limit. So this is not a change that has happened, but just for your clarity, the corporate insolvency resolution process, this shall be completed within a period of 180 days. And if there is extension that is provided, it should not be more than 90 days. And the corporate insolvency resolution process shall mandatorily be completed within a period of 330 days from the insolvency commencement date, including any extension of the period as well as the legal proceedings. So basically, for the corporate insolvency resolution process, it must be completed within 180 days, extendable by 90 days. And if there are any legal proceedings also, all of the complete process should finish by 330 days. That is the idea. Okay. Now coming to the RBI cancels the license of Paytm Payments Bank Limited. So what has happened that the RBI through its order cancelled the banking license issued to Paytm Payments Bank Limited under section 22(4). So the license was provided under the section 22(4) of the Banking Regulation Act 1949. Now, consequently, the Paytm Payments Bank Limited is prohibited from conducting the business of banking. That means it cannot collect any deposits. The payment banks, they are not allowed to lend the money, but they are allowed to take the deposit up to the amount of 2 lakh per customer. Okay, so payment bank, that is the Paytm Payment Bank, now it has been prohibited from conducting the business of banking as defined in section 5B. Okay, so that is the idea. So basically, the Reserve Bank of India through its order has cancelled the banking license issued to the Paytm Payments Bank Limited, and consequently, Paytm Payment Bank cannot conduct any banking business. Okay. RBI will make an application for winding up of the bank before the High Court. Paytm Payment Bank Limited has enough liquidity to repay its entire deposit liability to the depositors upon winding up of the bank. So basically, the RBI is telling the depositors that they do not need to worry. The Paytm Payment Bank has enough funds to return the money of the depositors. Okay. Now the minimum required. See, there are certain criterias for the payments bank to fulfill. They need to have the minimum they need to have the minimum paid up equity capital for opening a payment bank is 100 crores. So this is the minimum net worth required for the payment bank. For the first 5 years of commencement of business, the promoter must contribute at least 40% of the paid up equity capital. Deposit limit is 2 lakh per customer. Payment bank are the result of the recommendations made by Nachiket Moore committee, and Paytm Payments Bank is one of the payment bank that also follows these conditions. It also cannot lend. Okay. Now, the Reserve Bank has cancelled the license of the Paytm Payment Bank Limited because of these reasons. First of all, the affairs of the bank were conducted in a manner that was detrimental to the interest of the bank and its depositors. Thus, the bank is not complying with certain sections. Okay, the general character of the management of the bank is prejudicial to the interest of depositors as also the public interest. So basically, the general character of the management is not good because it is prejudicial. It is not good for the interest of the depositors as also the public. Thus, the bank is not complying with the provisions that stated that the management has to work for the interest of the depositors and the public interest. Okay, no useful purpose or public interest would be served by allowing the bank to continue as envisaged in the section 22(3). So as per the section 22(3)(e), the public interest will be served by grant of license to the company to carry on banking business in India. So basically, the requirement is that whenever the license is given to a bank, whenever a license is given to a company to carry the banking business, the public interest should be served. That there are more banks, so there will be more banking services that can be provided, more financial inclusion that can happen. So whenever a bank is being established, basically the public interest will be served by granting of license to the company to carry on banking business. Now, no useful, it is said that Paytm Payment Bank, it is not serving any useful purpose or public interest. So that's why allowing this bank to continue is not required. So no useful purpose or public interest would be served by allowing the bank to continue operations as it is not serving any public interest. The bank failed to comply with the conditions that is stipulated in the payment bank license issued to it. That means it has to maintain the net worth criteria. It needs to maintain the CRAR of 15% and such. So there are certain criteria that a bank has to follow when it is getting established, and after establishment also it has to maintain its net worth and such. So bank failed to comply with the conditions that were laid down while providing the payments bank license to the Paytm Payments Bank. So these are the reasons that why the license was cancelled. First of all, the affairs of the bank were conducted in a manner detrimental to the interest of the public. The character of the management of the bank was prejudicial. No useful purpose was being served by the bank, and the bank failed to comply with the conditions that were laid down while providing the payment bank license. I hope this is all clear. Okay, any confusion here? Previously, the bank was directed to stop onboarding of new customers with effect from March 11, 2022. Thereafter, on January 31st, 2024 and February 2024, certain business restrictions were also imposed on the bank. Now, it has which disallowed any further deposits, credits, top-ups in existing customer accounts. Okay, that is the idea. So basically, it is not that suddenly Paytm Payment Bank license has been cancelled. It is not a sudden decision. The RBI is trying to tell that since 2022, the RBI has been taking steps against this institution, and the onboarding stopped in 2022, and the deposits and such, they were stopped in 2024. Okay. Now, any confusion, anyone? Any confusion, anyone? So this is the first question. I hope you will be easily able to answer this question. As per the Insolvency and Bankruptcy Code Amendment Bill 2025, which of the following statements is or are correct in regard to the creditor-initiated insolvency resolution process? So these are the statements. Now you have to tell that which of the following statements is or are correct. Okay. Chalo. Coming to the second question, the adjudicating authority, that is NCLT for the corporates, and it is the debt recovery tribunal for the individuals and partnership within dash days of the adjudicating authority, within dash days of the receipt of application, admit the application if it is satisfied that a default has occurred and such. And the default should be of minimum how much? I hope you remember. Do join. Now, let's start with today's session. The RBI has issued the directions on reporting instructions for the authorized dealer category 1 banks. So, I hope you know that the authorized dealer category 1 banks, so authorized dealer banks, they are basically the banks that are allowed, that are authorized by the Reserve Bank of India to undertake the exchange or to buy and sell the foreign exchange. Okay, so authorized dealer category 1 banks, they are the banks that are authorized by the Reserve Bank of India to buy and sell the foreign exchange. Okay, for the different purposes, for the current account transactions, like for the trade in goods, for the trade in services, for the transfer payments, for the remittances and such, the authorized dealer category 1 banks, they can buy and sell the foreign exchange, as well as for the capital account transactions, that is for the investment purposes, for the borrowing purposes, the authorized dealer category 1 bank, they can exchange or they can buy and sell the foreign exchange. Okay, so for the current account transactions, trade in goods, trade in services, transfer payment, for the capital account transactions, that is for the investments, the borrowing and the lending that we are doing with the other countries. So for all these different purposes, the authorized dealer category 1 bank, they are allowed to buy and sell the foreign exchange. Okay, so these are the authorized dealer category 1 banks. So there are certain instructions that have been released for these category of banks. Okay, now previously what used to happen, that as per the master action risk management and interbank dealings that was released in 2016, that has been amended from time to time, in terms of which authorized dealer category 1 banks, they are required to report all the over the counter foreign exchange derivative contracts and foreign currency interest rate derivative contracts. So basically the authorized dealer category 1 banks, they had to report all the over the counter foreign exchange derivative contracts and the foreign currency interest rate derivative contracts. So first of all, what are the derivatives? What are the derivatives? Derivatives are such financial contracts. They are the financial contracts that derive their value from some underlying asset. This underlying asset can be the shares, the value of the shares, or it can be the interest rate in rupees, or it can be the interest rate of the foreign currency, or the underlying asset can be the commodities, or it can be foreign exchange, foreign currency. Okay, the value of the foreign currency. Okay, like $1 equal to 83 rupees, or $1 equal to $1 equal to 100 rupees. So basically the derivatives, they are the financial contracts that derive their value from some underlying asset, the value of the shares, or the interest in rupees, or the interest of the foreign currency, the commodities value, or the foreign currency value. So these are the derivatives. Derivatives are of different kind. The forwards, swaps, options and futures are there, right? There are different kind of 4 types of derivatives basically. Now the forward contracts, these are the contracts that are traded over the counter. That means these forward contracts, they are not traded on the stock exchanges. They are not traded on the stock exchanges, because the forward contracts, they are usually the customized contracts as per the need of the people that are trading in the forward contracts. Okay, so let's say I'm signing a forward contract. I am a exporter, and I know that after I am a importer, let's say, and I want to import some machines after 1 month. Now I'm afraid that what if the value of dollars increase and I have to pay more rupees to get $1 to purchase these machines that I want to purchase from USA. So what I will do, that I will come into a forward contract, that after 1 month, that is on 30th of May, I need $1,000 and I will purchase $1 at 83 rupees. So that I have fixed the price, fixed the value, So even if like after 1 month on 30th of May something happens and the value of dollars is $1 equal to 100 rupees, but I will only have to pay how much? I will have to pay 83 rupees. So this is like this is used for hedging to reduce your risk, as well as for speculative purposes also this is used. But basically for the hedging, for reducing your risk, you can use these kind of forward contracts, and they are customized. You can decide the date on which you want to purchase the dollars. You can decide the value, okay, on which you want to purchase the dollars and such, and whoever is the seller, if they want to sell, they can sell. So this is the basic idea. I hope this is very much clear. So I hope this is clear. Okay, these are the kind of forward contracts. So see, over the counter, now we have discussed that over the counter contracts are basically over the counter derivative contracts. They means a derivative other than those which are traded on the recognized stock exchanges. So in the recognized stock exchanges, the futures are being traded. The futures are being traded, okay? Futures and options. You must have heard about the FNO section in the IND money, in the different apps that you are using for trade. In the different app, there is the section of FNO in which many of the people trade, okay? And SEBI has also said that the retail investors, they should not invest in the future and option market, because this particular section is very volatile, as well as big traders, they usually trade in this segment, and retail investors, most of the retail investors, they make the losses. So SEBI has again and again talked about the FNO, because the futures and options, they come under the stock exchanges, okay? So OTC derivative transactions, or basically means a derivative other than those which are traded on the stock exchanges, on the recognized stock exchanges. So over the counter transactions, derivative transactions, these are the transactions that are not happening on the stock exchanges. They usually happen through the electronic trading platforms on the personal basis. The transactions or the contracts are happening. So now I hope you have understood the basic idea that the authorized dealer category 1 banks, previously they were required to report all their over the counter derivative foreign exchange derivative contracts in which they were trading the foreign exchange, as well as foreign currency interest rate derivative contracts. So these had to be reported. These had to be reported to the trade repository of the CCIL, Clearing Corporation of India Limited, as well as the authorized dealer category 1 banks. They also has overseas entities, that is overseas subsidiary, like the State Bank of India, Punjab National Bank has various branches in other countries or subsidiaries in the other countries, okay? So basically the State Bank of India, Punjab National Bank, the branches that it has in the other countries, for that also the reporting had to happen of the over-the-counter foreign exchange derivative contract or foreign currency interest rate derivative contract. So this is the basic idea, okay? If you have understood this, then this whole article will become easier for you to understand, that the authorized dealer category 1 banks, they are required to report all the over-the-counter derivative contracts in the foreign currency undertaken by them directly by the bank itself or through their overseas entities, through their overseas branches to the trade repository. They have to report trade repository of the CCIL. As well as what happens that as per the rupee interest rate derivative directions 2025, in terms of which market makers, now what are market makers? Market makers are basically the entities or the authorized people that maintains the liquidity in the market. Okay, let's say you want to sell your securities, but there is no buyer. So that means liquidity is not there. You are not able to sell your security. Let's say you want to buy the security. You want to buy some shares or something, but there is no, or you want to buy the derivatives, but there is no seller. So there is no liquidity in the market. To resolve this kind of problem, there are the market makers. The market makers, they keep on quoting the prices for the buy and sell so that liquidity is maintained in the market. And if someone wants to sell the derivatives, the market makers can buy the derivatives. If someone wants to buy the derivatives, the market makers can sell the derivatives. So basically market makers maintain liquidity in the economy, in the financial segment. So as per the rupee interest rate derivative directions 2025, in terms of which market makers in the rupee interest rate derivative market. So market makers, they are maintaining the liquidity in the rupee interest rate derivative market, they are required to report all the over-the-counter rupee interest rate derivative transactions undertaken by them directly or through their overseas entities, as well as all rupee interest rate derivative transactions that are undertaken globally by their related parties to the trade repository of CCIL. Now, here is a difference that I hope you have noticed, that authorized dealer category 1 banks, if they are undertaking the over-the-counter foreign exchange derivative contract or foreign currency interest rate derivative contract, they have to report such transactions to the trade repository of the CCIL if the transaction has been undertaken by them directly or by their overseas entity. But in the case of the market makers, as per the recent direction that was released in 2025, market makers in the rupee interest rate derivative contract market, they have to report the over-the-counter derivative contracts. That is the interest rate derivative, rupee interest rate derivative contracts. They have to report all such derivative contracts that they have undertaken themselves, by them only, by their overseas entity, as well as by the related party. So related party, we will discuss that what are the related parties. But even the related parties, even if they are undertaking these interest rate derivative contracts in rupees, even then these transactions also had to be reported to the trade repository of CCIL. Okay, so globally, even if the related parties are undertaking these transactions, that also have to be reported by the market makers for the trade repository of the CCIL. Now, this particular related party wala clause was not available for the authorized dealer category 1. So, authorized dealer category 1 banks, they did not have to report the transactions, the derivative transactions over the counter by their related parties. Got it? Any confusion here, first of all? Do you understand the difference? Market makers, they had to report the transactions undertaken by the related parties globally, but the authorized dealer category 1 did not have to report the derivative transactions undertaken by the related parties. Okay, any confusion, first of all? So now, what is the change that has come? Recently, the RBI has issued these directions. So under these reporting instructions for the authorized dealer category 1 banks, it has been clearly laid down that on a review, it has been decided that the authorized dealer category 1 bank, they shall also report all the over-the-counter foreign exchange derivative contracts involving the Indian rupee undertaken globally by its related party to the trade repository of CCIL. So basically, authorized dealer category 1 banks, before they were reporting over-the-counter foreign exchange derivative contracts and the foreign currency interest rate derivative contracts that were undertaken, these transactions that were undertaken by them or by their overseas entity, by their branches overseas. Now it has been said that they also have to report the foreign exchange derivative contracts that is involving the rupee if these transactions are undertaken by the related parties. This has also to be reported by the authorized dealer category 1 bank, and where the reporting should happen, to the trade repository of the CCIL. That is the idea. Okay, so on a review, it has been decided that the authorized dealer category 1 bank, they shall report all the over-the-counter foreign exchange derivative contracts involving the rupee undertaken globally by its related parties to the trade repository of CCIL. Now, what are the related parties? So first of all, as per the direction or instruction, the related party shall have the same meaning as assigned to it under the Indian Accounting Standard Related Party Disclosures or International Accounting Standard 24 Related Party Disclosures or any other equivalent accounting standard, provided that the term related party shall exclude the associates. So related party actually means what? So as per the Indian Accounting Standard, the related party disclosures, the related party means a person who has control, like we are talking about the related party, like authorized dealer category 1 bank. For this particular bank, the related party is any person who has control over the bank, or any a person that has joint control over the authorized dealer category 1 bank, or any person, any shareholder that has significant influence over the authorized dealer category 1 bank, they are the related parties, as well as key management or managerial personnel like the CEO or the board members and such. They are also the related parties of the authorized dealer category 1 bank. So these persons that directly have the control or joint control or significant influence, these persons as well as the close family members of these person, like the spouse or the children of these person, they also are considered the related parties of this authorized dealer category 1 bank. So means authorized dealer category 1 bank will have to report all the foreign exchange OTC derivative contracts that are signed by these related parties. These also have to be reported by the authorized dealer category 1 bank to the trade repository of the CCIL. As well as, other than these person, the entity can also be a related party to this bank if the entity is related to this authorized dealer category 1 bank. They belong to the same group. Let's say the Kotak Mahindra group is the parent of the Kotak Mahindra bank. Okay, so for this parent entity as well as for the other entities that are related to the Kotak Mahindra bank, like the subsidiary as well as the joint ventures and such, okay, like the State Bank of India, it is a authorized dealer category 1 bank. There is it is the parent bank. There is also State Bank of India Life Insurance. There is also State Bank of India Card and Payment Services entity. Okay, so these are the related parties of the State Bank of India because they belong to the same group. So if the entity belong to the same group, the parent, subsidiary, fellow subsidiary is related to the others. Okay, then also the authorized dealer category 1 bank has to report such kind of transactions that are undertaken by the related parties. Both entities, they are joint venture. Let's say both the entities, the Kotak Mahindra Bank and the Kotak Life Insurance or Kotak Securities, they both are the joint ventures of, or they are the subsidiaries of the parent Kotak Mahindra Bank. So the fellow subsidiaries, so for Kotak Mahindra Bank, the related party is the parent as well as the fellow subsidiary, as well as, let's say, XYZ is the joint venture of ABC, and the 123 Bank, that is the category authorized dealer category 1 bank, this is also the joint venture of ABC and some other entity. Okay, so the joint ventures of the third party, both entities are joint ventures of the same third party, then also the other entity will be considered the related party of the bank. Okay, or if the entity, let's say the entity is controlled or jointly controlled by the key management personnel of the bank. So let's say there is an entity that is controlled by the same key management personnel that are controlling the bank, that are controlling the authorized dealer category 1 bank, then also this entity will become the related party of the bank. So you can understand that the authorized dealer category 1 banks, they have to report so many of the transactions of the related parties, and there are so many of the related parties that a bank can have. For all these related parties, that can be a person or the close member of that person or any entity that is the related party, the authorized dealer category 1 bank have to report all the over-the-counter foreign exchange derivative contracts involving the Indian rupee undertaken globally by its related parties to the trade repository of CCIL. This is the idea. Now there are some timelines, there are some facts that you have to keep in mind. The authorized dealer category 1 bank has done additional financial contract with another bank, with another authorized dealer category 1 bank. Okay, so this is the idea that the client, the authorized dealer category 1 bank has done a contract that the authorized dealer category 1 bank A will sell $100 to the client at a particular rate, and authorized dealer category 1 bank has done another contract that it will buy $100 on this specified date at this rate. So basically it has covered its position. It is not at risk because it is selling the dollars, at the same time it will be buying the dollars at the future date. Okay, so it has no open position. So this is considered the back-to-back arrangement that the bank is covering its position by coming into the simultaneous contracts. So an authorized dealer category 1 bank will not be required to report transactions that is undertaken in terms of the back-to-back arrangement and transactions that is undertaken by the related parties with other authorized dealer category 1 banks in India. Because if the related party, let's say the person that has control over this authorized dealer category 1 bank A, it is this related person or this related entity, this person is coming into the contract with another authorized dealer category 1 bank. So this other authorized dealer category 1 bank, it will report the transaction because this bank is a part of the transaction, so it will report the transaction directly. So the authorized dealer category 1 BA bank will not have to report it separately. So basically this is a bank A, it has a related party, that is a person, let's say that is the key managerial person in the bank A. Now this person is having a contract with the bank B. Now this bank B has to report the transaction because this is a part of the transaction. So this bank B has to report the transaction to the trade repository of the CCIL. So already the transaction has been reported. So in this case, the bank A does not have to report the transaction of the related party. That is the basic idea. So authorized dealer category 1 banks, they are not required to report the transactions in which the back-to-back arrangement has happened. That means they have covered their position by simultaneously doing the contracts, so that they have covered the position, and transactions that is undertaken by the related party with other authorized dealer category 1 bank in India. So these kind of transactions, they are not to be reported to the trade repository of CCIL by the bank A under the existing instructions. That is the idea. Okay. Next, any confusion in this point? Any confusion? So back-to-back transaction, back-to-back arrangements and the transactions undertaken by the related parties with other authorized dealer category 1 banks in India will not have to be reported by the authorized dealer category 1 bank whose related party it is. Now an authorized dealer category 1 bank shall have the option of not reporting the transactions where the notional value of the contract, does not exceed $1 million or the equivalent in any other currency. Okay, so this is the idea that the authorized dealer category 1 bank, they have the option to not report the transactions where the notional value of the contract does not exceed $1 million or the equivalent value in the other currency. Okay. Next is authorized dealer category 1 bank shall ensure that with effect from 1st July 2027, all foreign exchange derivative contracts that is involving the rupees undertaken by its parent, including the branches of the parent, are reported by it. That means Kotak Mahindra Bank, that is a bank that is, let's say, authorized dealer category 1 bank. It has a parent, Kotak Mahindra Group. Okay, this is the parent. So basically, if the parent or the branches of the parent, if they are undertaking the foreign exchange derivative contracts over the counter, so all these kind of contracts, they have to be reported to the trade repository of the CCIL with effect from July 1, 2027. With effect from July 1, 2027. With effect from July 1, 2027, the transactions reported by the authorized dealer category 1 bank constitute 70%. So from the same date, with effect from July 1, 2027, at least 70% of the notional value of all foreign exchange derivative contracts involving INR that are undertaken by the related parties other than the parent, the other related parties that are the key managerial person or the other person having the control or other entities. So other key related parties, if they are undertaking the foreign exchange derivative contracts, so 70% of the value of the transactions have to be reported with effect from July 1, 2027. That is the idea. Okay. So for the parent, and the branches of the parent, from July 1, 2027, 100% of the contract's notional value have to be reported. But for the related parties, because there are so many of the related parties, so there is the timeline that is provided, phased path that is provided, that is with effect from July 1, 2027, transactions reported by the authorized dealer category 1 bank constitute at least 70% of the notional value of the contracts undertaken by the related parties. With effect from January 1, 2028, 80% of the notional value of the contracts have to be reported, and with effect from July 1, 2028, that is within 1 year, we can say all the foreign exchange derivative contracts undertaken by the related parties have to be reported. So basically, there are two categories. The contracts that are undertaken by the parent and its branches, they have to be reported 100% with effect from July 1, 2027. Now, if there are other related parties, if the contracts are undertaken by the other related parties, that is not the parent, in this case there is a phased path that is provided. With effect from July 1, 2027, 70% of the contract value has to be reported that are undertaken by the related parties, and January 1, 2028, 80% of the notional value of the contracts have to be reported, and with effect from, like, within 1 year from July 1, 2028, the 100% of the notional value has to be reported. Any confusion? No? Okay. Reporting shall be in terms of the following. So, authorized dealer category 1 bank shall report all the important elements of the transactions of the contract, like the notional value, the name of the counterparty. Let's say the related party is coming into the contract. So, which is the other party? That is a part of the contract. Okay, so the notional value of the contract, the name of the counterparty, that is the other party in the contract, maturity date, currency specifications, in which currency the transaction is happening, INR is involved, but what is the other currency that is involved? Okay, as applicable to the transaction. So, authorized dealer category 1 bank shall report all elements of the transaction which are relevant to provide meaningful information. The central counterparty. Now, there are certain transactions, let's say the related parties or the authorized dealer category 1 banks. The related parties, they are doing the transaction through the anonymous trading platform. So they are coming into a contract through the anonymous trading platform. In this case, the counterparty is not, like, the related party is not aware about the counterparty. The bank is not aware about the counterparty because it is an anonymous trading platform. We do not know that who is selling the contract or who is buying, who is the counterparty. We are not aware about it. So if the related party, it is coming into a contract with through the anonymous trading platform, so the counterparty, what is the other party, that is, let's say related party is buying the contract, so the other party is selling the contract, we do not know who the seller is. In this case, while the reporting is happening, the central counterparty is basically the intermediary that is coming in between the buyer and seller. So the buyer is the related party, the seller is the anonymous person. So the central counterparty is the intermediary that is basically acting as a seller for the buyer and buyer for the seller, and it is going to handle the transaction between the two entities. So if you are not aware about the counterparty, the other party, then the central counterparty may be reported as the counterparty. Only in cases where the transactions are happening through the anonymous trading platform, in this case, the transaction is cleared through the central counterparty, and that's why the central counterparty can be named as the counterparty. Okay. Yes. Moving forward. Next is the reporting formats shall be as indicated by the CCIL, because you have to report to the trade repository of the CCIL. So the CCIL will inform the reporting format. Transaction shall be reported preferably on the date of the transaction, but in any case within 2 working days from the date of the transaction, not later than that. Okay, so this is it. This is the whole article that we have discussed. We have discussed about the reporting, the timeline for the reporting, the phase timeline that is provided for the related parties and such. Now coming to the next article, that is on April 28th, 2026, the RBI has launched Mission Saksham. Okay, any confusion anyone in the previous article? This we have completed. So for all, so basically remember that on a review, it has been decided that the authorized dealer category 1 bank shall report all the OTC foreign exchange derivative contracts involving the Indian rupee undertaken globally by its related parties to the trade repository of CCIL. Okay, so for all the over-the-counter foreign exchange derivative contracts, this is the system that has been brought. Remember this. This is the main idea. The rest is just the data that you have to remember. Now, coming to the mission Saksham. RBI launches mission Saksham. Saksham is Sehkari Bank Shamta Nirman for capacity building of the urban cooperative banking sector. Okay, so Reserve Bank of India, it has announced, I think in February only, the announcement was made about the mission Saksham, that the mission Saksham will be launched. Now in April, the mission Saksham has at last been launched, so it becomes very, very important because just before your examination, this has been finally launched. So first of all, full form SA for Sehkari Sakshamta. Saksham for Sakshamta. Okay, so the Reserve Bank of India has been taking various steps, various regulatory and supervisory measures to support the urban cooperative banks. Now the mission Saksham, this is a mission mode sector wide all India capacity building training initiative for the urban cooperative banks. So under the mission Saksham, training programs, in-person training programs as well as e-learning courses would be conducted for the urban cooperative banks, covering about 1.40 lakh participants, and these training programs will be for the board members also, senior management, heads of the risk, compliance, audit functions, employees working in IT function and other critical areas. So the different levels of the authority will, or the different level of the employees, they will be included in the training programs. Okay, the Reserve Bank shall endeavor to conduct these training programs with content delivery in the regional languages to the extent that is feasible and possible, and the mission has been designed in consultation with the umbrella organization of the UCBs and the National State Cooperative Federation. Now the mission is expected. What is the outcome that is expected from the mission? So the outcome is to enhance the managerial and operational capabilities, improve the compliance culture, and strengthen the institutional resilience across the urban cooperative banks. So to improve the managerial and the operational capability, improve the compliance culture so it can comply with the rules and regulations of the Reserve Bank of India, and strengthen the institutional resilience across urban cooperative banks against the distress. Mission Saksham, the aim of the mission Saksham is to establish a sustainable, self-reinforcing ecosystem for continuous learning, contributing significantly to systemic stability of the urban cooperative banks, healthy growth and development of the urban cooperative banks. This is it. So this is it for today. Now this is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding reporting of OTC foreign exchange derivative contracts involving INR to the trade repository of the CCIL, and in this regards, which of the following statements is or are correct, that you have to inform. So which of the statements given above is or are correct. So do try to inform. Do try to give the right answer of the first question. The second question is that as per reporting instructions for authorized dealer category 1 banks with effect from July 1, 2027, transactions reported by such bank constitute at least what % of the notional value of all foreign exchange derivative contracts involving INR undertaken by its related parties over the counter other than the parent. For the parent, it would be 100% from July 1, 2027, but for the other related parties, what percentage of the notional value has to be informed, that you have to tell. Now, this was the question that was given as the homework question in the last session. So in regards to the creditor initiated insolvency resolution process, the first and third statements were correct. The second was wrong. Many of you have given the correct answer. So the creditor initiated insolvency resolution process, it should be concluded within 150 days, correct. Adjudicating authority can approve the extension of time by 45 days, not 90 days, by 45 days. Okay, that's why second was wrong. In the case of the creditor initiated insolvency resolution process, the management of the corporate can keep the managerial responsibility, but under the regulation or under the supervision of the resolution professional. So third is also correct. So 1 and 3 was the answer. Okay. Second homework questions that I have given today. We will discuss it in the next session now, and do try to answer these questions. So now, before ending the video, let me show you that how EduTap can help you, okay? So if you go to the EduTap's website, that is, if you go to edutap.in, here you can see the EduTap's website. You can go to the courses section. In the courses section, you can see the RBI Grade B courses, okay? And as the exam is quite near, so we have brought for you the live crash course. In the live crash course, you are getting the live classes for the phase 1 as well as for the phase 2 subjects, okay? So right now, you have to focus more on the phase 1. And so for the quant, reasoning, English, for the general awareness, for the RBI notifications, reports, for finance current affairs, ESI current affairs, general awareness, for all these different components, you are getting the live classes. And after the live classes, you also get the recording of the live classes, okay? The solve previous year questions, chapter wise test, full length test, they are also provided for this live crash course. And right now there is the flat 80% off that is going on, so you can avail this offer by using the code RBI80, or you can use the code whatever is provided on the website, like when the video is released, okay? So this is the live crash course that is going to help you for your phase 1 and the phase 2 preparation in the limited time, as the exam is quite near. If you want to attempt a lot of questions, you can also see the test series where you are getting the chapter wise test, sectional test, full length test, current affairs test, detailed explanation, evaluation by the super mentors also. So this is the idea. And now this is the end of the session. So thank you everyone for joining the video, and see you in the next session.